Okay, let's unpack this. So imagine it's 500 years ago. There's this Italian friar sitting at a wooden desk with a quill and a piece of parchment.
Yeah, just the absolute basics.
Right. And he basically invents something that, I mean, most people today just assume was created by some modern tech company.
Oh, absolutely. They think it's software.
Exactly. But he didn't invent a physical machine. He invented, like, a logic system. And that system is so perfectly balanced, so mathematically airtight, that it essentially became the operating system for modern capitalism.
It's wild to think about.
It really is.
Yeah.
I mean, the exact same binary balancing logic that this friar wrote down in 1494, I think?
Yep, 1494.
Yeah, that exact same logic is what currently runs Wall Street. It powers Amazon's entire global supply chain. It's literally the foundational architecture for, those multi-trillion-dollar automated trading algorithms.
It really is one of the most underappreciated intellectual achievements in human history, honestly.
I agree completely.
Because we look at these massive glass skyscraper mega corporations and we just assume they are running on some impossibly complex, inaccessible financial math.
Right, like you need a PhD to even look at it.
Exactly. But if you strip away the servers and, the sleek software interfaces, the foundational engine is identical to what spice merchants were using in the Renaissance.
Which is just crazy. And that is exactly what we are unpacking today. So if you are joining us for this deep dive, welcome.
Glad to have you here.
Yeah. I want to set the stage for what we're about to do because I know that just hearing the word accounting is enough to make, well, a lot of people's eyes just totally glaze over.
Or it gives them actual anxiety.
Yeah, for sure. Real anxiety. Whether you are, a complete beginner, maybe thinking about starting a side hustle, or a college student staring down the barrel of a massive midterm exam.
Or just someone who wants to know how money actually works.
Right. Accounting just has this reputation as being a giant, terrifying wall of arbitrary rules.
People assume it's just rote memorization. They think it's this sterile exercise where you put number A in this box and number B in that box just because some textbook told you to.
Just following instructions blindly?
Yeah. And when you learn it that way, I mean, it is tedious, it's frustrating, and it's almost impossible to actually retain the information long term because you don't have any underlying foundation.
So today, we're completely abandoning that approach.
Completely.
If you're listening, I want you to imagine that you and I and our resident expert here have just walked into a really comfortable, quiet study room.
The door's closed. No ticking clock.
No pressure at all. We've got a massive whiteboard, some comfortable chairs, and one singular mission today, conceptual clarity. We are going to build this logic engine from the ground up.
Because if you understand the why behind how value moves, if you really get the underlying physics of business, you will never have to rotely memorize the whatever again.
It'll just make sense.
Exactly. The rules will simply make intuitive sense to you.
So let's lay out the syllabus for our time in this study room. We are going to start by traveling back to that 15th century friar, just to understand the origin of the double entry system.
Gotta know where it came from?
Right. Then we are going to look at the beating heart of all business, which is the accounting equation.
That's the big one.
It is. From there, we are going to demystify what everyone assumes is some secret language, debits and credits.
Oh, the amount of confusion around those two words.
We will definitely get into that. Then we'll explore the two different lenses for classifying accounts, traditional and modern. And finally, we're going to take all that theory and apply it practically by writing flawless journal entries.
It's a very deliberate step-by-step journey we're taking.
Building blocks.
Right, because we can't just jump straight into writing a journal entry if we don't know how to speak the language of debits and credits.
Makes sense.
And we can't speak that language if we don't understand the master equation that dictates all of it. Everything builds on the previous concept.
So let's start at the very beginning then. Before we even look at a number or, a dollar sign, we need to talk about that Italian friar. Because accounting wasn't just handed down on stone tablets.
No, it wasn't.
And it wasn't invented by some government tax agency either. It was formalized by a mathematician named Luca Pacioli.
Luca Pacioli. He was such a brilliant thinker in the 15th century. And in 1494, he published this truly groundbreaking book.
But it wasn't a business book, right?
No, not exclusively. It was a comprehensive mathematical text. The title was Summa de Arithmetica, Geometria, Proporzioni e Proporzionalità.
Which translates roughly to everything about arithmetic, geometry, and proportions.
Exactly. It was a masterwork of math for its time. But buried inside this massive text was the very first published description of a double-entry accounting system.
It's tucked in there.
Yeah. Pacioli wasn't just, observing how local merchants kept their books. He was documenting the emergence of the only truly scientific system for tracking value. And he laid down one fundamental, inescapable truth. Every single transaction has a twofold aspect.
A twofold aspect.
Yeah.
Okay, meaning every single time money or value moves, it has a dual nature, a debit and a credit.
Right. Every transaction, no matter how tiny it is, affects at least two different accounts.
Now, I want to challenge this right out of the gate, because I think this is where a lot of people, especially beginners, naturally get confused.
Let's hear it.
Let's say I decide to open a small coffee shop.
Okay, love coffee.
Right, so I'm keeping a ledger. I go out and I buy a really nice high-end commercial espresso machine for $5,000 in cash.
Big investment.
Yeah. In my mind, the easiest, most logical way to track this is to just have a single running list of my cash. I look at my list, I write down minus $5,000 for espresso machine, and I see my cash balance is lower. Why isn't that enough? Why do I need to do twice as much work to record this twofold aspect?
Think about the massive blind spot in that single list system, though.
What blind?
Well, your single list only tells you half of the story. Yes, it successfully tells you that cash left your pocket. But where did that economic value actually go?
Oh, I see.
Did you lose it on the street? Was it stolen by an employee? Did it just evaporate into thin air?
Wow, okay. So in a single entry list, a $5,000 loss from theft looks mathematically identical to a $5,000 investment in an asset.
Precisely. They look exactly the same on paper. But if we look at the transaction through Pacioli's dual aspect, the value didn't vanish. It simply changed form.
Right.
Purchasing that espresso machine means, on one hand, your cash balance reduces. But crucially, on the other hand, a new asset is acquired. The espresso machine itself.
So the double entry system recognizes both of those things.
Right. It records both aspects simultaneously. It acts as the ultimate evidence of reality.
So the 5,000 economic energy just kind of morphed.
Yeah.
It went from liquid paper money into a solid metal machine.
Exactly.
And if we aren't tracking the metal machine, we are basically pretending that the value just disappeared.
Which is terrible business practice. And this isn't just some abstract philosophical point either. In the practical world of running a business, this dual aspect system provides core operational advantages.
Like what?
Well, there are 5 specific foundational advantages that are universally recognized. And these are critical to grasp, especially if you're taking an exam on this.
Let's explore those, but let's try to keep it grounded in the reality of our hypothetical coffee shop.
Yeah, I do.
If I adopt this twofold system, what is the first immediate advantage I get over my competitor who is just using a single list of cash?
The first, and perhaps most vital advantage, is a built-in accuracy check.
Okay, how does that work?
Because you are recording 2 equal sides for every single transaction, the total of all your left side entries must mathematically equal the total of all your right side entries.
Always.
Always. This allows you to establish the arithmetic accuracy of your entire accounting ledger at any given moment.
It's like a computer checksum.
That is a perfect analogy. You verify this accuracy through a device called a trial balance.
A trial balance.
Yeah, it's essentially a test. You put all the left-sided balances in one column, all the right-sided balances in another, and you sum them up. If the two totals don't match perfectly, an alarm bell goes off.
You immediately know you messed up.
Exactly. You know there is a clerical error, an omission, or potentially even fraud. The system literally polices itself.
That alone is worth the extra effort, honestly. What's the second major advantage?
The second is ascertaining profit or loss with granular details.
Granular detail.
Yeah. A single entry system might tell you if your grunt count is generally larger at the end of the year than it was at the beginning, but it can't tell you why.
Right. It just says you have more money.
Exactly. The double entry system tracks every specific expense and every specific stream of revenue. You don't just know if your coffee shop made money. You know exactly how much you made from black coffee versus lattes.
Oh, wow.
And you know exactly how much you spend on paper cups versus roasted beans during a specific period.
Which gives you the intelligence to actually manage the business, rather than just guessing. Like, if paper cups are eating all my profits, I can see that clearly in the dual system.
Precisely. And that leads directly into the third advantage, ascertaining the overall financial position of the entity.
So, getting the big picture.
Right. At the end of any financial period, you can prepare comprehensive financial statements. Because you've tracked both sides of every transaction, you have a complete panoramic view of exactly where the business stands.
Meaning I have a definitive list of every single thing the business owns and every single thing the business owes.
Yes. So instead of just a cash balance, you have a complete map of the business's health, which, by the way, is required by banks, investors, and governments.
Makes sense. They aren't going to just take your word for it based on a single list.
No, they are not. Okay, advantage number 4 is detailed control and reporting.
Control and reporting.
The double entry system permits accounts to be kept in as much minute detail as management deems necessary. It provides significant actionable information for controlling the business.
So you aren't forced to just lump everything under a generic expenses column?
Exactly. You can have a dedicated account just for the vanilla syrup you buy if you really want to track that specifically.
Nice. And the fifth advantage?
The fifth is historical comparison.
Because the data is standardized.
Exactly. Because the logic of the system is universally standardized, the financial results of one year can be reliably compared with those of previous years. You can ascertain exactly the reasons for any changes in profit or financial position over time.
Looking back at those 5 points, accuracy checks, detailed profit loss, overall financial position, granular control, and historical comparison. I mean, it makes complete sense why this became the global standard.
You literally cannot run a large-scale enterprise without these safeguards.
And to think it all traces back to a mathematician in the 1490s figuring out that value never disappears, it just changes form.
It is the universal language of business. But, to actually speak that language, to really understand how those two sides, the value shifting from one form to another, stay in perfect balance, we have to move to the next step.
Okay, what's next?
We have to look at the master scale that governs the entire system.
The accounting equation.
Yes. The fundamental accounting equation is the mathematical core of everything we've just discussed. The equation is beautifully simple. Assets equal liabilities plus capital.
Assets equals liabilities plus capital. A equals L plus C.
That's the one.
Okay, we need to pause here and unpack this carefully because I know from personal experience that this equation is where a lot of beginners hit a massive psychological roadblock.
It really is.
Let's look at this from a student's perspective. Assets are things of value. Liabilities are debts. And capital is the money that the owner invests.
Right. Basic definitions.
So my question is, if capital is the money that I put into my coffee shop, why in the world is it grouped on the exact same side of the equation as liabilities?
Yes.
I mean, liabilities are bad things, right? They are debts to the bank. Capital's my hard-earned money. Shouldn't my capital be considered an asset?
That is hands down the most important conceptual hurdle to clear in all of accounting.
It just feels wrong intuitively.
I know it does. But if you do not grasp the answer to that specific question, nothing else will ever make sense. The reason capital sits on the same side as liabilities is due to a foundational philosophy called the business entity concept.
The business entity concept.
When you do accounting, you cannot view the world through your own eyes as the business owner. You have to undergo a complete shift in perspective.
Okay, shift cow.
You have to imagine the business, your coffee shop, as a completely separate, independent, living, breathing person.
Wow, okay.
The business has its own identity, completely separate from you, the owner.
Okay, so I am me, the human being, and the business is, let's call it Bob's Coffee. Bob's Coffee is a separate person in the eyes of the accounting system.
Let's run with that. You take $50,000 of your personal savings and you inject it into Bob's Coffee to get the business off the ground.
Right.
Now look at that transaction strictly from the perspective of Bob's Coffee. Bob just received $50,000 in cash. That cash is a valuable resource. It is an asset to Bob.
Right. Bob now physically holds the cash.
But where did Bob get that cash? He didn't magically conjure it out of thin air.
No, he got it from me.
Exactly. He got it from an external source, you. Therefore, Bob's Coffee now owes you that money back, along with any profits he eventually makes from using it.
Oh.
Capital is simply the term we use for what the business entity owes back to its owner.
Oh, wow. Okay, that shifts the paradigm entirely.
Doesn't it? Liabilities are what the business owes to external outsiders, like a bank or a supplier. Capital is what the business owes to its internal owner.
But from the perspective of the business itself, they are both just claims.
Exactly. Both of them represent claims against its assets. It owes both of them. Therefore, assets, the things the business actually owns and holds, will always perfectly equal liabilities plus capital.
Which is the total of what the business owes to outsiders and to the owner. That is brilliant. The equation is just a scale balancing what is owned against who has a claim to it.
Precisely.
And we can actually expand this equation to see the mechanics in more detail.
How so?
We can say total assets equals liabilities plus owner's capital. But owner's capital isn't just that initial $50,000 cash injection. The owner's total claim, their equity in the business fluctuates based on the business operations.
Right, because the business is trying to make money for the owner.
Exactly. The expanded formula shows that owner's equity equals the contributed capital, plus any beginning retained earnings from past years, plus any revenue generated by selling coffee, minus any expenses incurred like buying milk or paying rent, minus any dividends or drawings paid out to the owner.
Okay, so if the business makes revenue, the owner's claim goes up.
If the business incurs an expense, the owner's claim goes down.
Yeah.
The business is basically just managing the owner's wealth.
That's a great way to put it. Let's prove that the scale always balances. Let's walk through a conceptual mathematical example to really cement this.
Good idea. Numbers help.
We'll use some clean numbers to illustrate the scale. Let's imagine a snapshot of a business at a specific moment in time. The fundamental structure is equity plus liabilities equals assets.
Huh?
Let's look at the claim side first, the right side of the equal sign. Let's say the owner's equity, their capital, is $5,000.
Got it.
The business also has long-term liabilities, maybe a small bank loan of $1,000. And it has current liabilities, perhaps money owed to a vendor for last week's coffee beans of $1,000.
So let's tally up the claims against the business. $5,000 to the owner, plus $1,000 to the bank, plus $1,000 to the vendor. That equals $7,000 in total claims. That's the right side of the master equation.
Perfect. Now let's look at the left side, the asset side. What does the business actually hold to balance those claims?
It has to be $7,000.
Right. Let's see. Let's say the business owns fixed assets, like that espresso machine and some furniture worth $1,000.
Okay.
It has current assets inventory, cups, beans in the back room with $5,000, and it has actual cash sitting in the register of $1,000.
Tallying that up, furniture at $1,000 plus inventory at $5,000 plus cash at $1,000, that also equals exactly $7,000.
The scale is perfectly balanced.
Total assets of $7,000 equals total claims of $7,000.
And because this is a rigid, mathematically balanced equation, we can use basic algebra to isolate any single unknown item if we know the others. This is a very common scenario in business and, on exams.
Right, so if a piece of information is missing, we can figure it out.
Let's say you know your total capital, your loans, your furniture, and your vendor payables, but your cash register is broken and you want to calculate exactly how much cash you should have.
We can deduce it from the surrounding evidence.
Exactly. Algebraically, cash would equal the capital plus the loan minus the furniture minus the payment to trade payable.
Oh, because you just rearranged the formula.
Yep. If you plug the numbers in, $5,000 in capital plus the $1,000 loan gives you $6,000 in total funds sourced. Then you subtract the $1,000 you deployed into furniture, leaving $5,000. And you subtract $4,000 you paid out to trade payables over the year. $5,000 minus $4,000 leaves you with exactly $1,000 in cash.
Which matches the asset list perfectly. It is a closed-loop system. If you change one variable, the equation forces a balancing change somewhere else.
It proves unequivocally that if there is any change on one side of the equation, there is bound to be a corresponding similar change on the other side.
Right.
Or alternatively, an equal and opposite change on the same side. Like when you use cash to buy furniture, one asset goes down, another asset goes up, and the total stays exactly the same. The balance is never, ever broken.
Okay, the philosophical elegance of that is undeniably beautiful.
Yeah.
But here, let's bring this down to the gritty reality of a Tuesday morning at the coffee shop.
Sure, let's get practical.
Practically speaking, if I have to adjust a massive master algebraic equation every single time I sell a $4 latte, and then again when I buy a $10 box of chalk for the mini board, and then again when I pay a $50 electric bill.
Yeah, that would be terrible.
It would be an absolute nightmare. I can't rewrite a multivariable master equation 100 times a day.
You couldn't. It would be paralyzing and incredibly prone to error. You need individual buckets to track the rapid-fire increases and decreases for every specific item independently without having to recalculate the master equation every single time.
Okay, buckets.
And that logistical need is exactly why the T account was created.
The T account. Okay, if you are listening, you don't need a textbook in front of you. Just close your eyes and picture a giant capital letter T drawn on a piece of paper,
Yeah, a horizontal line across the top and a vertical line straight down the middle.
creating a left side and a right side.
It is quite literally shaped like a T, and it remains the most brilliant, convenient visual tool ever devised to track changes in a specific account.
So you have a different T for everything.
Exactly. You create one T for cash, you create a separate T for furniture, you create a separate T for the bank loan.
And what do these left and right sides actually represent?
Well, the left side of the T is the debit side. It is universally abbreviated as doctor.
DR for debit.
Yes. And the right side of the T is the credit side, abbreviated as CR.
CR for credit. Okay, let's talk about the structure of those sides. What does the formatting look like inside the T?
The standard formatting is perfectly mirrored on both the left and the right. Underneath the left side of the horizontal bar, you have 3 columns. A column for the date of the transaction, a column for the particulars, which is just a brief description of what happened, and a column for the monetary amount.
Date, particulars, amount.
And on the right side of the vertical line, you repeat that exact same structure: date, particulars, amount.
So, left side, date, particulars, amount. Right side, date, particulars, amount. Let's walk through an example to see how one of these conceptual buckets actually fills up and empties out over time.
Sounds good.
Let's look at the most active bucket in any business, the cash account.
Right. Cash is an asset. It's something the business owns. For a cash account, the rule is that all receipts, the money flowing into the business, the increases are recorded on the left side, the debit side.
Okay.
Conversely, all payments, the money flowing out, the decreases are recorded on the right side, the credit side.
So imagine we are looking at the cash T account for a really busy month. We start the month with an opening balance.
Our source example uses an opening balance of $1,000.
Because that is a positive asset we own, it sits on the left side, the debit side. Then, throughout the month, we have various receipts. We make a sale for $250,000, then another for $200,000. Then we get a sudden influx of $500,000.
Nice month.
Right. Every single time cash comes in, we record the date, the description, and that amount on the left side. The left side is just piling up.
Precisely.
Oh.
But a business isn't just receiving cash, it is simultaneously spending it.
Sadly.
Those payments go on the right side. You pay a supplier $100,000, you pay rent of $300,000, you pay salaries of $200,000. Every payment is logged with its date and description on the right side, the credit side.
So at the end of the month, I have this T account with a long list of numbers on the left and a long list of numbers on the right. How do I figure out what my actual real-world cash balance is right now?
It is basic arithmetic.
Yeah.
You total up the entire left side, all your starting cash, plus all your receipts. Let's say that total is $2,485,000.
Okay.
Then you total up the entire right side, every single payment you made. Let's say your total payments equal $2,300,000. You simply deduct the total payments from the total receipts. The difference between the two sides is your closing balance.
So $2,485,000 minus $2,300,000 leaves you with a final balance of $185,000.
And because the left side was heavier, we took in more than we spent. That remaining $185,000 sits on the left side as our positive cash balance going into the next month.
Exactly. That net result is your current reality. Right.
Okay, that makes perfect intuitive sense for cash. Money comes in on the left, money goes out on the right. But we need to look at another T account example to show how this system requires you to really think.
Yes, we do.
Let's look at a creditor's account. A creditor is someone we owe money to, like a supplier who gave us coffee beans on a 30-day tab. This is a liability.
And this is where beginners often stumble, so, pay close attention to the logic here. The operational logic for a creditor's account is the exact, complete opposite of the cash account.
Wait, the opposite?
Yes. For a liability, increases, meaning you bought more beans on credit and now you owe more money, are recorded on the right side, the credit side.
Okay.
Decreases, meaning you finally paid the supplier some cash and now you owe them less, are recorded on the left side, the debit side.
Okay. I want to stop right here. This is the moment. This is the exact intersection where people throw their hands up in frustration and say, accounting is impossible. It's just contradictory rules.
I see it all the time. And the reason they do that is because of the emotional baggage attached to the words debit and credit.
You are entirely right. It is a massive societal misconception.
We hear debit, and we think of our debit card. We swipe it. The money is gone. We feel bad. Debit equals bad. Debit equals less money.
Right.
We hear credit. We think of a score credit or a credit to our account or a good credit score. Credit equals good, credit equals more money. But in the world of accounting, these words don't have those emotional or moral values at all, do they?
They possess absolutely zero inherent meaning regarding good or bad or increase or decrease.
Really?
Zero. None. In formal accounting terminology, the term debit merely denotes an entry on the left side of any account, period. And credit merely denotes an entry on the right side of any account.
So debit literally just means left. Credit literally just means...
Right. That is the entire secret. When your consumer bank sends you a statement saying, we have credited your account, it confuses you because you think, oh, good, I have more money.
Right, I'm happy when they say that.
What the bank is actually doing is speaking from their perspective as a business entity. To the bank, your deposit is a liability. They owe that money back to you.
Because of the business entity concept.
Exactly. And as we just discussed, an increase in a liability is recorded on the right side, the credit side. They are simply telling you, we increased our liability to you on the right side of our ledger.
Wow. They're speaking bank accounting language to consumers, which just creates a lifetime of misunderstanding.
It really does.
So if debit just means left and credit just means right,
Yeah.
how do we actually know the rules? How do I know whether an increase should go on the left or the right for any given account?
This is a massive focus area for examinations, and it is the key to unlocking the entire system. We are going to establish the golden rules, and to do it, we are not going to memorize them blindly.
Thank goodness.
We are going to derive them straight back to the master accounting equation we built earlier.
Okay, I have the master equation pictured in my head. Assets equal liabilities plus capital. A equals L plus C.
Hold that image. Now, visualize where those distinct items sit in relation to the equal sign in the middle. Where do assets sit?
Assets are on the left side of the equal sign.
Exactly. Therefore, the rule for any asset account is that an increase is recorded on the left side, a debit.
Okay.
And logically, a decrease must be recorded on the opposite side, the right side, a credit.
Wait, that is incredibly elegant. Assets live on the left side of the equation, so they increase on the left side of the T account.
Now look at the other half of the equation. Where do liabilities and capital sit?
They sit together on the right side of the equal sign.
Therefore, for any liability or capital account, an increase is recorded on the right side, a credit, and a decrease is recorded on the left side, a debit.
It is a perfect symmetrical mirror image based entirely on the mathematical equation.
Yes, it is.
If my asset goes up, I debit it on the left. If it goes down, I credit it on the right. If my liability goes up, I credit it on the right. If it goes down, I debit it on the left. I literally don't have to memorize a list of rules. I just have to remember A equals L plus C and look at which side of the equal sign the item lives on.
That is the conceptual clarity we are aiming for.
I love that.
Now, to be thorough, we have to address expenses and revenues. How do they fit into this mirror image?
Oh, right.
Well, remember our expanded equation. Expenses and revenues ultimately affect the owner's capital. What does an expense do to the business's capital?
If the business incurs an expense, it eats into the profit, which decreases the capital owed to the owner.
Correct. And since capital normally increases on the right, a decrease to capital must happen on the left. Therefore, an increase in an expense is recorded on the left side, a debit.
So expenses act like assets in their movement.
Yes. Now, what about revenue?
Revenue increases profit, which increases the capital owed to the owner. Capital increases on the right, so an increase in revenue must also be recorded on the right. A credit.
Exactly. Revenues act like liabilities or capital. Debit to increase an expense. Credit to increase a revenue. Once you map it back to the equation, it is mathematically flawless.
Okay, I am feeling incredibly confident about the left and right rules. The logic is so solid. But there is a catch.
There's always a catch.
To apply those rules correctly, to know whether to increase on the left or the right, you first have to know exactly what type of account you're actually looking at.
Very true.
Like if I look at an account called prepaid rent, and I don't know if that is an asset or a liability, I won't know which rule to apply.
And that brings us to the next crucial phase of our syllabus, classification. You need to know the shape of the bucket, which is the T account, but you critically need to know the type of bucket it is.
Right.
And in the evolution of accounting, there are two distinct lenses or approaches that we use to classify accounts, the traditional approach and the modern approach.
Let's start with the traditional approach. When you read about this in textbooks, it feels a bit more philosophical, almost rooted in, like, Old English common law.
It definitely has that feel.
It breaks every account in the entire business down into two massive master buckets, personal accounts and impersonal accounts.
Let's unpack the personal account side first. What makes an account personal?
Well, personal accounts are exactly what the name implies. They relate to persons or specific entities, that the business is interacting with.
Right. And under the traditional approach, this is broken down further into three very specific subcategories.
Okay.
The first is the most obvious, natural personal accounts.
Natural persons, meaning actual biological human beings with a pulse.
Correct. If your coffee shop extends a line of credit to a regular customer named Ram or a supplier named Rita, you open an account in their actual human name. These are natural personal accounts.
Simple enough. Humans. What is the second subcategory?
Artificial or legal personal accounts. In the eyes of the law, and therefore in the eyes of accounting, certain entities are treated as if they were separate persons, even though they don't have a biological pulse.
They have a separate legal identity.
Yes.
So this would be things like a government tax agency, a private corporation, a limited company, a local club, or a cooperative society.
Exactly. You do business with Apple Inc. or the State Revenue Department as if they were a singular person. Therefore, accounts dealing with them are artificial personal accounts.
Okay, humans and legal entities. The third category under the traditional personal umbrella is where I know students usually trip up because it gets slightly abstract. Representative personal accounts.
This is a prime area for exam questions. Representative personal accounts do not have the direct, literal name of the specific person or organization attached to them.
Then how are they personal?
Because the title of the account represents a person or a group of persons.
Can you give me a concrete example of how that works?
Sure. Let's say your coffee shop has 10 employees and you owe them all their wages at the end of the month, but you haven't paid them yet.
Okay.
You don't want to clutter your main master ledger with 10 separate individual liability accounts for wages owed to John, wages owed to Sarah, and so on.
That would be a mess.
Instead, you create one single account called outstanding wages. That singular account represents all the individual people you owe money to.
Ah, I see. It's proxy.
Exactly. Other examples are a prepaid rent account, which represents the landlord who holds your money, or the capital and drawings accounts, which represent the owner of the business without using their actual name. They are all representative personal accounts.
Okay, so that covers the entire personal side of the traditional approach. Natural, artificial, and representative. Now what about the other side? Impersonal accounts.
If personal accounts deal with who the business is interacting with, impersonal accounts deal with what the business is interacting with.
What?
Right. They are divided into two subcategories. The first is real accounts.
Real accounts. What makes something real in accounting?
Real accounts relate to the actual properties, possessions, or assets of the firm. Both tangible things you can touch and intangible things you can't touch, but have value. Crucially, this category excludes debt or receivables because those relate to persons.
So a real account would be the physical land the coffee shop sits on, the building itself, the machinery, the cash sitting in the register, or an intangible asset like a trademark or a patent.
Exactly. Those are real accounts. The second impersonal category is nominal accounts. This is a very important concept.
Nominal accounts.
Yes. Nominal accounts relate entirely to the daily, ongoing operations of the business. They track the expenses incurred, the losses suffered, the gains made, and the revenue generated.
So if real accounts are the physical things the business has, nominal accounts are the actions the business does.
That's a great way to summarize it. Paying a salary, paying interest on a loan, receiving a commission, buying supplies, those are nominal.
Got it.
And the critical defining characteristic of nominal accounts, and you must remember this, is that they are strictly temporary.
Temporary. What do you mean by that? Don't we keep records forever?
We keep the records, yes, but the accounts themselves don't live forever. At the end of the financial year, a business needs to know how it performed.
Right.
It takes all the revenue from the nominal accounts, subtracts all the expenses from the nominal accounts, and calculates a net profit or net loss. That final net result is then transferred permanently into the owner's capital account.
Because all profit eventually belongs to the owner.
Exactly. Once that transfer happens, all those nominal expense and revenue accounts are zeroed out. They are wiped completely clean so the business can start tracking the next year's performance from zero.
They don't carry over.
They do not carry a balance forward. Real accounts like your cash or your building those carry their balances forward year after year. A building doesn't reset to zero on January 1st, but your salary expense account does.
That is a phenomenal distinction. Real accounts are permanent. Nominal accounts are temporary scorecards for the year.
Precisely.
Okay, so that is the traditional classification framework. Personal, with its three types, and impersonal, with real and nominal.
Yep.
But our sources also outline the modern approach, which honestly feels a lot more streamlined, especially since we've already spent so much time dissecting the accounting equation.
The modern approach is frequently called the accounting equation approach for that exact reason. Instead of philosophical debates about what is a person or what is real, it simply classifies every account into one of 6 clear, pragmatic categories based on how it functions in the equation.
Let's list them out and re-verify their left and right rules just to really drill it in.
Let's do it. Category 1, asset account.
Rule: increases our debits on the left, decreases our credits on the right.
Category 2, liabilities account.
Rule: increases our credits, right, decreases our debits, left.
Category 3, capital account.
Same as liabilities. Increases our credits on the right, decreases our debits on the left.
Category 4, revenue account.
Rule: increases our credits, decreases our debits.
Category 5, expense account.
Rule: increases our debits on the left, decreases our credits on the right.
And Category 6, withdrawal or drawings account when the owner takes money out. Since it reduces capital, it acts like an expense.
Right. So rule: increases our debits on the left, decreases our credits on the right.
It maps flawlessly to the A equals L plus C rule we established.
It really does. Okay, I want to turn our study room into an interactive classroom for a second. We have a fantastic table in the source material that compares a long list of specific items under both the traditional and modern approaches.
Oh, this is a great exercise.
I am going to rapid fire some of these items at you. I want you to classify them for our listeners under both systems and explain the logic. This is exactly what exam candidates need to be able to do instantly in their heads.
I am ready. Let's analyze them.
First item: a building.
Under the traditional approach, it is an impersonal real account because it is a tangible property owned by the business. Under the modern approach, it is simply classified as an asset.
Simple enough. Okay, what about the account titled purchases?
Purchases tracks the cost of buying goods to resell. Traditional approach. It's an impersonal nominal account because it relates to the daily cost of operations. Modern approach. It is an expense account.
Yes.
The counterpart to purchases. Traditional approach. Impersonal nominal account tracking the revenue from daily operations. Modern approach. Revenue account.
Okay, here is one that I think is a massive trap. Bank fixed deposit.
Ah, yes.
Now, under the modern approach, that is obviously an asset. It's a chunk of money we own sitting in an account generating interest. But under the traditional system, the text explicitly says a bank fixed deposit is a personal account.
It does.
I have to push back here. Why on earth is a bank fixed deposit a personal account? A bank account is not a human being.
This is exactly why the traditional system requires careful thought. And it is a classic high-frequency exam trick. You have to remember the subcategories we discussed.
The artificial ones.
Yes. The bank is not a natural human, but it is an artificial legal person.
Yeah.
When you open a fixed deposit, you are not locking physical cash in a metal box. You are essentially lending your money to that legal entity. You have a contractual relationship with a person in the eyes of the law.
Okay.
Therefore, because you are tracking what that entity owes you, traditionally, it is classified as a personal account.
Wow. You really have to look past the object and think about who is on the other side of the legal transaction.
Exactly.
All right, let's look at another tricky pairing. Let's compare the account for rent versus the account for rent outstanding.
This is perhaps the biggest red alert warning for anyone taking an accounting exam. They sound identical, but they belong in entirely different universes.
Okay, break it down.
Rent on its own is an operational cost you are paying for the current period. Therefore, traditional approach. Nominal account, modern approach, expense account.
Right, it's just the cost of doing business this month.
However, rent outstanding means the month has passed, the cost was incurred, but you haven't actually paid the cash yet. You owe that money to a specific individual or corporation, your landlord.
Oh, I see where this is going.
Because this account represents the landlord you owe the money to, under the traditional approach, it is a representative personal account. Under the modern approach, it is a liability.
That is such a subtle but catastrophic difference if you get it wrong. Rent is a temporary expense. Rent outstanding is a permanent liability representing a person. You really have to read the full account name carefully.
You absolutely do.
Okay, a couple more quick ones to finish out the table. Closing inventory.
The physical goods you have left unsold. Traditional. Real account. Modern. Asset.
Trade receivables. These are customers who bought coffee on credit and owe us money.
Because they are human beings or companies who owe you money, the traditional approach classifies them as a personal account. The modern approach simply classifies them as an asset because the right to collect that money has value.
And finally, GST payable. Taxes we collected that we now owe to the government.
Traditional approach. Personal account because it represents the government, which is an artificial legal person you owe money to. Modern approach. Liability.
Okay, that exercise completely solidified the classifications for me. It really shows how the traditional system forces you to think about the legal reality of the transaction, while the modern system is more purely mathematical.
It's a great way to look at it.
So let's take a breath and review where we are in our study room. We understand the history and the dual aspect. We have the master equation balanced in our heads.
Check.
We know how the T account buckets fill and empty based on the left and right rules. And we now know how to accurately classify every type of bucket, so we apply the correct rule.
We possess all the conceptual pieces of the puzzle.
We do. Now, where do we actually write all this stuff down on a daily operational basis?
We finally arrive at the journal.
The journal.
The journal is known universally as the Book of Original Entry.
Original entry, meaning this is the very first place a transaction lives.
Exactly. When a transaction happens, a sale is made. A bill is paid. It doesn't go straight into those individual T accounts we talked about. It is first recorded in the journal in strict, unyielding chronological order.
Day by day, hour by hour.
It serves as a historical diary of the business's financial life. It's also sometimes referred to as a subsidiary book.
Now, in a massive business, writing every single thing in one giant diary seems, well, really inefficient. Are there different types of journals?
Yes. For small businesses or for theoretical learning, we use a single general journal. But in reality, when a business has thousands of highly repetitive transactions of the exact same nature, like a supermarket making 10,000 sales a day, they use specialized journals.
Like a dedicated sales journal.
Exactly. A dedicated sales journal, a dedicated purchases journal, a dedicated cash book. But the core formatting and logic we are about to discuss applies universally to all of them.
Okay, let's look at the actual anatomy of a journal entry. Because accounting is a rigid language, it requires rigid formatting.
Very rigid.
If I'm looking at a blank page in a general journal, I see a grid with 5 very specific vertical columns. Let's walk through what goes into each column, step by step. Column 1.
Column 1 is entirely dedicated to the date. Chronology is legally and operationally vital. The standard convention is to write the year at the very top of the column, then the month below that, and then the specific numerical date of the transaction on the line of the entry.
Straightforward enough. What is column 2?
Column 2 is the largest and most important. It is titled Particulars. This is the heart of the entry where you apply everything we've learned today. Here, you write the specific names of the accounts involved in the dual aspect of the transaction, and there is a very strict syntactical format you must follow.
Okay, how does the formatting work?
First, on the very first line of the entry, you write the name of the account that is going to be debited. And at the extreme right edge of that particular column, on that same line, you write the abbreviation Dr. Dal to signify the debit.
Okay, so the account receiving the debit always gets listed first. What comes next?
On the very next line down, you do not start at the left margin. You indent slightly to the right, leave a little physical space, and you write the word to, followed by the name of the account that is going to be credited.
Wait, why do we write the word to?
It's a historical convention from manual bookkeeping that just adds clarity, visually separating the credit from the debit. So if you bought an asset for cash, the first line says machinery count doctor, and the indented second line says to cash account.
I see. And modern accounting software sometimes omits the doctor and the to, relying just on the column placement, right?
Right. But for exams and manual learning, sticking to this explicit traditional format is crucial.
Is that everything for column 2?
Almost. On the third line, immediately below the credit entry, you write a brief, plain language explanation of what actually happened, enclosed in parentheses. This is called the narration.
So it would look like being machinery purchased for cash. It's context for the numbers.
Exactly. Without the narration, an auditor looking back 3 years later might not understand the nuance of why those specific accounts were moved. It is required.
Okay, so date, then particulars with its strict formatting. What is column 3?
Column 3 is a tiny column titled Ledger Folio, or LF.
LF, what does that mean?
Remember how we said the journal is just a diary, and eventually those numbers have to be moved into the individual T accounts?
Right.
The book containing all those T accounts is called the ledger. The LF column is simply a cross-indexing system. Once you transfer the entry from the journal to the ledger, you write the specific page number of the ledger where that T account lives into the LF column. It creates a traceable link between the chronological diary and the categorized bucket.
A built-in tracking system.
Yeah.
Brilliant. And the final two columns?
They are the monetary values. Column 4 is the debit amount. You write the numerical value on the exact same line as the account you debited. And column 5 is the credit amount. You write the numerical value on the line of the account you credited.
And here is a practical rule for the listener that ties everything together. An entry can be simple, meaning it involves just one single debit account and one single credit account. Or it can be a compound entry, meaning one transaction might affect 3 or 4 different accounts simultaneously.
Like if you bought machinery, paid half in cash, and took a loan for the rest.
Exactly. That would mean multiple debits or multiple credits. But no matter how complex the compound entry is, the fundamental rule of the universe still applies. The total mathematical sum of column 4, the debits, must always flawlessly exactly equal the total mathematical sum of column 5, the credits.
Unconditionally. If they do not match, you have broken the accounting equation and your entry is invalid. Furthermore, in a manual ledger, if your journal entries for a busy week stretch across several physical pages, you are required to total both the debit and credit amount columns at the absolute bottom of the page, verify they match, write that balance down, and carry that exact same total forward to the very top of the next page before writing the next entry.
It maintains an unbroken, continuous chain of mathematical balance.
Yes.
Okay? We have reached the climax of our time in the study room. It is time to put all of this incredible theory into actual boots-on-the-ground practice.
Let's do it.
We are going to act out a full, sequential narrative example from our sources. This is the ultimate test of exam readiness. We're going to mentally journalize the opening weeks of a new business, applying every single rule rigorously.
I'm ready. Let's process the data.
I will describe the real-world transaction, and you, as the expert, will walk us through the internal logic and dictate the final, perfectly formatted journal entry. The scenario is a new enterprise called R's Business. It is April 2022. Transaction 1, April 1st. The owner, R, formally starts the business by injecting $5,000 in cash.
Okay, let's analyze the dual aspect. First, what is the business receiving? It is receiving cash, which goes into the bank. Bank is a real asset account. The rule states that an increase in an asset is a debit. So we must debit the bank account for $5,000.
Okay, that's the left side.
Second, where did that economic value originate? It came from the owner. This represents capital, which is a personal account tracking the owner's claim against the business. Capital is treated as a liability to the business, and the rule states that an increase in capital is a credit.
So what does the formatted journal entry look like?
Date, 2022, April 1st. Particulars column, line 1, bank account, Dr. Ann, and in the debit column, 5,000, line 2, indented, to capital account, and in the credit column, 5,000, line 3, narration, being business started with cash.
The equation is balanced. We have an asset of $5K and a claim against it of $5K. Perfect.
The business is alive.
Transaction 2. It's a few days later. R needs equipment. He purchases furniture for the office for $1,200, paying in cash.
Analysis of the dual aspect. What is coming into the business? Furniture. This is a real asset account. It is increasing. Rule. Debit increases in assets, so debit furniture.
And what is leaving?
Cash. Cash is also a real asset account. It is decreasing. Rule. Credit decreases in assets, so the journal entry. Furniture count. Dr. 1,200 in the debit column to cash account. 1,200 in the credit column. Narration. Being furniture purchased for cash.
I want listeners to notice what just happened to the master equation there. One asset, furniture, went up by $1,200, and another asset, cash, went down by exactly $1,200. The net change to the total assets of the business is 0. The scale didn't even tip. Value just shifted from liquid form to solid form. Beautiful.
That really is.
Okay, transaction 3. The business is running. R pays a salary to his clerk of $1,100 in cash.
Analysis. Paying a salary is the cost of operating. Salary is a nominal account. It is an expense. The rule, derived from its effect on capital, is that an increase in an expense is debited. So debit salary account. To pay it, cash and asset is decreasing. Credit cash account.
So the entry is?
Salary account. Dr. 1,100. To cash account. 1,100. Narration, being salary paid.
Transaction 4 is very similar, but let's reinforce the habit. R pays the monthly rent of $1,150 in cash.
Identical operational logic. Rent is a nominal expense incurred to keep the doors open. Increase the expense with a debit. Decrease the asset paying for it with a credit.
The entry.
Rent account. Dr. 1,150. To cash account. 1,150. Narration, being rent paid.
Let's do one that goes in the other direction. Transaction 5. The business had some extra cash sitting in a deposit and receives interest of $2,000.
Analysis. Economic value is flowing in. The cash asset is increasing. Rule. Debit the increasing asset, so debit cash.
Way to come in.
It was generated by interest. Interest received is a nominal account, specifically categorized as an income or gain. The rule is that increases in income, because they boost capital, are credited.
Entry.
Cash account, Dr. 2000. To interest account, 2000. Narration, being interest received.
Seeing that flow translated into strict code is incredibly satisfying once you understand the underlying physics of it.
It clicks into place.
Let's do one more set, incorporating a few slightly more complex scenarios to make sure our listeners are bulletproof. We will run through a modified version of the 5 million example from our sources, using a larger scale business.
Let's do it.
Scenario 1. A massive new enterprise starts with a massive capital injection of 5 million paid into the corporate bank account.
The scale is larger, but Pacioli's logic is identical. The bank asset increases, the owner's capital claim increases. Journal entry, bank account Dr. 5 million to capital account 5 million.
Scenario 2. The company pays wages and salaries totaling $50,000 through bank transfer.
Nominal expense increases, bank asset decreases. Wages and salaries account Dr. 50,000 to bank account 50,000.
Scenario 3. The company owns part of a commercial building and receives rent from a tenant of $200,000 deposited into the bank.
Bank asset increases, nominal income increases. Bank account Dr. 200,000 to rent received account 200,000.
Okay, scenario 4 is where we separate the novices from the masters. Listen closely. The company purchases bulk goods for resale inventory costing $900,000, but they buy it entirely on credit. No cash move today. What do we do when half the transaction seems to be missing?
This is a phenomenal test of the dual aspect. The transaction isn't missing half, it's just a different type of half. First, let's look at what we gained. The goods categorized as purchases represent a nominal expense for the business operations because they are the cost of goods sold. Expenses are increasing, so we debit the purchases account for $900,000.
Right.
Now, for the credit. We didn't pay cash, so we can't credit the bank. Instead, by buying on credit, we have actively created a new debt. We created a creditor, a personal account representing a supplier who we now legally owe money to. Our total liabilities are increasing. What is the rule for liabilities? Increases are credited.
So what's the resulting journal entry?
Purchases account Dr. 900,000 to creditor account 900,000. The mathematical balance holds, an expense increased on the left, a liability increased on the right.
That is so logically pure. The abstract legal liability simply takes the place of the physical cash leaving the business. Okay, final scenario number 5. The company sells a portion of those goods to a customer for $816,000, and the customer pays immediately via a bank check.
We received a check that clears into our account, so our bank asset is definitively increasing. Debit the bank account. How did we earn this? Through sales. Sales is a nominal revenue account. Revenue is increasing. Credit the sales account.
The entry.
Bank account Dr. 816,000 to sales account 816,000.
And there it is. We have just witnessed the complete, flawless translation of chaotic, real-world human business activities into the perfectly structured, highly analytical language of accounting. We took physical furniture, human labor, abstract legal debts, and interest payments and standardized them all into a mathematical proof.
It is incredibly satisfying when that system finally clicks in your mind and you stop seeing random rules and start seeing the underlying physics of value transfer.
Let's do a quick conceptual recap of our journey through this study room today. We didn't just memorize a textbook. We started in 1494 with Luca Pacioli's brilliant realization that value doesn't vanish. It just changes form, the unbreakable twofold aspect of every transaction.
Which led us to the realization that a business is a separate entity from its owner, resulting in the master scale. The accounting equation. Assets equal liabilities plus capital. Everything the business owns equals everything the business owes.
Then we zoomed in on the buckets holding that value, the T accounts. And we killed the myth that debit means bad and credit means good. Debit simply means the left side of the bucket. Credit simply means the right side.
We learned how to classify those buckets, whether using the traditional approach of personal versus impersonal accounts or the modern approach of 6 distinct categories. And we navigated the dangerous waters of exam traps, like the massive difference between rent, the temporary expense, and rent outstanding, the permanent liability.
And finally, we brought all that theory together into the rigorous formatting of the journal, the chronological diary of original entry, proving that no matter how complex the transaction, the debits must always equal the credits. If you're looking for a singular memory trick to take away from this entire deep dive, it is this. Visualize the accounting equation. Assets sit on the left side of the equal sign. So you debit on the left to increase them. Liabilities and capital sit on the right side of the equal sign, so you credit on the right to increase them. If you remember that mirror image, you can derive every other rule on the fly.
It is the ultimate intellectual anchor for the subject.
So as we pack up our notes and get ready to leave this hypothetical study room, I want to ask, what does all of this actually mean for you, the listener? Why have we spent an hour meticulously dissecting the mechanics of debits and credits?
Because I want to leave you with a thought that completely changed how I view this entire discipline. We just spent all this time talking about a manual system of ledgers and T accounts invented by a Renaissance friar with ink and paper. It sounds antiquated.
It does.
But think deeply about the logic structure we just learned. It is a strictly binary system. Every action has an equal and opposite reaction. It requires perfect balance. It categorizes complex data into rigid, standardized arrays. This system is so mathematically and logically perfect that when the computer age arrived, computer scientists didn't have to invent a new way to track global finance. Luca Pacioli's system essentially formed the foundational logic structure for modern computer programming.
So the code is just translating Pacioli's math.
Exactly. The invisible algorithms that run today's digital, automated, multi-trillion-dollar global financial systems, high-frequency trading bots, global banking networks, international supply chain software, they are all fundamentally executing the exact same binary balancing logic that Pacioli wrote down in 1494.
Wow.
When you learn this basic accounting process, you aren't just learning an old bookkeeping method to pass a test. You are learning the core architectural logic of the system that runs the modern world. Luca Pacioli wasn't just doing math. He was writing the first operating system for global commerce.
That is an absolutely incredible perspective. From a friar's wooden desk in the 15th century to the glowing server farms of Wall Street, the fundamental language of value remains exactly the same. And after today, you know how to speak it. Thank you so much for joining us in the study room for this deep dive. Take this conceptual clarity, leave the memorization anxiety behind, and go ace those exams and build those businesses. We will see you next time.
Imagine buying a brand new laptop. You check the price tag and it says, 100,000 rupees.
Right.
You hand over the cash, you take the laptop home, and you're thrilled. But what if I told you that a massive chunk of that price tag, like literally thousands of rupees, wasn't actually paying for the microchips or the screen or even the profit margin of the store?
Yeah, that's where it gets interesting.
Exactly. What if I told you that a huge piece of what you just paid was simply, a mathematical error by the government, like a hidden tax on a tax?
I mean, it sounds like a scam, honestly.
It really does.
But for decades, that wasn't a scam at all. That was just the legal reality for every single consumer in India before the goods and services tax revolution.
Exactly. You were paying tax on top of other taxes. And the worst part was, you couldn't even see it on the receipt. It was just totally baked into the cost.
Yeah, completely invisible.
Right. We are looking at a financial landscape that, for a really long time, was incredibly murky. Millions of transactions, taxes upon taxes, credits, debits. I mean, just a complete storm of data.
It is the absolute definition of muddy waters, especially if you don't know how to read the currents, But that is exactly what accounting is designed to fix. It's the diagnostic tool for an entire economy.
It makes the invisible completely visible.
Exactly.
Which brings us to our mission today. We are taking a massive stack of accounting fundamentals, specifically focusing on the journal, which is like the absolute bedrock of the accounting process.
Oh, without a doubt.
And then we are going to use that foundation to demystify a beast that terrifies, frankly, a lot of students, exam candidates, and business owners alike. I'm talking about the goods and services tax, or GST.
Yeah, we are treating this discussion today as a true masterclass.
Absolutely.
If you are listening right now, maybe you're prepping for a massive accounting board exam, or you're an entrepreneur trying to finally get these financial concepts to just, click. Or maybe you're just a deeply curious learner who wants to understand how the economic engine of the country actually runs. Well, this is for you. We are building an interactive classroom right here in your ears.
And I know firsthand that these concepts can feel really overwhelming. You stare at a textbook page full of T accounts, debit and credit rules, intrastate versus interstate supply, input reversals, and it just looks like an impenetrable wall of arbitrary rules you have to memorize.
Yeah, it feels like learning a dead language or something.
Exactly. But it's not arbitrary, is it?
No, not at all. Once you understand the underlying logic, like the actual why, you never have to blindly memorize the whatever again.
Right.
The rules of accounting, they were forged over centuries to solve very specific human problems. Problems of trust, memory, valuation, and, of course, taxation.
So let's start at the absolute beginning, the foundation of the entire house, the journal, the fundamental book of first or original entry. And this entire concept, it rests on the double entry system.
Yeah, the double entry system is, and I'm saying this without exaggeration, it's one of the greatest inventions in human history.
Oh, for sure. Right up there with the wheel.
Seriously.
Yeah.
Right up there with the wheel and the printing press. The core philosophy is that every single transaction has a dual aspect. It's basically Newton's third law applied to money.
Oh, I like that. For every financial action, there's an equal and opposite financial reaction.
Precisely. If something comes in, something must go out. If you receive a benefit, you must give a benefit. The journal is where that dual aspect is captured for the very first time. It's the front door of the entire accounting system.
All right, let's make this concrete because, abstract rules fly right out the window during an exam.
They really do. Panic sets in.
Yeah. Let's look at the anatomy of a real journal entry. Let's say it's April 28th, and our business is settling a debt with a supplier named Shyam.
Okay, classic scenario.
Here is how the entry reads in our source material. First line, Shyam's account is debited for 2,025,000 rupees. Second line, to bank account, which is credited for 2,015,000 rupees. Third line, to discount account, which is credited for 10,000 rupees.
Right.
So total debits equal 2,025,000. Total credits equal 2,025,000. The universe is balanced.
The math works.
But, if I'm looking at this for the first time as a student, I immediately have a massive doubt.
Lay it on me.
Why is the discount on the credit side here? I mean, a discount feels like a reduction, right? Like something is getting smaller. Why is it sitting there on the exact same side as the money leaving our bank?
That is the perfect question to ask, and it gets right to the heart of how you have to orient your brain for accounting. You have to look at the transaction strictly from the perspective of the business.
Right, not from the perspective of Shyam.
Exactly. Not Shyam, and not from your personal, everyday perspective either. Let's rewind the timeline a bit.
Yeah.
We owed Shyam 2,025,000 rupees. Right. That was a heavy liability sitting on our shoulders. He was our creditor. Now, on April 28th, we are settling that debt completely.
Okay.
I thought, how are we settling it? We are handing over 2,015,000 rupees from our bank account. The bank balance is an asset. It is decreasing. And the golden rule for assets is that when they decrease or when value goes out, we credit them.
Okay, so crediting the bank account for 2,015,000 is totally logical. Money leaving the bank equals a credit. That part is intuitive.
But our debt to Shyam was 2,025,000. We only paid 2,015,000. Why is he crossing our name off his list?
Because he gave us a discount.
Because he allowed us a discount of 10,000 rupees. Maybe we paid early. Maybe we're just a really loyal customer.
Makes sense.
Now, from our business's perspective, what does that 10,000 rupees represent? Not having to pay money that we legitimately owed? And that's a massive benefit. It increases our overall wealth. It's a gain. It's an income.
Oh.
And in the double entry system, all incomes and gains are credited.
I see. So it's a gain because we kept money we fully expected to lose. It's basically exactly like finding a 10,000 rupee note in the pocket of your old winter coat.
That's a great way to put it.
But instead of physically finding it, you just didn't have to hand it over to Shyam. The net effect on your wealth is exactly the same.
Precisely. Your net worth increased by 10,000
Yeah.
compared to what it would have been if you paid the full debt. And this is why the entry balances with such, mathematical elegance.
Right.
Shyam, the person, receives the full value of the settlement, which is 2,025,000. We debit the receiver. We give out 2,015,000 in hard cash, so we credit what goes out. And we recognize a structural gain of 10,000, so we credit the income. Debits perfectly match credits.
Now, right below those numbers in a proper journal, there's always this little sentence in parentheses. For this entry, it would say something like, being cash paid to Shyam and discount allowed by him in full settlement. This is the narration.
Ah, yes, the narration.
And I'll be honest, when I was first studying this, narrations felt like annoying, pointless extra homework.
Oh, everybody hates them at first.
Right. The numbers are already there. The accounts are named. Why on earth do I have to write an English sentence explaining it? It just feels redundant.
Almost every student feels that way. They're rushing against the clock in an exam. They get the numbers to finally balance, and they just want to move on. They skip the narration to save like 30 seconds.
Exactly.
But in the real world, skipping the narration is a catastrophic error. The narration provides the precise explanation of the transaction for the proper understanding of the entry. Without it, you only have half the picture.
I like to think of the narration as a time capsule.
Oh, I like that.
Imagine you are an external auditor or maybe just a newly hired accountant taking over this company's books like 3 years down the line. You open the journal and you see a debit to Shyam and a credit to bank and discount.
And you're just staring at it.
Right. Who is Shyam? Is he a vendor who supplies raw materials? Is he a former employee we're settling a lawsuit with? Is it a loan repayment?
You have no idea.
Without the narration, you have to play financial detective. You have to dig up old emails and invoices. But with the narration, the accountant from the past is literally reaching through time and telling you exactly what happened that day in plain, unambiguous language.
That is a wonderful analogy.
Yeah.
The numbers tell you the mechanical movement of value. They tell you the physics of the transaction, right? But the narration tells you the story. It gives you the intent. And in the complex real world of business, context is absolutely everything.
So if we formalize this, there are 3 primary, heavily tested advantages of maintaining a proper journal. Let's lock these in for the listeners.
Let's do it.
Number 1, as transactions are recorded in chronological order, one can get complete information about the business transactions on a timely basis.
This is all about the timeline. The journal is your daily financial diary.
Right.
You don't write your personal diary alphabetically by what you did, right? You write it by the date and time. April 28th, 10:00 a.m., we paid Shyam. April 30th, 2:00 p.m., we made a massive cash sale. April 30th, 5:00 p.m., we paid the monthly electricity bill.
It's just a raw feed.
Exactly. It's the unedited, raw, chronological history of the company's life. If the CEO runs in and asks, "Hey, what exactly happened on the afternoon of March 14th?" You don't go digging through individual account files. You open the journal to March 14th.
Right. Advantage number 2 we just thoroughly covered, which is the narrations providing that vital, precise story.
Yep, the time capsules.
Which brings us to advantage number 3, and this is crucial for preventing complete chaos. Journal forms the basis for posting the entries in the ledger and reduces the chances of error.
Yeah, to understand this, you really have to understand the difference between the journal and the ledger.
Okay, lay it out for us.
If the journal is the daily diary where you dump everything chronologically as it happens, the ledger is the filing cabinet.
The filing cabinet, okay.
In the ledger, you take all those chronological entries and you organize them by character, by category. You sift through the diary, pull out every single bank transaction from the entire year, and put them in the specific bank account file. You take all the sales and put them in the sales file.
So, sticking with the diary analogy, it's like my personal journal says. Monday, went to the movies with Sarah. Tuesday, bought groceries. Friday, had lunch with Sarah. The journal just lists them by day.
Exactly.
But if I had a ledger, I would have a specific page dedicated entirely to Sarah, showing every single interaction I've had with her all year, completely ignoring the groceries.
That's spot on. The ledger gives you the summarized status of a specific account at a glance. But here's the catch. You cannot create that Sarah page accurately without the daily diary to draw from.
Oh, because you'd miss things.
Right. Imagine if a business didn't have a journal. Imagine if they just tried to write transactions directly into the thousands of ledger files as they happen in real time.
That sounds like a nightmare.
It is. You pay Shyam, so you run to the S cabinet, pull out Shyam's file, write down $2,025,000. Then the phone rings, you get distracted, and you completely forget to go to the boop cabinet to record the money leaving the bank.
Oh, wow. You've just broken the universe. The double entry is completely severed.
Exactly. And at the end of the year, nothing will balance, and you will spend literally weeks trying to find the error. The journal forces you to balance the equation debits, equal credits, right there on the spot, on a single piece of paper, before you ever move the numbers into their permanent ledger files.
It acts as a primary, non-negotiable filter for human error.
Absolutely.
Okay, so the foundation is solid. The journal is our chronological diary, complete with stories, acting as our error checker. But to actually write in this diary to know what to debit and what to credit, you have to know the rules of the game.
The golden rules.
Yes, and that means mastering account types. I want to really stress test this because if you misclassify an account, everything downstream is just ruined.
100%. If you get this wrong, you fail the exam.
So we have 3 main buckets: nominal, real, and personal accounts. Let's start with nominal accounts. These relate to expenses, losses, incomes, and gains. Examples are rent paid, salaries, purchases, wages, electricity depreciation.
Lots of everyday running costs.
Right. And the ultimate rule is that the net result of all these nominal accounts gets flushed into the profit and loss account at the end of the year. But why? Why do they disappear?
Because nominal accounts are strictly temporary. The word nominal literally means in name only. They exist purely for the duration of the 12-month financial year to track your performance, your velocity.
Going is velocity.
Yeah, think about the engine of a car. When you pay your employees a salary, or when you pay the power bill to keep the factory lights on, you are paying for fuel, that effort, that electricity. It's consumed immediately.
Right. You can't get it back.
Yeah, exactly. You can't store employee effort from last month in a warehouse. You can't sell last month's electricity to a customer today. It is an expense that has vanished into the operations of the business to generate revenue.
So if nominal accounts are tracking the fuel burned and the distance traveled, it's exactly like the trip odometer on your dashboard. You use it to measure the miles for one specific road trip, and when you get home, what do? You hit the reset button, you push it back to 0 so you are ready to measure the next trip.
That is brilliant. At the end of the financial year, you match all the fuel burned your expenses against all the ground coverage your incomes in the profit and loss account. That calculation tells you if the trip was profitable.
And then,
once that single profit or loss number is calculated, all those individual nominal accounts, the rent, the salaries, the sales, they are wiped entirely clean. They are reset to 0. You do not carry last year's rent expense into this year's books. Day 1 of the new year is a blank slate for performance.
Okay, the rule for the trip odometer, the nominal accounts is debit all expenses and losses, credit all incomes and gains.
Nailed it.
Now, contrast that temporary nature with real accounts. A real account relates to properties and assets, land, buildings, heavy machinery, patents, cash in the bank, investments.
If nominal accounts are the fuel you burned in the trip odometer, real accounts are the car itself. They are the tangible and sometimes intangible things of actual enduring value that the business owns. They are permanent, or at least they outlast a single financial year.
So you do carry them over?
Yes, you don't hit reset on these. The cash you have in the bank vault at 11:59 p.m. on December 31st does not magically vanish at midnight on January 1st. It carries forward into the new year. The machinery is still sitting on the factory floor.
They represent the permanent reality of the business. And the rule here, debit what comes in, credit what goes out.
Simple and physical.
Which brings us to the third bucket, personal accounts. These relate to individuals, firms, companies, or institutions, debtors, customers who owe us creditors, suppliers we owe banks, and importantly, the capital account.
Yes, capital's a big one.
Here is where we need to look at some classic traps that catch students off guard. I'm going to throw a few rapid-fire doubts at you, the kinds of things that show up as tricky, true-false questions.
Bring them on.
Doubt number 1. A student looks at a balance sheet and says, well, the capital account represents all the money and assets the owner invested into the business. Money is an asset. Assets have debit balances. Therefore, the capital account must have a debit balance. Why is that logic dangerously wrong?
It is wrong because it violates the most sacred principle in accounting, the separate entity concept.
The separate entity concept.
Yes. You have to imagine drawing a thick, impenetrable line between the human being who owns the business and the business itself.
Okay.
In the eyes of accounting, the business is an artificial person. It is a standalone robot. The owner is treated as a completely separate outside party.
So the creator of the business is treated like a stranger.
Yes, essentially like a specialized bank. When the owner puts 1 million rupees into the business to start it, what happens? The business robot receives an asset cash.
Right.
Cash is a real account. It comes in, so the business debits, cash for 1 million. But where did that cash come from? It came from the owner.
Oh, I see.
The business robot now owes that 1 million rupees back to the owner. The capital account is the specific ledger that tracks this internal debt. It is a liability of the business towards the owner.
Because the robot has to pay the inventor back eventually.
Exactly. And what is the golden rule for personal accounts and liabilities? Credit the giver, and credit increases in liabilities. Therefore, the capital account always has a credit balance. It is the business permanently declaring, I owe my creator this much value.
That mind shift is everything. The business is the robot, and capital is its debt to the inventor.
That's the secret to passing the exam right there.
All right, doubt number 2. Let's test the timeline of a transaction. A question asks, if an entity sells goods to a debtor on credit, that debtor is considered a receiver. True or false?
Oh, that's a classic trick question. You have to break the timeline into 2 distinct events.
Event 1.
Event 1 is the day of the sale. You hand over the goods, and they promise to pay later. At that exact moment, The debtor is receiving value from you without giving anything back yet. They are the receiver. According to the rule for personal accounts, debit the receiver, you debit their account.
Well, what about event 2, like 30 days later?
Exactly. 30 days later, the debtor writes you a check to settle the account. In that subsequent transaction, what is the debtor doing?
They're giving you money.
Right. They're giving you cash. In event 2, the debtor is the giver. You debit your bank account because cash comes in, and you credit the debtor's account because you credit the giver.
So if an exam question tries to lock a debtor into always being a receiver, it's a total trap.
A massive trap. You have to ask, which part of the life cycle are we in? The creation of the debt or the settlement of the debt?
Brilliant. Okay, doubt number 3. A student is drafting a balance sheet, and they are trying to figure out what goes on it. They assume the asset side of the balance sheet must contain all the nominal accounts, because nominal accounts have debit balances and assets are debits.
Utterly false. And if we connect this back to the odometer analogy, it becomes obvious why. Where do nominal accounts go?
Well, they're temporary. They get flushed into the profit and loss account at the end of the year to figure out the profit, and then they are reset to 0.
Correct. They are dead and buried in the P&L by the time the financial year ends. The balance sheet is a completely different document.
It's not a trip odometer.
No, it is not a measurement of a trip. It is a high-resolution photograph. It's a snapshot of the permanent reality of the business at exactly midnight on the last day of the year. What do you own and who do you owe at this exact second?
I love that. A high-resolution photograph.
Therefore, the balance sheet strictly holds real accounts, the tangible assets you own, like machinery, inventory, and cash, and fiscal. Personal accounts, the people you owe, like bank loans, creditors, and the owner's capital, plus the people who owe you, like debtors.
So nominal accounts never, ever touch the balance sheet.
Never.
To help everyone lock this 3-bucket framework into their brains forever, let's use a memory trick. I love mental filing systems for exams.
Oh, mnemonics are lifesavers.
Think of it like this. Nominal equals now. It's happening right now. It's the fuel burning today. It's temporary for this year only. It measures current performance. Nominal is now.
I like it.
Real equals reality. It's the tangible, hard reality you get to keep. The assets you hold in your hands that outlast the year. Real is reality.
Spot on.
And personal equals people, the individuals, companies, and entities you are interacting with, owing, or collecting from. Nominal is now. Real is reality. Personal is people.
That is an incredibly robust mnemonic. If you encounter any random account name, say prepaid insurance or wages outstanding, and you can instantly categorize it into one of those 3 buckets, applying the golden rules of debit and credit becomes completely automatic. You don't have to guess.
All right, we have laid a massive, solid foundation. We know how to write in the chronological diary of the journal, and we know the rules of the now reality and people accounts. We can confidently record a business buying raw materials, paying rent, and selling finished products.
The mechanics are sound.
But here's where the real world crashes into the textbook. Here is where it gets incredibly complicated and honestly incredibly interesting. When you buy or sell something in the actual economy, you aren't just dealing with the price of the goods and the supplier. You are dealing with a silent, invisible third partner in every single transaction.
The government, yeah.
The government. You are dealing with taxes.
Yes. The moment value changes hands, the sovereign state steps in to claim its share to fund the country.
We need to figure out how to record these taxes in our journal. But before we look at the modern, elegant solution of the Goods and Services Tax, GST, we have to understand why it was invented in the first place. We have to walk through the dark ages, the pre-GST tax nightmare.
I always tell my students, you cannot truly appreciate the cure if you have never suffered from the disease.
Wow, that's dark but true.
And the disease was the way India and many other countries historically handled indirect taxes. It was just an economic strangulation.
Let's define the core term first. What is an indirect tax? The technical definition is a tax whose incidence is borne by the consumers who ultimately consume the product or service, even though the immediate liability to pay the tax falls upon another person, like the manufacturer.
The easiest way to visualize an indirect tax is a game of hot potato.
Hot potato.
Yeah. The government needs tax revenue from the consumption of a luxury good, let's say a high-end television. But logistically, the government cannot track down every single citizen who buys a TV and send them a tax bill in the mail. It's impossible.
Right, that would be an administrative nightmare.
So they change the collection point. They go to the factory making the TVs and say, you owe us the tax.
Yeah.
The factory pays the government. But the factory isn't going to absorb that loss, are they?
Definitely not. They'd go out of business.
Exactly. They take that tax amount, bake it into the price of the TV, and pass the hot potato to the wholesaler. The wholesaler passes it to the retailer. The retailer passes it to you, the final consumer.
So the hot potato ends up in my lap.
Yes. You bear the ultimate financial burden of the tax, even though you never directly wrote a check to the tax department. The burden is shifted. That's why it's indirect.
That makes perfect logical sense. A single collection point passed down the chain. But the problem wasn't the concept of indirect tax, was it? The problem was how fragmented and chaotic it became.
Oh, it was beyond chaotic.
Let's look at the pre-GST landscape. It wasn't one hot potato. It was dozens of different potatoes being thrown by different governments all at once.
It was a barrage of potatoes.
Right. If you manufactured goods, the central government in Delhi hit you with an excise duty. But then, if you sold those goods to a shop within your own state, the state government stepped in and hit you with a state value-added tax, or VAT.
And it didn't stop there.
No. If you sold goods across state lines, say from Gujarat to Maharashtra, the central government reappeared and levied a central sales tax. And if you didn't sell goods at all, but provided a service like consulting or accounting, the central government levied a service tax. It sounds like a bureaucratic nightmare.
It was far worse than a nightmare. It was actively destructive to economic growth. Because these different taxes were levied by different authorities, the center versus dozens of individual states, they did not communicate with each other.
They were just completely disconnected.
Totally walled off silos. If you paid excise duty to the center, the state government didn't care. They wouldn't let you use that payment to reduce your VAT liability. You couldn't take the benefit of credit for taxes paid at one stage against the taxes owed at the next stage.
This brings us to the most critical concept to understand the pre-2017 economy, the cascading effect. The text gives a mathematical breakdown, and I want to walk through it step by step, painfully slowly, because this is the absolute why behind everything we do in modern accounting.
This is the crux of the whole episode right here.
Let's trace a fictional product, let's say a batch of custom furniture, through the pre-GST supply chain.
Okay. Custom furniture.
Step 1. A manufacturer produces the furniture. The base cost of materials and labor is exactly 100,000 rupees. Because they manufactured a physical good, the central government slaps an excise duty on it. Let's assume the rate is 18%.
Pretty standard rate.
So 18% of 100,000 is 18,000 rupees. The manufacturer must remit 18,000 to the sender. To recover this, the total price the manufacturer charges the next guy in line is 118,000 rupees.
Okay, now let's introduce step 2. A local trader, a wholesaler, comes along and buys this furniture from the manufacturer. The trader writes a check for 118,000 rupees.
Right.
Let's pause and look deeply at the trader's financial reality. He just paid 118,000 rupees. 18,000 of that was an excise tax. In a rational world, he would say, I'll hold on to the receipt for that 18,000 tax and use it to reduce my own tax burden later.
That would make sense.
But in the pre-GST world, he cannot, because excise duty is a central tax on manufacturing, and he's a trader who's about to deal with state-level VAT on sales. The state government looks at him and says, we don't recognize central excise. That's your problem.
Wow, so the trader is stuck. He can't get that 18,000 back from the government, and he can't offset it. It's just dead money.
Dead money.
What is his only option? He has to treat that 18,000 tax as part of his actual cost of acquiring the goods. His base cost for the furniture isn't the true 100,000 anymore. It is artificially inflated to 118,000.
Exactly. The taxes become permanently embedded, crystallized into the cost of the product.
Now for step 3. The trader is not a charity. He is running a business to make money. He wants to add his profit margin. Let's say he wants to make a flat 20,000 rupee profit on this batch of furniture.
Okay.
So he takes his embedded cost of 118,000, adds his 20,000 profit, and sets his selling price at 138,000 rupees.
Right.
Step 4. The trader now sells the furniture to a final consumer, maybe a local office. Because this is a sale within the state government steps in and says, we need our VAT. Let's assume the state VAT rate is also 18%.
Here comes the tragedy.
Here's the mathematical tragedy. The trader has to calculate 18% VAT on his selling price. What is his selling price? 138,000.
And if you unpack that 138,000, what is inside it?
This is the exact moment my brain exploded when I really understood it. Inside that 138,000 base is the original 100,000 cost, the 20,000 profit. And the 18,000 excise duty.
Yes.
So when the state government demands 18% on the 138,000, you are calculating 18% tax on top of the 18,000 tax that was already paid. You are literally paying a tax on a tax.
This is the infamous cascading effect. Like
Yeah.
water cascading down a mountain, gathering mass and speed, the tax snowballs down the supply chain.
It just compounds.
At every single stage, the embedded taxes from the previous stages get taxed again, artificially inflating the price at a compounding rate. And who pays the ultimate price for this systemic inefficiency?
The final consumer. You, me, the office, buying the furniture.
We suffer an unjust enrichment at the cost of the ultimate consumer simply because the government's separate tax buckets stubbornly refuse to talk to each other.
It's like buying a product online, paying a shipping fee, and then the delivery driver shows up and charges you a percentage fee based on the total of the product plus the original shipping fee.
That is a very painful, very accurate analogy.
It's maddening. It suppresses demand, makes exports uncompetitive, and encourages rampant tax evasion because the margins are so tight. So the country realized this was unsustainable. We needed a revolution.
We desperately did.
Enter the goods and services tax, implemented to dismantle this exact nightmare. GST is a comprehensive, single tax levied on the supply of goods and services right from the manufacturer down to the consumer. It forcefully subsumed almost all those fragmented taxes, excise, VAT, service tax, luxury taxes, into one unified national system.
But the genius of GST isn't merely that it consolidated 10 taxes into one.
Yeah.
You could still have a cascading effect with a single tax if you aren't careful.
Wait, really?
Oh yeah, if you don't allow offsets, one tax can still cascade. The true architectural genius of GST is the mechanism of the input tax credit. Under GST, the tax levied at all stages of the supply chain is part of the exact same continuous system, which means you can seamlessly take credit for taxes paid at previous stages. It builds a dam to stop the cascade.
Let's break down the two most important terms in modern accounting: input tax versus output tax. Because getting this conceptually right dictates every single thing we do in the journal later on. Let's start with input tax. What exactly is it?
Input tax is a GST paid by the recipient on the procurement of goods or services. It is the tax you pay on your inputs, the raw materials, the machinery, the rent, the consulting fees you buy to run your business.
Okay, that's straightforward.
But here is the massive paradigm-shifting difference from the pre-GST era. Under GST, the input tax you pay is considered an asset of your business. It is an input credit.
Wait, I need to push back on that. To an average person, taxes are the ultimate expense. Money leaves your pocket and goes into a black hole. Why on earth is a tax I just paid considered an asset?
Because it doesn't go into a black hole anymore. The government is essentially handing you a digital voucher.
A voucher?
Yeah. They say, we know you just paid 18,000 rupees in tax to your supplier for those raw materials. We have a record of it. Keep this voucher in your digital wallet. Later this month, when you sell your finished goods and you collect tax from your customers that you owe to us, you don't have to give us all the cash. You can hand us this 18,000 rupee voucher to reduce your final bill.
Oh, wow.
Think about a definition of an asset. Something of value owned by the business that provides a future economic benefit. That voucher, that legal right to set off your future liabilities, is a very real, quantifiable economic benefit. Therefore, input tax is recorded on your books as an asset.
That completely flips the script. The tax is segregated from the cost.
Completely segregated.
And on the flip side of the coin, we have output tax. This is defined as the GST charged on the supply of goods or services made by a supplier.
When you finally sell your furniture to a consumer, you add GST to the invoice. You collect that tax money from them. But that money is not your revenue. You did not earn it.
Right.
You were simply acting as a temporary, unpaid collection agent for the government. You were holding their money. You owe that money to the state treasury. Therefore, output tax is fundamentally a liability.
Okay, let's prove the magic of this system. Let's revisit our exact same 100,000 rupee furniture math example, but we're going to run it through the shiny, modern, post-GST system.
Let's do the math.
Step 1. The manufacturer makes the furniture for 100,000. He charges 18% GST. The total invoice is 118,000. Step 2. Our trader buys it and pays the 118,000. But now, under GST, what happens to that 18,000?
It does not become an embedded cost. The trader recognizes the 100,000 as his cost of goods, a nominal account, and he recognizes the 18,000 as input tax credit. That is a real account, an asset.
Yeah.
He puts the 18,000 voucher in his pocket.
This is massive. His base cost stays perfectly flat at a clean 100,000.
Perfectly flat.
Step 3. The trader wants to add his 20,000 rupee profit margin. So he takes his clean 100,000 costs, adds 20,000, and his selling price before tax is exactly 120,000. Notice how much lower that is than the 138,000 from the Dark Ages.
It's a huge difference for the consumer.
Step 4. The trader sells to the final consumer. He is legally required to charge 18% output GST on the 120,000 sale price. 18% of 120,000 is 21,600 rupees. So the trader collects 120,000 for himself plus 21,600 in tax from the consumer.
Right.
This 21,600 is his output tax liability. He owes the government 21,600. But wait, before he writes a check to the government for 21,600, he reaches into his pocket and pulls out his input tax credit voucher for 18,000.
Exactly. He logs into the GST portal and tells the government, my output liability is 21,600, but I already injected 18,000 of tax into this exact supply chain when I bought the goods. I am exercising my right to set off the liability.
So he just subtracts it.
Yep. He takes the 21,600 debt, subtracts the 18,000 voucher, and the final cash payment he has to deposit with the government is a mere 3,600 rupees.
The cascade is broken. But I want listeners to look incredibly closely at that final number, 3,600 rupees. What was the trader's value addition? His personal profit margin was 20,000. If you take a calculator right now and calculate 18% of 20,000, it is exactly 3,600 rupees.
This is the mathematical elegance of GST. By allowing the input tax to be availed as a credit, the system ensures that at every stage, only the pure value addition, the profit margin, or the processing cost added by that specific business is subjected to tax.
That's incredible.
The original 100,000 was taxed once at the factory. The 20,000 was taxed once at the trader. Double taxation is mathematically impossible in a perfect GST chain.
I want to address a very common lingering student doubt here. When people look at a business paying 18,000 in input tax out of pocket to their supplier and then having to pay another 3,600 in cash to the government later, they think, wow, taxes are bleeding this business dry. It's eating into their 20,000 profit. Does the business actually lose money on these taxes?
Absolutely not. And clearing up this misconception is vital. Let's analyze the trader's actual cash flow.
Okay, break it down.
Cash out. He paid 18,000 in tax to a supplier. Later, he paid 3,600 in tax to the government. Total cash out of his bank for taxes, 21,600. Cash in. When he sold the furniture, he collected exactly 21,600 in tax directly from the consumer. Total tax cash in, 21,600. Total tax cash out, 21,600.
So it's a wash.
The net financial impact on the trader's pocket is exactly zero. His 20,000 profit remains completely untouched. The entire burden of that 21,600 rupees rests solely and heavily on the shoulders of the final consumer. The business is nothing more than a transparent conduit, a pipe passing the tax along the chain until it hits the end user, with the government siphoning off pieces of it at each stage of value addition.
It is a brilliantly designed machine. Let's codify this by running through the formal salient features of GST. If you are taking an exam, this is your high-yield checklist.
Your pen's ready.
First feature, GST is levied on supply. This seems like a simple word, but it replaced a lot of chaos, right?
Immense chaos. Previously, armies of lawyers spent decades arguing in court over what constituted manufacture to trigger excise duty, or what exactly defined a sale to trigger VAT. Was assembling a computer from parts manufacturing? What if you bundled software with it?
Sounds like a lot of billable hours.
Oh, it was a gold mine for lawyers. GST swept all that away. The new universal taxable event is simply supply. Did you supply goods or services for a consideration? If yes, it is a taxable event. The lawyers had to find something else to argue about.
Second feature, tax is levied only on the value added at each stage of the supply chain. We just proved that definitively with our 3,600 rupee math example.
Check.
Third feature, GST is a destination-based consumption tax. We are going to dedicate an entire section to the geography of this in a moment, but essentially, the tax revenue flows to the state where the goods are consumed, not where they were created.
Exactly.
Fourth feature, there is no tax on tax or cascading of taxes. Again, the input tax credit voucher system destroys the cascade. And fifth, harmonization of laws, procedures, and rates of tax across the country. One nation, one tax.
The economic impact of this harmonization cannot be overstated.
Really? How big of a deal was it?
Imagine running a logistics company before 2017. A truck driving from Delhi to Chennai would have to stop at every single state border for hours, sometimes days, while inspectors manually checked paper waybills to ensure state taxes were paid. You had to hire tax consultants who specialized in the localized VAT laws of 29 different states. It crippled efficiency. Harmonization created a unified national market.
Okay, let's zoom in on that third point. the destination-based consumption tax. This brings us to the geography of supply. We've talked about the government as a single entity, but India is a federal republic.
Very much so.
The central government in New Delhi needs money for defense and national highways. The state governments need money for local police, hospitals, and state schools. They are both desperately hungry for tax revenue, and under GST, they're both levying tax on the exact same transactions. How do we avoid a civil war over who gets the money?
By establishing rigid geographical rules. The entire GST framework rests on identifying two coordinates on a map: the location of the supplier and the place of supply, which usually means where the goods or services are finally consumed.
Okay, two coordinates.
Based on these two coordinates, we classify every transaction into one of two scenarios: intrastate or interstate.
Let's break down scenario 1, intrastate supply. Intra meaning within. This occurs when the supplier and the place of supply are located within the exact same state or the exact same union territory. For example, I manufacture office desks in Pune, Maharashtra, and I sell those desks to a corporate client located in Mumbai, Maharashtra.
Since the goods never cross a state border, it is a purely local affair. But both governments still need their cut. So the tax pie is sliced perfectly down the middle, a 50-50 split between the center and that specific state.
Okay.
On your invoice, you will levy two distinct taxes simultaneously: CGST, which stands for Central Goods and Services Tax, and SGST, which stands for State Goods and Services Tax. If the item falls under an 18% GST bracket, you do not charge 18% one chunk. You charge 9% CGST, which goes straight to the central government treasury, and 9% SGST, which goes directly to the government of Maharashtra.
Got it. What happens if I'm operating out of a union territory, say Chandigarh or Lakshadweep?
The fundamental concept remains exactly the same. We just use a slightly different acronym for legal precision. If the union territory has its own legislature, like Delhi or Puducherry, it acts mostly like a state, so we still call it SGST.
Makes sense.
If it is a UT without a legislature like Ladakh, Lakshadweep, or Chandigarh, it is administered directly by the center, so the state half is called UTGST, Union Territory Goods and Services Tax. But functionally, mechanically, it behaves exactly like SGST. The local administration gets its 50%.
Okay, so intrastate is local, and it triggers the CGST plus SGST twin engines. Now for scenario 2, where things get geographically complex, interstate supply. Inter meaning between. This occurs when the supplier and the place of supply are in two different states or two different UTs, or a state and a UT.
The border crossing.
Exactly. Let's say I manufacture those same desks in Pune, Maharashtra, but this time my client is a massive tech park in Bangalore, Karnataka. The goods are crossing a border.
This is where the core philosophy of a destination-based consumption tax is put to the test. Under the old broken system, Maharashtra would have collected a central sales tax because the goods originated there. The manufacturing state won.
Oh, interesting.
But GST flips this entirely. The philosophy is, the people of Karnataka are the ones buying and consuming the desks. They are bearing the ultimate burden of the tax. Therefore, the government of Karnataka should receive the tax revenue to build infrastructure for those citizens. The destination state wins.
That makes philosophical sense. But logistically, how on earth does that work? Does the business owner in Maharashtra have to register for taxes in Karnataka and send them a check? If a business sells all over India, they'd have to file returns in 29 states. We'd be back to the old nightmare.
Exactly, which is why they created a brilliant clearinghouse mechanism. When a transaction crosses a state border, you do not charge CGST and SGST. Instead, you levy one single combined tax, IGST, which stands for Integrated Goods and Services Tax.
So just one line item.
Yes. The mathematical equation is simple. IGST equals the sum total of CGST plus SGST. So if the rate is 18%, you just charge one single line item of 18% IGST on your invoice.
Who collects this IGST? Does it go straight to Karnataka?
Initially, no. The central government acts as the sole collector for all IGST across the country.
Right.
You remit the full 18% to New Delhi.
Okay, so the center holds the bag.
Then, behind the scenes, deep in the government's IT infrastructure, the magic happens. The center takes the 18% IGST pie. It keeps its 9% central share. Then it looks at the invoice, sees the destination was Bangalore, and it automatically transfers the remaining 9% directly into the treasury of the Karnataka state government.
That is seamless.
Totally invisible.
Yeah.
The business owner in Maharashtra never have to interact with the Karnataka government. They just pay the IGST to the center, and the center handles the distribution. It is a seamless, invisible transfer of wealth to the consuming state.
So IGST is basically an armored vehicle that transports the combined tax safely across state borders, and the central government acts as the trusted distributor.
Great analogy.
This is vital context because it sets up the architecture for the most complex, most heavily tested, and frankly, most dangerous area for students making journal entries. The waterfall. The rules for utilizing input tax credit.
Yes, the set-off rules. We've established that input GST is an asset, a voucher in your digital wallet. And we know you use those vouchers to pay off your output GST liabilities.
Right.
But you cannot just blindly throw a handful of mixed vouchers at your debts. The government has instituted very strict, non-negotiable rules on exactly which vouchers can be used to pay off which specific debts, and in what order. It operates like a waterfall, cascading from one level to the next.
Let's build this waterfall. Picture 3 distinct buckets of input credit, our assets, our vouchers. We have the IGST credit bucket, the CGST credit bucket, and the SGST credit bucket.
3 buckets.
And across from them, we have 3 buckets of output liability, the debts we owe the government. IGST liability, CGST liability, and SGST liability. Let's start at the top of the waterfall with the IGST credit bucket. We have imported goods or bought goods from another state, so we have a surplus of IGST vouchers. What are the rules for spending them?
Think of IGST credit as the master key, the most flexible and powerful voucher you possess. The absolute first rule, you must utilize your IGST credit to completely pay off any IGST liability you have, like pays for like.
IGST pays IGST. Makes sense.
If and only if you have completely zeroed out your IGST debt and you still have IGST vouchers left over in the bucket, the system opens up. The text explicitly states that the balance can be utilized against CGST or an SGST in any order and in any proportion.
So IGST is like the wealthy parent. It pays its own debts first. And if it has money left over, it looks at its 2 children, CGST and SGST, and says, I will happily pay off either of your debts however you want to split it. It is fully integrated.
Precisely. It flows everywhere. Now, let's step down to the second bucket, the CGST credit. You bought goods locally, so you have central tax vouchers. The first rule remains consistent, like pays for like. You must utilize CGST credit against your CGST liability first. Central credit pays central debt.
Straightforward.
If you still have a balance of CGST vouchers available after paying off the center, the rule allows you to utilize it against IGST liability.
Again, that makes logical sense. The center is taking its leftover credits and shipping in to pay the integrated national pool.
But here is the critical limitation, the immovable wall built into the law. However, CGST credit cannot be utilized against SGST. Under no circumstances can you use a central voucher to pay a state debt.
Wow, okay, and I assume the exact same logic applies in reverse for the final bucket, the SGST credit.
You'd be right. SGST credit has to be first utilized against SGST liability. State pays state. If a balance is available, the state will chip into the integrated pool, so it can be utilized against IGST liability.
But the unbreakable rule is...
However, SGST credit cannot be utilized against CGST.
I want everyone listening to pause and visualize this wall, because I know this is where 90% of exam mistakes are made. Students try to offset across the aisle. Why does this wall exist?
Think about the actual treasuries. CGST is money belonging to the central government in New Delhi. SGST is money belonging to a specific state government, say Tamil Nadu.
Okay, different bank accounts.
Entirely separate sovereign entities with separate bank accounts. The government of Tamil Nadu is absolutely not going to allow a business to use a state-level tax credit to pay off a debt owed to the Prime Minister in New Delhi. And New Delhi is certainly not going to let you use central credits to fulfill your obligations to Tamil Nadu. The treasuries do not mix.
I use an analogy for this that always works for me. Think of the center CGST and the state SGST as 2 incredibly stubborn siblings living in the same house. They each have their own personal piggy banks.
I like where this is going.
They are perfectly willing to use their own piggy banks to pay their own personal debts. And because they are family, they are perfectly willing to take leftover money from their piggy banks and put it into the family's shared holiday fund. That's the IGST bucket.
The integrated pool.
Right. But they will never, ever, under any circumstances, directly hand money from their personal piggy bank to the other sibling to pay off the other sibling's debts. They just stubbornly refuse to cross that line.
That is a flawless way to remember it. The stubborn siblings never share. CGST and SGST never cross. They only ever interface by funneling upwards into the parent pool, the IGST.
It's such a common trap.
If you were doing a complex journal entry problem and you find yourself debiting an SGST liability and crediting a CGST asset to offset it, alarm bells should be ringing in your head. You have triggered an illegal setoff.
All right. We have covered the deep theory. We know the chronological diary of the journal. We know the account types now, reality people. We survived the dark ages of cascading taxes. We understand that input is a voucher asset and output is a liability. We mapped the intra and interstate geography, and we built the strict sibling rules of the waterfall.
We've covered a lot of ground.
We really have. Now it is time for the grand finale, putting it all together into the journal. How do we take this massive architecture of GST logic and translate it into the simple, elegant, double-entry language of debits and credits?
The foundational rules for recording GST are actually quite simple if you hold on to the core concepts we've established about assets and liabilities. Scenario 1. You are making a purchase. You buy goods, raw materials, or receive services. In this process, you are paying input GST to your supplier. What did we determine input GST is?
It's a voucher. It's an asset.
Exactly.
Yeah.
And what is the fundamental accounting rule for an increase in an asset?
Real account rule, debit what comes in. Or the modern equation rule, debit increases in assets.
Therefore, the golden rule for entries is, at the time of purchases of goods or services, input GST account, whether it's CGST and SGST or IGST, is debited. You are bringing the voucher into your book.
Okay, bringing it in.
Scenario 2. You are making a sale. You sell goods or supply services to a customer. In this process, you are collecting output GST from them. What did we determine output GST is?
We didn't earn it. We are just holding it for the government. It's a liability.
And the rule for an increase in a liability.
Credit increases in liabilities, personal account rule, credit the giver of the benefit, which is the government allowing you to operate.
Therefore, at the time of sale of goods or supply of services, output GST account, again, CGST, SGST, or IGST is credited. You are recording your debt to the state.
Let's see this in action with a concrete numerical example to prove it works. Let's say our business is purchasing a heavy piece of machinery from a supplier named Symphony Industries. The base price of the machine is 100,000 rupees. We are paying immediately via a bank transfer.
Okay, a big purchase.
We are both in the same state, so it's an interstate transaction. The tax rates are 9% GST and 9% SGST. Walk me through building this journal entry line by line.
First, we identify the primary item we are acquiring.
Yeah.
We are buying machinery. Machinery is a real account. It is a tangible asset coming into the business, so we must debit it. What is the value we debit? The base cost of the machine is 100,000. So our first line is machinery account debit 100,000.
Okay, but I am going to push back hard on this. I'm looking at my bank screen, and I am about to authorize a transfer for 118,000 rupees, 100,000 for the machine, and 18,000 for the combined taxes.
I see where you're going with this.
Why wouldn't I record the machinery account as 118,000? That is literally the total amount of money that left my business to acquire this machine.
That instinct is incredibly common, but it means the pre-GST mindset is creeping back into your logic. Remember our extensive discussion about the voucher system. The 18,000 you are paying in tax is not a sunk cost. It is not permanently lost to the business.
Right, it's the voucher.
Exactly. It is an input tax credit. It is a separate asset, a voucher you get to use later to offset your output liability and save cash down the road. Because that 18,000 is recoverable from the government, it cannot legally be capitalized as part of the cost of the physical machine.
Oh, I see. If I did that, it would be misrepresentation.
Huge misrepresentation.
Yeah.
If you added it to the machinery account, making it 118,000, you would be committing two cardinal sins. First, you would be overstating your physical assets on the balance sheet. Second, you would be double dipping, claiming the 18,000 as machine value to depreciate and later trying to claim it as a tax credit. The tax authorities would penalize you heavily for that.
Oh, wow. Double dipping. Okay, the tax must be segregated. The machinery sits cleanly at 100,000.
Exactly. The cost is pure.
So, line 1, machinery account, debit 100,000. No, we deal with the taxes. We paid 9% CGST, which is 9,000 rupees, and 9% SGST, which is also 9,000 rupees. Since this is a purchase, these are input taxes. Input taxes are vouchers, which are assets. Assets increase with a debit. So, line 2, input CGST account, debit 9,000. Line 3, input SGST account, debit 9,000.
Excellent. We have recorded all the value coming in,
Yeah.
the machine and the two tax vouchers. Now for the credit side, what is giving the benefit? What is going out?
Cash is leaving our bank. Bank is a real asset account, and when an asset goes out or decreases, we credit it.
Exactly.
We credit the bank account for the total actual cash outflow. 100,000 plus 9,000 plus 9,000 equals 118,000. So the final balanced entry reads, machinery account debit 100,000, input CGST account debit 9,000, input SGST account debit 9,000, to bank account 118,000. Total debits equal 118,000, total credits equal 118,000. The equation balances perfectly and the taxes are properly segregated.
And to make our future auditor happy, the narration will be something comprehensive like, being machinery purchased from Symphony Industries, paid immediately by bank, interstate supply, CGST and SGST at 9% each. Now, that is the happy, straightforward scenario. You buy something, the supply chain is working, you debit the input tax, you hold the voucher.
It's all working as intended.
But nothing in business always goes smoothly. And this brings us to the final, most nuanced concept in our deep dive, the section that truly separates the rote memorizers from the deep understanders, the reversal of GST.
Reversals. This is where it gets tricky.
We just spent 20 minutes hammering home that input GST is an asset with a debit balance. When do we credit an input GST account? When do we actively reverse and destroy the asset voucher we just created?
Knowing when to reverse input credit is a test of true conceptual mastery. You have to remember the fundamental philosophical deal you made with the government.
What deal?
Why did the government allow you to debit input GST and call it an asset in the first place? They didn't do it out of the goodness of their hearts.
Right. They gave you that voucher on the strict assumption that you were going to use those goods to make a taxable sale later on. They gave you input credit so that you would eventually generate output GST for them to collect. The input credit is a temporary holding area. It only legally survives if the continuous chain of supply survives.
So what breaks the chain?
If something happens to break that supply chain, if the goods are destroyed, given away, or returned, meaning they will never be sold to generate output tax, then the government's deal is voided. They step in and say, hold on, you didn't fulfill your end of the bargain, no output tax is coming, therefore you do not get to keep that input credit voucher, you must reverse it.
You literally lose the voucher. The asset is destroyed. The text lists 5 specific, highly testable scenarios where input GST paid at the time of purchase must be reversed. I want to analyze the why behind every single one of them.
Let's do it.
Scenario: purchase is return. You buy goods, but send them back.
This is the most purely logical one. You bought raw materials, you paid the tax, and you debited input GST, claiming your voucher. But a week later, you realize the materials are defective. You pack them up, return them to the supplier, and the supplier refunds your money, including the tax.
So I have my cash back.
Yes. Since you physically returned the goods, you obviously no longer have them in your inventory to sell. The forward supply chain for those specific items is unwound. You got your cash back. Therefore, the input credit you claimed in your books must also be unwound. You reverse it by crediting the input GST account.
As the formal working note states, since goods are returned to the supplier, the input tax credit availed earlier on those goods is to be reversed, since these goods are no longer available to be sold.
Exactly.
Simple enough. You can't keep a voucher for something you returned. Scenario 2 is where it gets spicy. Drawings. In accounting terms, this means goods taken by the owner for personal use.
Oh, this reversal exists to close a massive economy-destroying loophole.
Really? How so?
Imagine a business owner who runs an electronics store. He buys a top-of-the-line gaming laptop through his business. The business pays the 18% GST and claims the input credit voucher, effectively reducing the business's tax bill. But then, instead of putting the laptop on the shelf to sell to a customer, the owner just puts it in his car, drives home, and gives it to his kid to play video games.
Wow.
If the government allowed this, every single business owner in the country would buy their personal groceries, their clothes, their TVs through their company ledgers just to claim the tax-free input credits.
That would be massive tax evasion.
Huge. Because the laptop was taken for personal consumption, it has permanently left the business stream. It will never be sold to a retail customer to generate output GST. The supply chain is broken. Therefore, the business is legally forced to reverse the input credit it initially claimed. You credit the input GST account, canceling the asset.
It prevents tax evasion. If you consume it personally, you bear the tax burden just like any other citizen.
Absolutely.
Scenario 3. Goods distributed as free samples. And scenario 4. Goods distributed as gifts. Let's tackle these together, because a business giving a client a free desk or handing out free sample energy drinks on the street feels like legitimate business marketing expense. Why do we reverse the GST?
It is a legitimate marketing expense, but we have to look strictly at the mechanics of the tax law.
Yeah.
Both scenarios operate on the exact same logic. If you are handing out energy drinks on the street for free or giving a client a gift, what is the selling price?
Oh, the selling price is 0.
If the selling price is 0, what is the output GST you are collecting from that consumer? 18% of 0 is 0.
Oh.
We go back to the philosophical deal. The government says, we give you input credit so that you collect output tax. If you, as a business strategy, voluntarily decide to give goods away and collect absolutely 0 output tax, the government says, fine, that's your marketing choice, but since we aren't getting any output tax, we are revoking your input credit.
You must reverse the input tax you claimed when you originally bought those energy drinks. You credit the input GST account.
Yeah, exactly. Just a quick note for the advanced students. There are highly complex exceptions in advanced GST law regarding related parties and what constitutes a deemed supply, even if free, but at this foundational level, the rule holds. No output tax intended, reverse the input credit.
The government always gets its due. And finally, the most heartbreaking one. Scenario V. Goods lost in fire or theft.
This is a tragedy for the business owner. Your warehouse burns down, or thieves empty your inventory overnight. You've lost your capital. But accounting and tax law are brutally objective. They do not operate on sympathy.
That's rough.
If those goods are reduced to ashes or fenced by thieves, one thing is absolutely certain. They are gone from your control. You will never, ever be able to sell them to a legitimate customer. They will never generate output GST on a legal invoice.
So the deal's broken again.
Because the ultimate taxable event, the supply to a consumer, can now never happen. The premise for granting you the input credit is destroyed. The tax credit literally dies with the goods. Even as you are writing off the loss of the inventory, you must simultaneously reverse the input GST you claimed when you bought those goods. You credit the input GST account to wipe the asset off your books.
It really is all about relentlessly following the physical flow of the goods to their final destination. If the goods detour into the owner's house, or into a fire, or into a free giveaway and fail to reach a taxable destination, the credit is nullified.
Exactly. The journal entries are merely a reflection of the economic and legal reality of the supply chain. If the chain breaks, the entry reverses.
Wow. We have covered an absolutely staggering amount of ground today. We have torn apart the mechanics of money. Let's do a rapid, comprehensive chapter recap for everyone taking notes, or for anyone who just wants to mentally solidify this framework before their exam.
Take a deep breath. Here we go.
We started at the absolute foundation, the journal. It is not just busy work, it is the chronological diary, the book of original entry based entirely on Pacioli's double entry principles. It provides the narrative context through narrations, and it acts as the vital error checker before anything hits the ledger filing cabinets.
Yep.
Then we mapped the rules of the game, the account types. Nominal equals now. These are temporary expenses and incomes, the fuel burned, which get flushed into the P&L and reset to 0. Real equals reality. These are the tangible assets that endure, sitting permanently on your balance sheet. Personal equals people. Debtors, creditors, and crucially, the capital account, which is a liability because the business is a separate robot that owes its owner.
A robot that owes its inventor.
We suffered through the dark ages of the pre-GST landscape, understanding the devastating cascading effect, where fragmented central and state laws forced businesses to embed taxes into their costs, resulting in consumers paying an unjust tax on top of a tax.
The dark times.
Then we emerged into the GST revolution. We learned the paradigm shift. Input tax is a voucher, an asset. Output tax is money owed to the government, a liability. By using vouchers to pay liabilities, the cascade is broken, ensuring only pure value addition is taxed.
The dam that stops the cascade.
We navigated the geography of federalism. Interstate local supplies trigger the 50-50 split of CGST and SGST. Interstate border crossings trigger the IGST armored transport vehicle, ensuring the destination consuming state gets the revenue.
The armored vehicle.
We built the waterfall, the strict rules of utilizing credits. Remember the golden memory trick? The stubborn siblings. CGST and SGST will fund the family vacation IGST, but they will never, ever share credits directly with each other to pay each other's debts.
Never cross the streams.
And finally, we brought it all back to the journal. We learned to debit input tax assets on purchases, credit output tax liabilities on sales, and crucially, we learned to reverse and destroy that input tax asset when the supply chain breaks due to returns, personal drawings, free gifts, or tragic losses like fire.
It is a massive, comprehensive framework. But notice how every single piece connects to the others.
It really does.
If you understand these interconnected principles, the why behind the rules, The individual journal entries you face on an exam, or in the real business world, won't be things you have to memorize. They will just be logical puzzle pieces falling naturally into place. You can derive the answer from first principles.
Before we officially sign off and let your brains cool down, I want to leave you with a final provocative thought, building on everything we've unpacked today.
Ooh, all right.
Think about the sheer, unfathomable scale of accounting taking place across the country right at this very second. Every single time you walk into a local cafe and tap your phone to buy a cup of coffee, a microeconomic event happens. An output tax liability is instantaneously created in the cafe's digital ledger. Somewhere in the back-end servers, an input credit from when they bought those coffee beans last week is being offset against your purchase. Depending on where those beans were grown and shipped from, IGST might be settling between state borders in milliseconds, and the state you are standing in receives its tiny fraction of a rupee in revenue to help pave the road outside the cafe or fund the local school.
It's mind-blowing when you think about it.
The journal isn't just a dusty book of historical entries sitting on an accountant's shelf. When you aggregate these double entries across millions of businesses, billions of times a day, it is the literal nervous system of the entire economy. It is firing billions of synapses, constantly balancing equations, keeping track of every single ounce of value created, transferred, and consumed by humanity.
It is a profoundly beautiful, complex machine when you finally zoom out and see how all the gears interlock. And now, hopefully you know how to read the blueprints.
Thank you so much for joining us on this masterclass deep dive. We hope we have finally cleared the muddy waters for you. Good luck on your exams, good luck in your businesses, and no matter what you are studying, always keep questioning the why behind the numbers. Imagine for a second, you are the CEO of a multi-million-dollar company.
Right.
You pull up your business banking app on your phone, and right there on the screen, it shows you have, I don't know, $5 million in cash.
Oh, well, that feels like a great day.
Right. You feel invincible. It's a great day. But what that app doesn't tell you, what that single comforting number completely hides, is that tomorrow morning you actually owe $6 million to your primary suppliers.
Oh, wow. Yeah, that's a problem.
Yeah, if you are only looking at the cash flowing in and out of your bank account, you are basically flying blind straight into a brick wall.
You really are.
Yeah.
And I mean, that is the ultimate danger of raw data. We all crave that, instant clarity, that single number on a dashboard that tells us we are totally safe.
Exactly.
But raw financial data is just inherently deceptive without a framework to organize it.
And that is exactly why we are here today. Welcome to another deep dive. Whether you're, an exam candidate staring down finals, or a business student trying to actually wrap your head around the mechanics of finance rather than just memorizing them.
Which never works, by the way.
Right, it never works. Or maybe you're simply someone who wants to understand the language of business. Well, you're in the right place. Because today, we are taking on the tool that prevents that CEO from flying into the brick wall. We are mastering one of the most fundamental concepts in all of accounting, the ledger.
Yes. And I think the goal for our discussion today isn't to just hand you a list of rules to memorize. I mean, rote memorization fails the moment a real-world scenario doesn't perfectly match the textbook.
Totally.
So we are going for complete conceptual clarity here. We really need to explore the underlying logic, the why and the how of ledgers, of posting, and, of balancing. We want it to be so deeply understood that it basically becomes second nature to you.
Yeah, so we're going to build this from the absolute ground up, working our way through to the advanced traps that trip people up on exams and, honestly, in actual boardrooms, too.
Oh, absolutely. They do.
And I'll be asking the questions that naturally arise when you actually try to apply this stuff because, well, the theory often sounds much cleaner than the practice, right?
It always does.
Yeah.
Always. So let's establish the big picture first. It really helps to think of accounting as a distinct language.
Okay.
In this language, the journal, which is where we record every transaction exactly as it happens, the journal, is basically the daily diary of a business.
A stream of consciousness, basically.
Precisely. Just a continuous stream. But the ledger is entirely different. The ledger is the organized encyclopedia of the business. In the accounting world, it's universally recognized as the principal book of accounts.
The principal book, right. So to understand why it's the principal book, we have to understand how we move from the chaos of that daily diary to, the order of the encyclopedia. According to our source material, after original transactions are recorded in the journal, They cannot just sit there. They have to be classified. They have to be grouped.
Grouped, yeah.
And the physical, or I guess digital, book that contains all of these specific sets of accounts, whether they are personal accounts for individuals, real accounts for assets, or nominal accounts for expenses, that book is the ledger.
Exactly. And the concept that unlocks this entire process, the real key here, is the distinction between a chronological order and an analytical order.
Okay.
That is the fundamental difference between your journal and your ledger.
Let's spend some time on that, actually, because grasping that difference seems to solve like half the confusion right out of the gate.
It really does. So the journal records transactions in a strictly chronological order. It is relentless.
Yeah.
Day by day, hour by hour, minute by minute.
Just a timeline.
Exactly. If you purchase inventory at 9 a.m., then you sell goods to a customer at 11 a.m. and then pay your electricity bill at 3 p.m. Those events are listed exactly in that order, one after the other.
So it's just a massive, continuous mixed stream of events, which, I mean, is great if you want to know exactly what the company did on a random Tuesday at noon.
Right.
But it is completely useless if I, as the manager, come to you and ask, hey, how much did we spend on electricity this entire year?
You would be entirely stuck. I mean, to answer that simple question using only the journal, you would have to manually read through perhaps tens of thousands of mixed entries, right? Spanning 365 days.
Just hunting for the word electricity.
Hunting for electricity, writing those numbers down on a scrap of paper and adding them up. It's a total recipe for disaster and just massive inefficiency.
Yeah.
So the ledger solves this by recording transactions in an analytical order. It groups them by specific targeted accounts.
I think about this in terms of how we use our smartphones every single day.
Oh, that's a good way to look at it.
Yeah, think about your phone's notification center. That is your journal. It is a master history of every single text, phone call, email, calendar alert, and like breaking news update, all mixed together strictly based on the exact second they arrived on your screen.
It's just a wall of information.
Exactly. It is chronologically perfect. But analytically, it's chaos. Like, if I want to know what my mom said to me last week, the notification center is completely unhelpful.
Because her message is buried between, a pizza delivery update and a spam email.
Exactly. The ledger, on the other hand, is your phone's contact list. When I open my contacts and tap on Mom, I see only the history of interactions with her. The pizza delivery updates are gone.
Right.
The work emails are gone. I am looking at a highly classified, analytical group of data dedicated entirely to one single subject.
That analogy perfectly captures the highly tested distinction between the two books. And exam boards consistently test this exact concept, by the way.
Do they really?
Oh, yeah. They want to ensure you know that the journal is the primary book, the book of original entry. But the ledger is the principal book of accounts. The journal captures the data.
But the ledger makes the data useful.
Exactly. It makes it useful.
Wait, hold on, though. If I'm already taking the time and, paying an accountant to write a perfectly accurate chronological diary in the journal, building this entire secondary book feels like a massive duplication of effort.
It does feel that way at first.
Right. Like, why are accountants doubling their workload? Is this just a relic from the days before computers?
It's an understandable pushback. And honestly, it's a question people have been asking since the system was formalized in the 1400s by Luca Pacioli, who was a mathematician who worked alongside Leonardo da Vinci, actually.
Oh, wow. I didn't know that.
Yeah. But it's absolutely not a duplication of effort. It is a transformation of data. Because without the ledger, you can never determine the account-wise balance. You literally wouldn't know how much cash you actually have in the bank.
Because the journal only tells me money went in or went out on specific days, not the running total.
Exactly. You wouldn't know how much a specific customer actually owes you. Your journal just says, sold goods on Tuesday and received a partial payment on Friday.
Right.
The ledger calculates the net result. Without it, you are running the business completely blind. And to address the technology aspect, modern software hasn't eliminated the ledger at all.
It hasn't.
Not at all. ERP systems like SAP or QuickBooks, they might do the grouping instantly in a fraction of a second, but under the hood of that software, they're still taking the chronological entry and instantly posting it to a digital ledger. That's how they give you that dashboard view.
So the dashboard we talked about at the very beginning, the one that gives the CEO that instant snapshot, that dashboard is pulling its data from the ledger, not the journal.
Always. The ledger is the ultimate source of truth for the current standing of the business.
All right, so let's get into the architecture of this thing. What does a ledger account actually look like? Like, for anyone listening, if you want to visualize this, Picture a giant letter T drawn on a blank piece of paper.
The foundational T account. It is the building block of all financial analysis.
The vertical line of the T divides your page right down the middle, creating two distinct equal sides. The left side is always the debit side. The right side is always the credit side.
Always.
And sitting right across the top horizontal line of the T is the specific name of the account. Let's imagine we are opening a cash account.
Okay, so underneath that main header, the left side and the right side are mirror images of each other. They each contain 4 very specific columns.
Let's break those columns down. The first column on the far left is the date. That's straightforward, right? When did this transaction actually happen?
Yep. The second column is labeled particulars. This is the narrative section of the ledger. This is where we write the name of the corresponding account involved in the transaction to tell the story of where the money came from or where it went.
Right. Now, the third column is one that often confuses people. It's JF, which stands for Journal Folio.
Yeah.
It is essentially the specific page number from the original journal where this transaction was first recorded. And finally, the fourth column is the amount, recorded in whatever your local currency is.
So that's date, particulars, JF, and amount on the left debit side. And the exact same 4 columns, date, particulars, JF, and amount, repeated on the right credit side.
I have to stop and ask about that third column, though, the Journal Folio.
Sure.
Writing down literal page numbers seems like an archaic practice in an era of cloud computing and hyperlinked databases, you know?
It sounds a bit outdated.
Exactly. Why do accounting standards and exam boards still obsess over the JF column? Like, what is its actual modern purpose?
It speaks to the absolute core philosophy of accounting, which is verify everything. Even if modern software replaces a physical page number with, say, a clickable hyperlink or a unique transaction ID string, the conceptual purpose remains identical.
Which is?
The JF column creates an unbreakable audit trail.
Ah, it's the breadcrumb trail.
Exactly. In a rigorous accounting system, numbers cannot just magically materialize in the ledger. Every single dollar has to have a verified chronological origin story back in the journal.
Right.
The JF reference proves that a ledger entry wasn't just fabricated out of thin air by someone trying to hide something.
So if an auditor walks into my company and sees a massive unexpected spike in my cash ledger, they don't just take my word for it.
Absolutely won't. They will look at the JF column, which points them directly to, say, journal page 42 or transaction ID 8974.
Okay.
They can then go to that original source, look at the date, look at the authorization, and verify the reality of the transaction. It tethers the analytical summaries of the ledger to the harsh reality of the journal.
It's the receipt for the entry itself. I love that. Okay, so we understand the architecture. We have our T account drawn. The real question is, how do we actually move the data from the chronological diary into this analytical structure?
Right.
Which brings us to the actual mechanics of posting.
Yes. Posting. Posting is the formal action of transferring debit and credit items from the journal to the respective classified accounts in the ledger. You are intentionally migrating data.
Before we move on, I want to address a definition trap that people fall into all the time, especially on exams. I've heard students define posting as, and I quote, the process of transferring account balances from the ledger to the journal to create a record.
Oh no, that is completely backward.
Completely backward, right.
It reverses the entire flow of time and logic in accounting. Posting is strictly moving information from the journal to the ledger. You extract from the chronological diary to build the analytical encyclopedia. Never the other way around.
Chronological to analytical, journal to ledger, got it. Now, our source material outlines 3 golden rules for this posting process.
Okay, let's hear them.
Rule number 1, separate accounts are opened in the ledger book for each distinct account, and entries from the journal are posted to those respective accounts accordingly.
Right. This rule is really about maintaining the purity of your data. You cannot be lazy with your categories.
What do you mean?
Well, you don't create a blended utilities and rent account just because you pay both of them on the first of the month. You open a dedicated utilities account and a dedicated rent account. If you blend them, you destroy the analytical power of the ledger.
Keep the categories pure. Makes sense. Rule number 2 introduces the specific terminology of the ledger. It involves the use of 2 tiny words, to and by, and these are written in the particulars column.
Yes. Whenever you are posting an entry onto the left side, the debit side, you always precede the account name with the word to. Whenever you are posting on the right side, the credit side, you precede the account name with the word by.
And this is where things get really fascinating from a linguistic standpoint. The source material includes a very specific bolded note about this.
It does.
It states explicitly that these words, to and by, do not carry their standard English meanings in this context.
This is a trap that ensnares so many beginners. People try to read the ledger like a novel. They see an entry and read, cash went to sales or rent was paid by the bank. And because that occasionally makes grammatical sense in English, they think they've cracked the code.
But it's a total coincidence when it makes sense.
Completely coincidental. And eventually you'll hit an entry where reading it as an English sentence makes absolutely zero sense and your brain will just freeze.
So what are they then?
You have to discard the dictionary definitions of these words. They are not prepositions here. They are merely traditional visual conventions.
They're just signposts.
Exactly. The word to is simply a visual signpost alerting the reader, hey, you are currently looking at a debit entry. The word by is a signpost alerting the reader you are currently looking at a credit entry. That is the beginning and the end of their meaning.
Follow the signposts. Don't analyze the grammar. Okay, now let's look at rule number 3. This is the heavy hitter.
Oh, yes.
This is the rule that causes the most genuine confusion. I call it the opposite account rule.
Let's lay it out. The formal rule states, the concerned account debited in the journal should also be debited in the ledger, but the reference written in the particulars column should be of the respective credit account.
Okay, I have to stop you there, because the first time I read that, it sounded like a massive contradiction.
It does sound like one, doesn't it?
Think about it. The rule essentially says if an account is debited in the journal, I have to go to the debit side of that account in the ledger. Fair enough. But I have to write the name of the credit account inside it.
Yep.
Like if I am staring at my cash account and I'm putting a number on the debit side because my cash just increased, why on earth am I writing a word like sales in there?
I know. It feels incredibly counterintuitive at first.
Mm-hmm.
But when the underlying logic clicks, it's actually a brilliant system of cross-referencing.
Okay, explain it to me.
Think about the context of where you are. You are sitting inside the physical space of the cash account. You are looking at the debit side, which means you already know cash has increased.
Yeah.
If, in the particulars column, you just wrote the word cash, what new information have you actually provided?
Absolutely none. I know it's cash. The word cash is written in giant letters at the top of the page.
Exactly. Writing cash increased because of cash is a useless tautology. It tells you that number went up, but it completely strips away the context.
Oh, I see.
However, if you write the name of the opposite account, the corresponding credit account from the journal entry, you suddenly tell the story of the transaction. You write sales. Now, any manager, auditor, or investor looking at that specific line in the cash ledger knows exactly why the cash increased. The cash went up on this date because we made a sale.
So the ledger isn't just tracking the movement of the money, it's tracking the cause of the movement. You are identifying the source of a debit or, the destination of a credit.
Precisely. You write the name of the corresponding opposite account to preserve the narrative of the transaction within the analytical framework.
Let's ground this theory in reality. The source material provides a great scenario involving a stationary account for a firm in January. Instead of just reading rows of numbers, let's imagine you run a small design agency.
Okay, I like it.
It's a new year and you need supplies.
Let's walk through it step by step. Visualize that T account with stationary account right at the top.
The first piece of data is from January 1st. It says, inventory of stationery, 480. This isn't a new purchase. This is an opening balance. It's a pens and paper left over from last year.
Right.
So because stationery is an asset we hold, we go to the debit side, the left side. We write the date, Jan 1. In the particulars, following our signpost rule, we write to balance, B a D. And the amount is 480. We will unpack exactly what bulb means when we get to balancing, but for now, it just means we are starting the month with 480 worth of supplies.
Perfect. Now let's do an actual posting of a new transaction. January 5th, you authorize a purchase of new stationery and pay by check for $800. Before we touch the ledger, what happens in the journal?
Okay, thinking chronologically first. I bought stationery, which is an expense for the agency. Expenses increase on the debit side, so I debit stationery.
Good.
I paid by check, which means money is leaving my bank account. The bank is an asset, and when an asset decreases, we credit it. So the journal entry is debit stationery 800, credit bank 800.
That's the correct diary entry. Now, how do we migrate that specific data into our stationary ledger account?
Well, I am focusing exclusively on the stationary half of that journal entry. The journal says debit stationary. That is my instruction.
Yes.
So I physically move to the debit side, the left side of my stationary to account. I write the date, Jan 5. Because I am on the debit side, my signpost word is ton. And here's where we apply the magic opposite account rule.
Here we go.
I do not write stationary. I look back at my journal, find the corresponding credit account that completed the transaction, which is bank, and I write bank AC. So the line tells the story. Jan 5 to bank AC 800.
Beautifully done. When I, as an outside observer, read that ledger, it tells me a crystal clear story. On January 5th, this agency's stationery expense increased by $800. And the reason for that increase was a direct payment from the bank.
It's so clean once you see it.
Let's do one more to really solidify the mechanics. January 15th, you make a massive credit purchase of specialized design paper from a supplier called 5-Star Stationery Mart for $1,280. You haven't paid them yet.
Mental journal entry first. The expense increases again, so debit stationery $1,280. But this time, money didn't leave the bank. Instead, my liability, my debt to this specific supplier has increased.
Right.
So I credit the creditor, 5-Star Stationery Mart, $1,280.
Now post it to the ledger.
I go to my stationery ledger. The journal instructs me to debit stationery, so I move to the left side again. Date, Jan 15. Signpost word, 2. I look for the opposite account name to tell the story, and I write 5-Star Stationery, amount, $1,280.
And once again, the narrative is perfectly preserved. The stationery expense increased by $1,280, and the source of this transaction was our credit supplier, 5-Star. You have successfully taken raw chronological events and categorized them perfectly into an analytical tool.
Okay, so we spent the entire month tossing numbers onto the left and right sides of these various accounts based on what happened. But eventually, the month ends.
It always does.
My boss, or the CEO from our opening example, doesn't want to see a chaotic list of 50 numbers on the left and 30 numbers on the right. They want a single definitive bottom line. How much do we actually have? Who owes what?
Which brings us to the crucial process of balancing the books. Finding the equilibrium in the account. At the end of every reporting period, whether that's monthly, quarterly, or annually, it is absolutely necessary to ascertain the net balance in every ledger account. As the text simply puts it, if you bought goods worth $1,000, but you only paid $850, you still owe $150. That $150 is your net balance. We need a systematic mathematical way to calculate that for every single account in the business.
Well, the source outlines a very straightforward mathematical procedure. Step 1. You total up all the numbers on the debit side, and you total up all the numbers on the credit side, usually just jotting it down on a piece of scratch paper.
Yep, rough math.
Step 2. You deduct the smaller total from the bigger total. Step 3. That difference is your balance. The math itself is elementary school subtraction.
The math is incredibly simple. But the conceptual understanding of what that resulting number means, what you call it, and physically where you write it on the ledger, that is where the most devious exam traps are laid, and where even working professionals sometimes get turned around.
Let's dismantle those traps one by one then. The first challenge is identifying the actual nature of the balance. Is it a debit balance or is it a credit balance?
The rule of thumb here is simple but absolute. The balance always takes the name of the heavier side.
The heavier side.
If the total of the debit side is greater than the total of the credit side, the intrinsic nature of that account is a debit balance. Conversely, if the credit total is greater than the debit total, it is a credit balance.
Okay, whichever side has more weight wins the naming rights. Simple enough.
Yeah.
But here is the massive doubt that trips up students, and honestly, it confused me for a long time too.
Let's hear it.
The source explicitly instructs us that if we have a credit balance, meaning the credit side is significantly bigger and heavier, we must physically write the balance amount on the debit side of the ledger.
Yes, that's correct.
But if the credit side is the bigger side, why on earth does the final number physically sit on the opposite, smaller side? It feels entirely backwards.
It does feel backward if you just think of it as writing numbers on a page. To understand why we do this, you really have to visualize a physical, old-fashioned weighing scale.
Like the ones with 2 hanging plates.
Exactly. The kind with 2 metal plates hanging from a fulcrum. Imagine that scale sitting on a desk. On the right side, representing the credit side, you have piled up 1,000 pounds of heavy iron weights. On the left side, representing the debit side, you only have 850 pounds of weights.
So the scale is completely lopsided. The right side is much heavier. It's sagging down to the desk, while the left side is up in the air.
Exactly. The intrinsic, undeniable reality of this scale is that it is credit heavy. It has a credit balance of 150 pounds.
Right.
Now remember, our job as accountants, at the end of the reporting period, our job is literally to balance the books. We must force both sides of that scale to equal exactly 1,000 so we can draw a neat double line under them, declare the period closed, and move on.
Ah, I see it. To make that lighter 850-pound debit side equal the heavy 1,000-pound credit side, I have to go find a 150-pound placeholder weight and manually drop it onto the lighter side.
Bingo. You take that 150-pound placeholder and you place it on the lighter debit side. You label that specific placeholder weight to balance CD. By doing that, the left side now mathematically equals 1,000 and the right side equals 1,000. You have artificially balanced the scale for the end of the month.
That is such a clarifying way to look at it. You haven't changed the fundamental fact that the account was credit heavy. You've just used a mathematical wedge to force the totals to match temporarily so you can close the book.
And the most important part of this visual happens the very next morning.
What happens?
On the first day of the new month, you cannot leave that artificial placeholder sitting there. You have to remove that 150-pound placeholder weight from the lighter side, and you move it back to its natural, heavier side to serve as the genuine opening balance for the new month.
Which brings us perfectly to decoding those little abbreviations that are everywhere in ledgers, CD and BD. Let's define them formally based on the text.
The abbreviation CD stands for carry down. This is that artificial closing balance we just talked about, the placeholder inserted at the very end of the period solely to equalize the two sides.
Got it.
The abbreviation BD stands for brought down. This is the genuine opening balance for the new period, and it always sits on its natural, heavier side.
I have a memory trick for this that helped me immensely when I was first learning this. I think of CD as meaning closing down the current period. You only use it on the absolute last day of the month when you are shutting off the lights.
I like that.
And I think of BD as beginning down the new period. You use it on the first morning of the new month.
Closing down and beginning down. That's a highly effective mnemonic that keeps the timeline straight in your head. And visually, if you're looking at the T account, you have to remember the crossover rules.
Crossover rule.
The CD amount always crosses diagonally over the final total line to become the BD amount on the opposite side. If your to balance CD placeholder is sitting on the debit side, it crosses over diagonally to become by balance BD on its natural credit side for the start of the next month.
Let's weave in one of the exam traps from the source right now because it relates perfectly to this.
Okay, lay it on me.
Let's say a student is taking an exam. They've totaled up a ledger account. The total of the debit side is 5,000. The total of the credit side is only 1,000. The debit side is clearly heavier.
Right.
The student writes down this logic. Because the debit side is greater, I have to put the balancing figure on the credit side to equalize it. Therefore, I will get a credit balance as an opening balance for the next month. Where do they go wrong?
Ouch. They fell right into the trap of confusing the location of the placeholder with the nature of the balance. Let's go back to our physical scale. The debit side has 5,000 pounds. The credit side only has 1,000 pounds. The debit side is drastically heavier. Therefore, the intrinsic, undeniable nature of this account is a debit balance.
The heavier side always wins the name.
Yes. Now, the student's middle step was actually correct. To equalize the scale for the last day of the month, you must place the 4,000 balance CD placeholder on the lighter side, which is the credit side. That physical action is correct.
Okay.
However, their final conclusion is fatal. They forgot the crossover rule. When that 4,000 placeholder crosses over diagonally to become the opening balance BD for the next month, it returns to its natural heavier side. It will sit on the debit side. Therefore, you absolutely get a debit balance as an opening balance, not a credit balance.
The placeholder goes on the light side to close down, but the opening balance always lives on the heavy side to begin down. That is a crucial distinction. Let's actually trace this full life cycle using our design agency's stationery account that we built earlier.
Let's run the numbers. We had a beginning debit balance of 480. We had a debit of 800 for a bank purchase, and we had a debit of 1,280 for a credit purchase.
Step 1. Total both sides. The debit side total is 480 plus 800 plus 1,280, which gives us a total of 2,560. We look at the credit side, and there's absolutely nothing there. The total is 0.
Step 2. Deduct the smaller from the bigger. 2,560 minus 0 is 2,560. Because the debit side is the only side with weight, This is intrinsically a debit balance.
Step 3. To make both sides mathematically equal 2,560 for the end of January, we must put a placeholder on the lighter side. The credit side is the lighter side. So on January 31st, on the right credit side, we write our signpost by, then balance CD for 2,560. Now we can draw a solid line and write the total of 2,560 neatly under both sides.
And the vital final step, the crossover for the new month. On February 1st, we cross that number diagonally over to the left debit side, its natural heavier side, and we write our signpost, 2, then balance BD for 2,560. You now have your opening balance for February.
That is the complete flawless life cycle of balancing an account. We've taken raw chaos, categorized it, and extracted a single meaningful number. But that fundamentally changes how financial statements are built. Not all accounts get this treatment at the end of the year.
Right. This is perhaps the most important conceptual dividing line in all of accounting. It dictates the difference between a balance sheet and an income statement. Not all accounts are treated equally when the financial calendar flips to a new year.
Our source text draws a very hard line here. It states, personal accounts and real accounts, which are essentially your assets and your liabilities, are balanced exactly how we just described, and their BD balances are proudly carried forward to the next year, ultimately sitting on the balance sheet. But nominal accounts, which encompass your revenues, incomes, gains, expenses, and losses, are not balanced to be carried forward.
To understand this, you have to ask a fundamental philosophical question about the data. Does the financial reality of this account persist into the future, or does it merely represent a measurement of performance for a specific, finite period of time?
I like to explain this using an analogy. Let's look at a real account first, like a physical asset. The source text uses an illustration of a building account showing a balance of $10,000. Think about that realistically.
Okay.
If your company owns a building worth $10,000 on December 31st, when you wake up the next morning on January 1st, that building hasn't vanished into thin air. You still own it.
Obviously.
The reality of that physical asset carries forward across the arbitrary line of the new year. Therefore, you bring that balance down, you carry it forward.
The asset is a continuous, persistent reality. The exact same logic applies to a personal account, like a bank loan or a mortgage. If you owe the bank $50,000 on New Year's Eve, you don't magically owe them $0 on New Year's Day.
Right, the bank doesn't forget.
The liability persists. The debt is real. That is why real and personal accounts are always balanced and carried down into the new year.
But a nominal account operates on an entirely different plane of reality. Think of a nominal account like your personal monthly grocery budget.
Okay, let's track this.
Let's say you spent $500 on groceries in December. When January starts, you don't look at your budget and say, well, my starting grocery spending for this year is already $500. No.
Right, you'd be out of money immediately.
Exactly. The calendar flips and your spending trackers instantly reset to 0. You want to measure January spending in isolation, completely separate from December's.
That is the perfect way to understand it. Nominal accounts exist solely to measure the performance, the incomes generated, and the expenses incurred of one specific, contained accounting period. Once that period ends, their job is done. They have no physical reality to carry forward.
I know students often fall into a trap here relating to true-false question 4 in the source material. A student finishes their year-end accounting. They've perfectly balanced the cash account, the building account, the bank loan account. They turn to the rent expense account and say, all right, time to calculate the balance CD for rent so I can bring it down for next year.
And that is a fatal error. They are treating a measurement of performance like a physical asset. You do not carry this year's rent expense into next year's ledger as a starting balance. The grocery budget resets.
So if we don't write balance CD and carry them forward, what actually happens to them? Do they just evaporate? Where do they go?
They don't evaporate, they are aggregated. The source note is very clear on this flow. The balances of all nominal accounts are transferred into a master summary account called the profit and loss account, often just called the P&L.
Okay.
Imagine you have a dozen buckets representing your nominal accounts: the rent bucket, the sales bucket, the salary bucket. At the end of the year, you empty all of those individual buckets into one giant P&L bucket.
You are pouring all the revenues and all the expenses into one place to find out if you won or lost the game that year.
Precisely. By contrasting all the revenues against all the expenses in the P&L, you determine the ultimate net result of the year, your net profit or your net loss. And then that final net result is transferred into the owner's capital account, officially adjusting the owner's total equity in the business.
So, to summarize the cycle of accounting life, nominal accounts die at the end of the year, so the profit and loss account can live, and the resulting profit makes the capital account grow.
It's a very poetic way to describe a very rigid mathematical process, but yes, that's exactly it. Let's look at one final practical example from the text to see how the accounts that do survive are handled.
Sure.
Illustration 3 is an excellent look at personal accounts. We are examining the ledger of a business owner named Mr. S for the month of April. He needs us to compile 2 specific personal accounts for individuals he does business with, Mr. H and Mr. R.
As soon as I hear personal accounts, warning bells should be ringing in my head based on what we just discussed. These are people. These are debtors who owe us money and creditors who we owe money to.
Yes.
Debts persist. Therefore, these accounts will be balanced and carried forward into May. They do not get dumped into the P&L. Let's walk through the transactions.
Let's start with Mr. R's ledger. The first transaction is on April 1st. It says Mr. S owes Mr. R $15,000. Think about what this means. Mr. R is a creditor. We owe him money. This is an existing debt and opening balance.
So in Mr. R's ledger account, a liability inherently has a credit nature. We go to the right side, the credit side, write April 1st, our signpost buy, and then balance BD for $15,000. We start the month owing him $15K.
The next transaction happens on April 4th. Mr. R sold goods worth $60,000 at a 10% trade discount to Mr. S.
There's a subtle trick here before we even post, the 10% trade discount.
Good catch.
Accounting rules dictate that trade discounts are generally not recorded as separate journal entries. You just deduct them from the source value immediately. 10% of $60,000 is $6,000. So the actual recognizable purchase value is $54,000.
Correct. Always net the trade discount first. Now, what is the journal entry for this? We are Mr. S, and we just purchased goods from Mr. R on credit.
Buying goods is an expense, so we debit purchases $54,000. Because we bought on credit, our liability to Mr. R increases. Liabilities increase on the credit side, so we credit Mr. R $54,000.
Now, migrate that data. Post it to Mr. R's ledger.
The journal instructs us to credit Mr. R, so we physically go to the right side, the credit side, date, April 4, signpost word, buy. We use the opposite account rule to tell the story, so we write purchases AC, amount, $54,000. The line tells the story. April 4, buy purchases AC, $54,000. We owe him more because we bought from him.
That's the end of the activity for Mr. R in this specific illustration. So let's balance his account to close out April.
Step 1. Total both sides. The credit side has the opening balance of $15,000 plus the new purchase of $54,000. That total is $69,000. The debit side has absolutely nothing. Total is 0.
Step 2. Deduct smaller from bigger. 69,000 minus 0 is 69,000. The credit side is the only side with weight, so it's intrinsically a credit balance.
Step 3. Put the placeholder on the lighter side to equalize the scale. The lighter side is the debit side. So on April 30, the last day of the month, we write our signpost 2, then balance CD for 69,000. We draw our double lines with 69,000 total, sitting proudly on both sides.
And step 4, the crossover for the new month. On May 1st, we cross that number diagonally over to the right credit side, and we write by balance BD 69,000. Mr. S still owes Mr. R 69,000 going into May. The liability persists.
Excellent. Let's quickly contrast that by doing Mr. H's account from the exact same illustration. Good. On April 1st, it says, Mr. H owes Mr. S $20,000. This is the reverse situation. Mr. H is our debtor. He owes us money. Someone owing you money is an asset.
And based on the modern equation approach to accounting, all assets inherently have debit opening balances.
Exactly. When I first started learning this, I got caught by a mental trap. I thought, well, cash is money I have. It's a positive thing, so it must be a credit to my business because we use the word credit like a good thing in everyday life.
Oh yeah, a lot of people do that.
But that's entirely wrong in accounting terminology.
It is a very common misconception. Assets are debits, period. If you receive cash, you debit cash. If someone owes you money, that receivable is a debit.
Right. So in Mr. H's ledger, on the left debit side, for April 1st, we write to balance BO $20,000.
The next transaction is on April 5th. Mr. S sold to Mr. H goods priced at $30,000.
We made a sale on credit, so our asset, the amount the debtor Mr. H owes us, increases. We debit Mr. H $30,000. Making a sale generates revenue, and revenues are credited, so we credit sales $30,000.
Posted to Mr. H's ledger.
The journal says debit Mr. H. We go to the left debit side. April 5. Signpost 2. Opposite account rule dictates we write sales act to explain why he owes us more. Amount 30,000, April 5, to sales act, 30,000.
Let's balance it out to finish the month.
Debit side total. The starting 20,000 plus the new 30,000 equals 50,000. The credit side is 0. The debit side is drastically heavier. It's a debit balance. We must put our placeholder on the lighter credit side to balance the scale. April 30, by balance CD 50,000, we draw our matching 50,000 totals. And then we cross it over to May 1st on the debit side. To balance BD 50,000, Mr. H owes us 50,000 going into May. The asset persists.
That is exactly how you handle personal accounts. They survive the month end and the year end. You have mapped out the entire flow of data perfectly.
We have covered a truly massive amount of ground today. We've gone from the conceptual philosophy of why these books exist all the way down to the granular mechanics of crossing over CD to BD. Let's do a final recap to lock all of this into long-term memory.
Sounds good. We began by looking at the chaos of raw data in the journal chronological minute-by-minute diary of the business. We established that to actually make informed decisions, to avoid flying blind, we must transition that raw data into the ledger.
Right.
The ledger is the principal book of accounts because it organizes everything into a highly classified analytical order.
We broke down the anatomy of the T account, debit on the left, credit on the right. We explored the 4 columns, date, particulars, journal folio for that unbreakable audit trail, and the amount.
Yeah.
We mastered the nuanced art of posting, using to and by simply as visual signposts rather than English grammar, and always writing the name of the opposite account in a particulars column to preserve the narrative story of the transaction.
Then we learned how to find equilibrium by balancing the books, using the physical weighing scale analogy. The heavier side always determines the true nature of the balance. We use the balance CD placeholder to close down the period on the lighter side, and then we strictly follow the crossover rule to begin down the new period with balance BD on the heavier side.
And crucially, we learned the ultimate destiny of these accounts at year end. Real and personal accounts, the tangible assets, and the very real liabilities survive the year-end cutoff. They carry their balances forward to build the balance sheet.
But nominal accounts, the revenues and expenses that merely measure performance, do not get carried forward. Their buckets are emptied into the profit and loss account to calculate net income, and they reset to 0 for the new year.
If you can internalize those flows, you haven't just memorized rules, you have mastered the mechanical heart of accounting.
You really have.
I want to leave you with a final thought to ponder as we wrap up this deep dive. We've spent all this time discussing how the ledger classifies financial data to reveal the underlying truth about an account's balance. But think about how this analytical framework applies far beyond the walls of an accounting department.
It's a framework for processing reality, really.
Exactly. We live in an era of unprecedented data overload. In your personal life, your career, your own small business, having raw information, like a chronological journal of events, is essentially useless without a system to group, classify, and balance it.
So true.
If you just consume data as it happens, reading every email, tracking every minute, you are constantly reacting to the diary.
You are drowning in the chronological timeline without seeing the analytical patterns.
Mastering this simple, centuries-old, two-sided T account doesn't just make you good at passing accounting exams. It fundamentally rewires how your brain processes information. It forces you to look at any chaotic set of data, whether it's a year's worth of user feedback for a software product, time-tracking logs for your team's week, or a massive list of interactions with a client, and ask a higher-level question.
Which is?
How can I pull this out of chronological chaos? How can I organize this analytically to tell me the real story?
It elevates you from a passive recorder of history into an active, strategic analyst of reality.
And that takes us right back to our opening scenario with the CEO. When you step into the engine room of a business, you don't have to be intimidated by the muddy waters or the sheer volume of raw transactions, because now you have the filter. You have the tool that turns noise into that clean, clear, accurate dashboard. You have the ledger.
Keep practicing the mechanics. Get a blank piece of paper, write out the journal entries from the source material, draw the T accounts, and manually post them. There is a physical muscle memory to accounting that only develops with actual practice. If you understand the why and manually apply the how, the exams will take care of themselves.
Thank you so much for joining us on this deep dive into the Principal Book of Accounts. Keep questioning the data you receive, keep balancing your books, and we will see you next time. Imagine you're an accountant, And it is midnight on the last day of the fiscal year.
Oh, man, the classic accounting nightmare scenario.
Right. You have literally spent the last 12 hours just painstakingly balancing the company books.
Probably chugging cold coffee at that point.
Exactly. And you tally up the final columns, and the math is just absolutely flawless down to the last penny.
A great feeling.
It is. Like, every single debit perfectly equals every single credit. You sit back, take a breath, and you just feel like a genius. Because the numbers don't lie, right?
Well, supposedly.
Right. But what if I told you that despite this absolute mathematical perfection, your company is actually secretly bankrupt?
Wow.
And your flawless math is really just hiding this fatal structural error. So, welcome to the deep dive. Today, we are exploring this really crucial moment in the life of any business, which is the third phase of the accounting process.
Yeah, it's a terrifying scenario to think about, but honestly, it happens every single day in the real business world.
I bet it does.
It really does. And the tool that basically sits right at the center of that 3 a.m. midnight drama is exactly what we are unpacking today. We're talking about the trial balance.
The famous trial balance.
Exactly. And by the end of our discussion today, you, our listener, are going to deeply, fundamentally understand the mechanics of this tool.
Because it's not just about memorizing stuff, right?
Right. No rote memorization here. We are going to explore, the actual technique of extracting ledger balances, the absolute core purpose of doing this in the first place, and exactly how to spot those invisible traps that bring massive companies down.
And conveniently trip up so many students on their accounting exams, too.
Oh, absolutely. The examiners love these traps.
I love how you frame it as a trap, by the way, because it really requires you to have your eyes wide open. When I was first looking through our source material on this Unit 3 on the trial balance, I just kept thinking about building a house.
Okay, I like that. Walk me through that.
Well, if you are constructing a home, you don't just pour some concrete, stack up a bunch of raw bricks, and then immediately start nailing down the roof shingle.
No, of course not. You'd end up with a total collapse.
Exactly. You need an inspection. You need a structural inspector to walk through that wooden frame, check the load-bearing walls, and make sure the structural integrity is actually there before the heavy roof goes on.
That is a perfect analogy.
Thanks. Because in our accounting world, the raw materials are the journal entries, right?
Right, the daily transactions.
Yeah. And the bricks you stack up are the ledgers. And then the roof, that really heavy final layer that's the final financial statements, the profit and loss account and the balance sheet.
Yes.
So the trial balance is that critical, mandatory structural inspection that has to happen right before the roof gets built.
It really is. Because, think about it. If your frame is crooked, or if you accidentally used weak drywall for a load-bearing pillar, your roof is going to cave in no matter how pretty it looks from the outside.
Right. The bank doesn't care how nice the paint is if the foundation is cracked.
Exactly.
Yeah.
So let's start with the absolute foundation here. What exactly is a trial balance? At its core, the source defines it very carefully as a statement containing various ledger balances on a particular date.
A statement.
Yes, and we have a pause right here, because this is the very first conceptual trap, and it is a massive one for anyone taking an exam.
Okay, hit me.
The trial balance is a statement. It is absolutely, unequivocally not an account.
Okay, wait, let me stop you there. Because statement versus account to a complete beginner, or even just an entrepreneur trying to run a small business, a piece of paper with numbers on it looks pretty much the same whether you call it a statement or an account.
It does look similar, yeah.
So why does that specific vocabulary matter so much? Why is it a trap?
It matters because of what an account actually implies in the whole accounting ecosystem. Think about the cash account or a rent account. These are part of the double entry ledger system. They're living, breathing things. An account is where the actual accounting action happens. It has a designated debit side and credit side where transactions are permanently legally recorded day after day.
It's where the history actually lives.
Exactly. A statement, on the other hand, is just a summary document. It's just a snapshot. You are simply extracting the final resting numbers from all those active living accounts and listing them out on a separate disposable sheet of paper.
Just to see if the math balances.
Right. You aren't doing any new accounting.
So it's kind of like the difference between my actual active checking account at the bank, where my money is constantly moving in and out every day, versus the printed PDF bank statement I download at the end of the month.
That is exactly it.
The statement is just a photograph of where things stood on one specific day. If I spill coffee on the printed statement, I didn't lose any actual money.
brilliant way to put it. You aren't doing new accounting in the trial balance. You are literally just checking the math of the accounting you already did.
Okay, that makes total sense. And that brings us to the why, I think. Why are we so obsessed with making sure this printed list of numbers balances perfectly on both sides?
It all goes back to the fundamental law of the universe, or at least the accounting universe.
The double entry system.
Yes. The unbreakable golden rule of modern accounting is that for every single transaction, the amount written on the debit side of various accounts is always equal to the amount entered on the credit side of other accounts.
It's basically Newton's third law of motion, right? Every action has an equal and opposite reaction.
Exactly like that.
If I buy a laptop for $1,000, my equipment asset goes up by 1,000 and my cash goes down by 1,000. There's this perfect symmetry to it.
Precisely. The symmetry is the entire point.
Yeah.
So if every single entry you made throughout the month had an equal debit and credit,
Right.
then logically, when you gather up all the final balances of every single account at the end of the month, the total of all the debit balances absolutely must equal the total of all the credit balances.
Because you put equal weights on both sides of the scale every single time.
Yes. If they don't match, it means something. Somewhere in your frame is crooked.
So it's fundamentally a diagnostic tool then.
It is. Which is exactly why the source material outlines 3 main objectives for preparing this statement. Number 1, as we just discussed, is establishing arithmetical accuracy.
Arithmetical accuracy, meaning, did I do the math right?
Right, because doing accounting involves human beings, and human fingers make mistakes. It proves that during the posting process, moving numbers from the daily journal to the ledger, you haven't accidentally dropped a 0.
Oh man, dropping a 0 is the worst.
What happens all the time? Or fat-fingering 50 instead of 500, or just completely forgetting to record the other half of a transaction.
Right, because even if you're using fancy software, if a human is doing the data entry, a slip of the keyboard can just throw everything into complete chaos. So objective 1 is catching the typos. What is the second big objective?
Number 2 is that it forms the basis for final accounts. Financial statements like the trading account, the P&L, and the balance sheet are normally prepared directly on the basis of an agreed trial balance.
Okay, so the roof sits on the frame.
Exactly. The phrase you will see in exams and corporate law constantly is that financial statements must give a true and fair picture of the business.
A true and fair picture. I mean, that sounds great, but let's break that down for the listener. What does that actually mean in real practical terms?
It means that if an investor or a bank manager looks at your final statements, those documents have to accurately reflect reality.
Right.
If you try to build financial statements from a trial balance that doesn't tally where the math is just fundamentally broken at the base level, those final statements are built on a bed of lies.
Wow.
They do not represent reality. They are not true, and they are not fair to the people risking their money on your business. And your roof collapses.
That makes perfect sense. I mean, you can't show a bank a crooked house and ask for a mortgage. They're going to laugh you out of the room.
Exactly.
Okay, so we have checking the math and preparing for the final statements. And what's the third objective?
It serves as a ledger summary. I want you to imagine like a medium-sized manufacturing business. Their ledger might contain hundreds, if not thousands, of individual accounts.
Right. We've got raw materials, payroll for 5 different departments, utilities, sales in different regions. It's a lot.
Historically, this meant massive, heavy, leather-bound books. Today, it means endless, massive digital spreadsheets.
I'm picturing this Victorian accounting room with stacks of dusty ledgers all the way up to the ceiling.
Right. Now, imagine the CEO walks in and says, "Hey, what are our total sales for the quarter?" Or, "How much cash do we actually have right now?"
You'd have to scramble.
It would be incredibly time-consuming to dig through those massive ledgers and tally up thousands of individual entries every single time. Management has a quick question.
Yeah, that would be a nightmare.
So, the trial balance summarizes all of that raw data onto a single, clean page. You only ever have to dive back into the deep ledger if you need specific, granular details about why a particular number looks weird.
Okay, I love that. It's like the ultimate executive summary. It's taking this massive 1,000-page novel and turning it into a 1-page book report.
That's a great way to put it.
Okay, but let's circle back to that terrifying midnight scenario we opened with, because this is the ultimate student doubt, or frankly, the business owner's doubt. Let's say I finish my trial balance. I add up the left side, I add up the right side. Boom, the totals match perfectly.
Okay.
Doesn't that mean my accounting is 100% flawless? I can just go home and sleep like a baby.
I really hate to burst that bubble, but no, not even close.
How is that even possible? If the math is perfect, how can the accounting be wrong?
This brings us to a phrase in the source material that is absolutely critical. You really have to sear this into your brain for the exam. An agreed trial balance establishes reasonable confidence that the work is free from clerical errors, but it is not a conclusive proof of total accuracy.
Okay, wait. Reasonable confidence, not conclusive proof. I mean, that sounds like a lawyer trying to avoid getting sued.
It does sound like legal jargon, but it's very careful wording for a specific reason. There are these terrifying things called invisible errors that completely bypass the mathematical check of the trial balance.
Invisible errors.
Yes, the math will balance perfectly, giving you this totally false sense of security while your business is actually bleeding money due to an error of principle.
Okay, consider the trap fully set. We will definitely come back to those hidden errors because I need to know how that happens. But before we talk about how it breaks, let's talk about how it's actually built. Timing-wise, when is this structural inspection supposed to happen?
Technically speaking, because the double entry rule applies to every single transaction the very millisecond it happens, you could prepare a trial balance at any given second of the day.
Right, because at exactly 2:04 p.m. on a random Tuesday, my debits should perfectly equal my credits.
Exactly. But practically, stopping the entire business to run a massive check every hour just isn't useful. So generally, businesses prepare it at monthly intervals.
Monthly makes sense.
Doing it monthly is smart because it limits your blast radius. If you find an error, you only have 30 days of transactions to dig through to find the needle in the haystack.
Much better than digging through a whole year.
Exactly. However, the absolute most critical, non-negotiable time to prepare it is at the end of a reporting period, whether that's month-end, quarter-end, or year-end.
Because that is right before you hand the numbers over to the government for taxes or to the public for investing. You absolutely have to verify the structural integrity right before you build the final roof.
Precisely. So let's roll up our sleeves and get into the actual construction. Let's talk about the rules of the game.
Let's do it.
If you are sitting down with a blank sheet of paper or opening a first spreadsheet, what does the physical format of a trial balance actually look like?
It's pretty straightforward, right?
It's elegantly simple, yeah. At the very top, you have the heading Trial Balance, and right beneath that, you must write the date in a very specific way, as at, and then insert the specific date. For example, Trial Balance as at December 31st.
As at, meaning this is a freeze frame. It's a photograph taken at exactly midnight on December 31st.
Exactly. It's not a range of time, it's a specific moment. Below that heading, you create 4 columns, just 4.
Okay, 4 columns.
The first column is narrow. It's just for the serial number, 1, 2, 3, 4, just to keep your long list organized. The second column is wide. That is the name of ledger account or the head of account, so things like cash, sales, rent, machinery.
Got it.
Then the third column is for the debit amount. And the fourth final column is for the credit amount.
Okay, so columns 1 and 2 are literally just a numbered list. A 5th grader could do that part. But columns 3 and 4, debit and credit. This is where the rubber meets the road, right?
The whole ball game.
This is the exam goldmine. And honestly, where real-world accountants probably pull their hair out, you have a list of 50 different account balances, and you have to know instantly, by pure instinct, which ones go in the left debit column and which ones go in the right credit column.
It is the make or break skill for the entire process. If you take a debit balance and accidentally write it in the credit column, your trial balance won't just be wrong, it will be off by double that amount.
Double. Wait, why double?
Because you subtracted from one side of the scale and improperly added to the other side, you widen the gap twice as much. So we really need to establish the absolute placement rules based on the source material.
Let's lay down the law.
The rule for the debit column, the left side, is that it contains the balances of all assets, all expenses, all losses, and drawings.
Okay, let me repeat that. Assets, expenses, losses, drawings.
Correct. Now, the rule for the credit column, the right side, is that it contains the balances of all liabilities, all incomes, all gains, and capital.
Liabilities, incomes, gains, capital.
Okay, as someone who loves a good memory trick, we need a way for you, our listener, to lock this in permanently.
I agree.
Because rote memorizing 2 random lists of 4 words while sitting in a super stressful exam room or panicking at a real job is just a recipe for a completely blank mind. We need a mnemonic. Let's look at the debit side again. Assets, expenses, losses, drawings. If we take the first letters, A-E-L-D.
AELC.
E-E-L-D. It sounds like the name of an angry Viking.
An angry Viking.
Yeah, imagine a giant Viking named A-E-L-D. He wields this massive battle axe and just storms into your fancy accounting firm and pillages all your debits. He gathers up all your assets, your expenses, your losses, and your drawing, and he just drags them all over to the left side of the room. AELD goes on the left.
Okay, that is incredibly vivid. I guarantee no one will forget the Viking AELD.
It works, right? It definitely works. Another common mnemonic that students use, which is a bit less violent, is deal versus girl.
Deal versus girl. How does that one work?
Deal stands for dividends, which is just the corporate version of drawings, expenses, assets, losses. Those are your debits.
Oh, okay.
And girl stands for gains, incomes, revenues, which is your capital side, and liabilities. Those are your credits.
Oh.
Whichever mental trick you choose, though, the crucial thing is deeply understanding why they sit where they do. It can't just be a party trick.
Yes. Let's definitely dive into the why, because memorization always fails when things get complicated in the real world. Let's take two things that seem very similar, capital and drawings.
Okay, good example.
They both relate to the human owner of the business, right? But capital goes on the credit side and drawings go on the debit side. Why?
This is a brilliant question, and honestly, answering it unlocks a core secret of all accounting. Let's start with capital. Capital is the money or assets that the human owner invests into the business to get it started.
Right. My seed money.
But here's the critical mind shift you have to make. We always do accounting from the perspective of the business entity itself, not the human owner.
Ah, the business entity concept. This is where you have to pretend the business is like a living, breathing alien organism that is completely separate from the person who created it.
Precisely. Imagine the business is a robot. The human owner hands the robot $100,000 to start operating. From the robot's perspective, it now has $100,000 in cash, but it owes that money back to the human who created it.
Oh, so it's a debt.
Yes. Therefore, capital acts as an internal liability for the business. The business owes the owner. And since our rule is that all liabilities are credits, capital is always a credit balance.
That is so incredibly clean. The business is basically saying, thanks for the cash, owner. I acknowledge my debt to you.
Exactly.
So if capital is a credit, then drawings, which is when the human owner pulls money OUT of the business to buy groceries or go on a vacation, must be the exact mechanical opposite.
Exactly. Drawings reduce that internal obligation. The human is taking their money back early. Since we increase the capital liability with a credit, we must decrease it with a debit. Therefore, drawings sit permanently in the debit column. AELD the Viking takes the drawings.
I love how logical that is when you just break it down into perspective of the business robot. Okay, let's apply these rules to some specific, really tricky scenarios that the source notes explicitly call out.
Let's do it.
Because examiners and real-world business transactions aren't going to just say asset. They're going to use tricky, specific vocabulary. Here's the first one. Dues from customers. Does that go in the debit or credit column?
This is a classic vocabulary trap. When we hear the word dues in everyday life, it usually sounds like an expense, really.
Yeah, exactly. You have to pay your union dues or your gym dues or your club dues. It feels like money leaving your pocket.
But you have to read the entire phrase, dues from customers.
Ah. It's not dues we owe, it's dues owed to us. The customers owe the business money.
Yes. In formal accounting language, this is a trade receivable. It is money that will legally flow into the business in the near future. It represents a future economic benefit. And a future economic benefit is the very definition of an asset.
An asset.
Since it's an asset, AELD the Viking claims it. It goes in the debit column.
Beautiful. Okay, next vocabulary trick from the text. Trade payables and bills payable.
The word payable is your anchor here. Payable simply means you, the business, owe someone else money in the future. It's a present obligation arising from a past event. That is the literal definition of a liability.
Like you owe the supplier for the coffee beans they dropped off last week.
Exactly. And following our rule, all liabilities go in the credit column.
Okay, here's one that consistently trips people up. Even experienced bookkeepers sometimes get confused by this one. Opening inventory.
Let's visualize it. What is inventory, actually? It is physical goods sitting in your warehouse waiting to be sold to customers. It is property owned by the business that holds tangible economic value. Because it holds value and can be converted into cash eventually, it is an asset. Therefore, opening inventory is a debit balance.
Okay, we've navigated the vocabulary traps, but now it is time for the granddaddy of all student confusions, the logic of returns.
Oh, yes. This is a big one.
Purchase returns versus sales returns. This is deeply counterintuitive for a lot of people. The source notes specifically say, purchases return account always shows a credit balance because assets go out. Can we unpack that phrasing? Because usually we think of purchasing things as an expense, which would be a debit.
You are hitting on a friction point that frustrates almost everyone learning this. The source material's phrasing here is rooted in the real account rule of traditional old-school accounting, which dictates a very simple mantra. Debit what comes in, credit what goes out.
Debit what comes in, credit what goes out.
To make this stick, you have to stop thinking about abstract numbers and start visualizing physical movement.
Okay, I'm ready. Paint the picture for me.
Imagine you own a high-end furniture retail store. You need inventory. So you purchase a massive truckload of solid oak dining chairs to sell to your customers. When that delivery truck backs up to your loading dock and your employees start unloading heavy boxes, physical assets are coming into your business.
Debit what comes in?
Exactly. The physical chairs are coming in, so the purchases account takes a debit.
Okay, my warehouse is full of beautiful chairs. I have a massive debit balance.
But wait, the next morning you open the boxes and realize 10 of the chairs have broken legs from the shipping process.
Yeah.
You can't sell broken chairs to your customers. So what do?
I complain.
You do. You box them right back up, you call the supplier, and you put them back on a truck to send them away. You are returning your purchases.
Okay, I see it.
Those physical broken chairs, your assets, are now physically leaving your warehouse. They're going out the door. The mantra is, credit what goes out. Therefore, the purchases return account must be a credit balance.
Oh, wow. That physical visualization is so helpful. You physically send the goods back out into the world, so you credit it. The trucks pull away, the goods leave, you credit.
It makes it tangible.
Okay, let's flip the scenario then. Sales returns. The source says it shows a debit balance because assets come. Walk me through the physical movement there.
It's the exact same logic, just in the reverse direction. You have a beautiful, non-broken dining table in your showroom. A customer buys it. When you make that sale, your delivery team loads the table onto a truck and drives it away to the customer's house. The physical asset just left your store.
Credit what goes out, so the sales account is a credit balance.
Precisely. But a week later, the customer calls. They say the table clashes with their wallpaper, or they just hate it. They demand a refund, and they bring the table back to your store. The table comes right back through your front glass doors. The physical asset is coming back in.
Debit what comes in.
Exactly. Therefore, sales returns is a debit balance.
Debit what comes in, credit what goes out. That is brilliant. If you are sitting in a sterile exam room staring at a multiple choice question about returns, just close your eyes and visualize the delivery truck.
Yeah.
Is the truck backing up to your warehouse, dropping things off? Debit.
Yes.
Is the truck driving away, taking things back to the supplier or out to a customer? Credit. If you visualize the truck, you will never get returns wrong again.
Basically a foolproof visualization.
Okay, so we know what a trial balance is. We know where to place the items based on AELD, the Viking, and the delivery trucks. But mechanically, physically, how do accountants actually pull these numbers out of a massive ledger and put them onto the summary sheet? Like, are they just dumping every single transaction onto this one page?
No, definitely not every transaction. This brings us to the methodology. The source material outlined 3 specific methods for preparing a trial balance. Let's start with method 1, the total method.
The total method.
Yes. And to understand this, let's invent a business. Let's say we have a guy named Xavier, and he runs a really busy downtown coffee shop called X & Co.
Okay, I'm picturing Xavier. Lots of espresso machines, lots of foot traffic, pastries.
Under the total method, Xavier's bookkeeper opens the massive ledger to the cash account. Over the course of the month, the coffee shop had hundreds of cash sales. The bookkeeper takes an old-school adding machine, adds up every single number on the debit side, all the cash flowing in, and gets a massive grand total, let's say $100,000.
That is a great month for Xavier.
It is. Then the bookkeeper goes to the credit side of the cash account. They add up every single cash payment Xavier made, paying the baristas, buying coffee beans, paying rent. They add up all those outgoing numbers and get a grand total, let's say $90,000.
Okay, so $100K came in, $90K went out.
Now, under the total method, the bookkeeper transfers both of those gross totals to the trial balance.
Right.
They write cash account on the list, they put $100,000 in the debit column, and they put $90,000 in the credit column. And they do this for every single account in the ledger.
Wait, let me pause right there. As a business owner, if I'm Xavier, I'm looking at this sheet and I'm honestly furious. Why would I want to see both totals? If I collected $100,000, but I spent $90,000, the only thing that actually matters to me and the only thing the bank cares about for my balance sheet is that I have a net cash balance of $10,000 left in the register. Why carry over all that messy, gross data? It just seems incredibly confusing.
You've hit on the exact reason why this method is almost completely extinct in the modern world. Its limitations are glaring. But we have to understand why it was ever used in the first place.
Okay, enlighten me.
The primary advantage of the total method historically was speed at the balancing stage. Before computers, bookkeepers had to do everything by hand. Calculating the net balance for hundreds of accounts takes a lot of time.
Oh, I see.
With the total method, you don't calculate net balances. You just total the columns, transfer the big numbers, and see if the grand total of the debit column matches the grand total of the credit column. If it matches, you know your ledger arithmetic isn't broken.
So it's basically a quick and dirty diagnostic test.
Exactly. The source material uses an illustration of X and Co to show this. In their example, the cash account has debit entries totaling 35,500 rupees and credit entries also totaling 35,500 rupees. Under the total method, you just throw 35,500 on the debit side and 35,500 on the credit side.
That seems so bloated.
It is. When you do this sloppy method for every account, X and Co's trial balance ends up with a massive bloated total of 119,100 rupees on both sides.
But as I said, I can't build a balance sheet with that because it doesn't tell me my net cash. I have to go back and do the math anyway. So I assume method 1 is not the fan favorite today.
No, it is rarely used in modern practice. Which leads us to method 2, the balance method.
Let me guess, this is the gold standard.
This is the undisputed king of accounting methods. Under the balance method, the bookkeeper does the extra work inside the ledger first. They calculate the net balance of each account, and only those pure net balances are carried forward to the trial balance.
So back to Xavier's coffee shop. Instead of carrying over $100 and $90, the bookkeeper just does the math right there. 100 minus 90 is 10. They write cash account, and they put a single $10,000 in the debit column, and nothing goes in the credit column for cash.
Correct. Or, looking at the sources X and Co example, the debit total was 35,500, but the payments out were only 28,000. So the net balance is a 7,500 debit. On the trial balance, you just write 7,500 in the debit column.
And when X and Co does that for all their accounts, their trial balance total drops from that bloated, useless 119,100 down to a much leaner, highly accurate 44,000 rupees.
Yes. And here is exactly why the balance method is the king. Because this trial balance only contains the pure netted out realities of the business. It feeds directly into the trading account, the profit and loss statement, and the balance sheet.
You literally just copy-paste.
You literally just lift the numbers off the trial balance and drop them right into the final financial statements. This is the method used by accountants and software systems everywhere.
It's clean, it's efficient, and it tells the true story. Makes total sense. Now, what about method 3? The outline mentions something called the total and balance method.
It's exactly what it sounds like. It's a Frankenstein combination of the first two. You create a giant trial balance with 6 columns, 2 columns for the gross totals, 2 columns for the net balances, plus the serial number and account name.
Why would anyone voluntarily subject themselves to a 6-column nightmare? That sounds awful.
It's a belt and suspenders approach. It provides maximum visibility. You get the immediate raw arithmetic check of the gross totals, plus you have the netted balances sitting right next to them ready for the financial statements. It leaves no stone unturned.
I guess that's thorough.
It is, but honestly, in a world where accounting software calculates all of this instantly in the background, it's mostly a theoretical construct now. If you're sitting for an exam, definitely know what it is, but know that the balance method is the practical reality of the profession.
Got it. Balance method is king. Okay, now we arrive at the most fascinating and frankly the most dangerous part of this entire discussion. The illusion of perfection.
Yes, the limitations and the hidden errors.
Let's circle back to that midnight scenario from the opening hook.
The flawless math.
Right. I'm Xavier, the coffee shop owner, or I'm an accounting student. I just finished a massive month-end close. I add up the columns. My debits equal my credits down to the penny. 0 equals 0. The trial balance tallied perfectly. I feel incredible.
Time to celebrate.
Right. But you're telling me my books could still be a complete disaster and my business might be failing without me knowing. How is that mechanically possible?
It is possible because of the very nature of the trial balance. You have
Yeah.
to understand what it actually checks and what it is completely blind to. The trial balance only checks one rule. Does
Mm.
every debit have a corresponding credit of equal value? That's it.
So it's just checking the weight.
Exactly. It is a scale checking weight. It doesn't know what you put on the scale, only how much it weighs. So if you make a mistake that still obeys the double entry weight rule, the trial balance will remain blissfully ignorant. It will tally perfectly.
So it verifies the symmetry, not the reality.
That is a perfect way to summarize it. The source material outlines 5 specific hidden errors that completely bypass the trial balance. You must understand these conceptually, not just memorize a list. I like to group them into 3 categories: errors of pure forgetfulness, errors of human clumsiness, and the most dangerous one, errors of accounting ignorance.
I love that breakdown. Let's start with pure forgetfulness. What falls under that?
The first one is complete omission. This is exactly what it sounds like. A transaction happened in the real world, but it was just never entered into the accounting journal at all.
Let me give you a scenario. I go to an office supply store. I buy a $50 stapler with cash straight out of the register. I shove the paper receipt in my pocket. I put the stapler on my desk. I go home. I wash my pants. And the receipt is totally destroyed. I forget it ever existed.
That is a perfect example. From the accounting system's perspective, nothing happened. Your real-world cash went down and your real-world expenses went up, but the system doesn't know that. Because you completely omitted it, you missed a debit of $50 and a credit of $50.
Right.
Since you missed both equally, the scales are still balanced. The trial balance math still works perfectly. It has no idea you own a new stapler or that you are secretly missing $50.
Terrifying, because that money is just totally unaccounted for, but the math says everything is fine. Okay, what is the second error of forgetfulness?
This one is an omitted ledger posting. It's similar, but it happens at a different stage. Imagine the physical desk of a bookkeeper. You wrote the stapler purchase perfectly into the daily journal. Debit office supplies, credit cash. The journal is correct.
Okay, so step 1 was successful.
But then it comes time to physically transfer those numbers from the journal into the massive ledger books. You are looking at the journal. You are about to write the numbers in the ledger. Suddenly your phone rings. It's an angry client. You spill your coffee. You deal with the crisis. When you sit back down, you lose your place, and you completely skip transferring that stapler entry into the ledger.
Wow. So again, if you omit both the debit and the credit from the final ledger, it's just like the first error. It's missing equally from both sides of the scale, so the trial balance still tallies perfectly.
Correct. It's an omission at the posting stage rather than the initial recording stage, but the result is exactly the same. Flawless, balanced math, hiding missing data. Now let's move to the second category. Errors of human clumsiness.
Things we do when we're tired or rushing.
Exactly. The first one here is wrong amount in both columns. Let's say your coffee shop paid monthly rent of $5,000. You sit down at the computer to record it, but you are exhausted. Your finger slips on the keyboard. Instead of $5,000, you record a debit to rent expense for $500 and a credit to cash for $500. You just dropped to zero.
And because the computer system just checks if the debit equals the credit. $500 equals $500. The trial balance is totally happy.
The trial balance is thrilled. It tallies perfectly. But your landlord is definitely not happy that you only paid $500. And internally, your net profit is going to look wildly artificially high because you hid $4,500 of rent expense. The symmetry of the mistake protects it from the trial balance.
Okay, what is the other clumsy error?
Double posting. This is the exact opposite of the omission we talked about earlier. You are at your desk, you post the $5,000 rent payment to the ledger, debit rent, credit cash. Then you get distracted by a coworker asking a question. You turn back to your desk, you forget you just did it. You post that exact same $5,000 rent payment to the ledger a second time.
Oh man, so you put $5,000 on the debit side and $5,000 on the credit side twice. The scales are perfectly balanced again, but now your expenses are massively inflated.
Yes. Your trial balance adds up perfectly, but your business reality is completely distorted.
Okay, so we have forgetfulness and clumsiness. Both result in balanced math, but bad data. Now let's talk about the third category, which you called the most dangerous, errors of accounting ignorance.
This is the error of principle. Sometimes it's called an error of commission depending on the specific flavor, but the core issue is the same. You put the right amount of money on the right side of the scale, but into the completely wrong bucket.
Walk me through a scenario where this actually happens.
Let's go back to Xavier's coffee shop. Business is booming. So Xavier decides to start a catering service. He buys a brand new, custom-painted delivery van for $40,000 cash.
Nice investment.
Now, a delivery van is a long-term asset. It holds value and will benefit the business for years. The correct accounting entry is to debit the asset account called vehicles. But Xavier's new bookkeeper doesn't really understand accounting principles. They see a bill related to a van, and they debit an expense account called motor expenses.
Okay. Wait, let's pause and ELI 5 this for a second. Explain it like I'm 5. Why does it matter so much if I call the van an expense versus an asset? The $40,000 left Xavier's bank account. Either way, right? The cash is gone. Why is this so dangerous?
It is dangerous because of how those two different buckets affect the final roof of our house, the final financial statements. If you capitalize it as an asset, the $40,000 sits safely on your balance sheet as wealth you own. It doesn't hurt your current year's profit. But if you classify it as an expense, that entire $40,000 is immediately deducted from your revenue on the profit and loss statement for that year.
Oh, wow.
Exactly. Let's say Xavier's coffee shop made a true profit of $30,000 that year. If the bookkeeper incorrectly expenses that $40,000 van, suddenly the profit and loss statement shows a $10,000 loss for the entire year.
That's drastic.
Xavier looks at his statements and thinks his business is failing and bankrupt, all because the bookkeeper put the number in the wrong bucket.
And what does the trial balance say about all this?
The trial balance says, hey, I see a $40,000 debit and a $40,000 credit to cash. The math is perfect. Good job, everyone. The trial balance is completely blind to the fact that you just destroyed the financial reality of the business.
That is wild. The math works, but the business looks bankrupt on paper because of a categorization error. That really proves why you can't just rely on a mathematical tally.
Okay, is there any other way the trial balance can be fooled?
There is one more, and it is basically a freak accident. It's mentioned in the true-false section of the source material, and it is called a compensating error.
A compensating error. That sounds like two wrongs somehow magically making a right.
That is exactly what it is. It is when two completely unrelated mistakes happen to cancel each other out mathematically. Let's say on a Monday, you are rushing and you accidentally overcast your sales account by $100. Overcasting means you added it up wrong. So you have a credit error of $100. Your trial balance is now unbalanced. The credit side is too heavy.
So the alarm bell should be ringing. The trial balance is doing its job in catching the error.
But then on Thursday, a completely different bookkeeper is working on the rent expense account. They misread a receipt, and they accidentally overcast the rent expense by $100. That's a debit error of $100.
Wow. Oh, yes. The $100 mistake on the debit side perfectly, mathematically cancels out the $100 mistake on the credit side. The scale balances.
A match made in accounting hell. The trial balance looks at those two completely unrelated massive mistakes and says, looks perfectly balanced to me. This is a brilliant exam trap. If a professor asks, a trial balance will always tally in case of compensating errors, true or false?
The answer is absolutely true. And this is exactly why the source text is so pedantic about its language. Agreement is not conclusive proof of accuracy. The trial balance is a vital mandatory structural check, but it is not a substitute for human intuition, paying attention, and rigorously auditing your own books.
Okay, let's pivot. We've spent a lot of time talking about what happens when the trial balance tallies perfectly but is secretly hiding disasters. Let's talk about the other nightmare scenario, the one where it explicitly tells you something is wrong and you are totally out of time.
The midnight crisis.
Yes. Let's paint the picture. It's late at night. The finalized financial statements are due to the board of directors and the bank tomorrow morning at 8 a.m. You add up the columns on your trial balance. The credit side total is $100,000. The debit side total is $98,500.
You're short $1,500 on the debit side.
Exactly. You recount, you run the adding machine again, you comb through the massive ledger looking for the missing $1,500. You cannot find it anywhere. It is 3 a.m. The trial balance is screaming that your math is wrong, the scales are tipped. What do? You just call the CEO and say, sorry, we can't issue the financial statements, the business is paralyzed.
Well, in the theoretical world of a classroom, you would stay up for 3 days straight until you found the error. But in the real world, a business cannot grind to a halt because of a missing $1,500 discrepancy. You have hard deadlines. You have investors waiting. So the accounting profession has created a built-in emergency release valve. We introduce a temporary fix called a suspense account.
A suspense account? That is such a dramatic name. It literally sounds like a thriller movie. You are sitting in suspense, waiting to find out who stole the missing money.
The drama is very real at 3 a.m. The suspense account is essentially a mechanical placeholder. It's a digital sticky note. In your scenario, The debit side is too light by $1,500. To force the trial balance to balance so you can proceed to the next step, you artificially inject a brand new fake account onto the list. You call it suspense account, and you give it a debit balance of exactly $1,500.
Okay, wait. I'm putting on my student hat and my business ethics hat right now. Isn't that just sweeping dirt under the rug? It feels like cheating. You can't just invent a fake account and throw a random number into it just to make the math work so you can go home.
It feels incredibly uncomfortable, which is why there are incredibly strict rules around how it is used. As the source material explicitly notes, it is strictly a temporary account. It is not a permanent hiding spot for sloppy bookkeeping or fraud.
Okay, so how does it actually resolve then?
It allows the accountant to generate the final financial statements on time so the business can function. That $1,500 suspense balance will actually visibly appear on the balance sheet temporarily. But the very next morning, the accountant's sole mission in life is to audit the books, find where that $1,500 actually belongs, and post adjusting journal entries to move the money to its rightful place. And that clears out and closes the suspense account down to zero.
Okay, so it's not sweeping it under the rug. It's putting it in a bright red glowing box in the middle of the room that says, "We have a problem to fix."
Exactly. It highlights the error while allowing the machinery to keep moving. And this concept is heavily tested. In the true-false section of your exam, you might see a statement like, "Suspense account opened in a trial balance is a permanent account." You must know that is unequivocally false. It is always temporary.
And I imagine in practical long-form exam questions, they might give you an untallied trial balance, and your instruction is to draw up a corrected one, forcing you to debit or credit the residual errors to a suspense account.
Yes, and the mechanical rule is simple. You plug the hole wherever the hole is. If the debit side is smaller, you put the suspense account on the debit side to prop it up. If the credit side is smaller, you put the suspense balance on the credit side. Use it to balance the scales temporarily while you investigate.
This has been an incredibly illuminating deep dive. We've gone from the raw bricks of the journal to the structural inspection of the trial balance. We found a few invisible termites hidden in the wood, and we learned how to temporarily patch a hole in the roof with a suspense account to pass the inspection at the midnight hour. Let's move to our chapter recap and lock this in for our listeners who might be walking into an exam room or a boardroom very soon.
Absolutely. Let's solidify the key takeaways from Unit 3. First and foremost, the trial balance is the critical third phase of the accounting process, acting as the bridge between the ledgers and the final financial statements.
Second, remember the defining trap. It is a statement, not an account. It doesn't have a life of its own. It's a summary snapshot taken on a specific date.
Third, while there are historically 3 methods of preparation, the balance method is the absolute king. By extracting only the netted balances, it provides the clean data that feeds directly into the profit and loss and the balance sheet.
Fourth, and this is where the money is made or lost. That tallied trial balance is a great sign, establishing basic arithmetic accuracy, but it is never conclusive proof of total accuracy.
Because it is entirely blind to the invisible errors. It cannot see complete omissions. It cannot see when you post the wrong amount twice. It gets tricked by compensating errors that cancel each other out. And most dangerously, it cannot tell if you committed an error of principle, like expensing a massive asset.
And fifth, when the scales just won't balance and you have a hard deadline, you plug the mathematical difference into a temporary suspense account. But remember, it's a glowing red emergency flare, not a permanent rug to sweep your mistakes under. You have to fix it the next day.
And finally, let's do one last review of our memory tricks for placing items, because if you get the placement wrong, everything else falls apart.
Yes, the Viking rule. AELD, assets, expenses, losses, drawings. Imagine an angry Viking named AELD dragging all those items to the left side of the room. They go on the debit side.
Which logically leads liabilities, incomes, gains, and capital for the right, the credit side.
And if you face a tricky question on returns, don't try to memorize it. Close your eyes and visualize the physical delivery truck. Purchase returns. You are boxing up broken shares and sending them out of the warehouse. Credit what goes out. Sales returns. The angry customer is bringing a table back in through your front door. Debit what comes in.
Debit what comes in, credit what goes out. It is a flawless physical visualization.
I can literally see the delivery truck in my mind right now. It makes it so much less abstract. Okay. As we always do, we want to end with a final provocative thought, something for you, the listener, to mull over long after the session ends and maybe debate with your professors or colleagues.
Think about this. We just spent this entire session discussing the grueling arithmetic of the trial balance. making sure debits perfectly equal credits, catching slip-of-the-finger calculation errors, and deploying a suspense account when the manual math fails at 3 a.m. But if you look at the real business world today, modern accounting software like Xero, QuickBooks, or massive enterprise ERP systems literally will not allow you to post an unbalanced journal entry.
Right. If I try to debit $500 and credit $50, the software turns red and won't even let me hit the save button. The computer automatically prevents arithmetic errors. It guarantees that debits always equal credits.
Exactly. So the provocative question is this: does the traditional trial balance even matter anymore? If the software guarantees arithmetical accuracy by default, is this entire statement obsolete? Or does it mean something much more profound for your career? Does it mean that the modern accountant's only real job now is hunting down those invisible errors of principle, like Xavier's bookkeeper putting the van in the expense bucket that the computer's too blind to see?
Whoa. That flips everything on its head. The software might be a perfect, flawless calculator, but it doesn't have human judgment. It doesn't know what a transaction is in the real world, only how much it is.
Precisely. The machine can check the math faster than we ever could, but only the human can check the reality.
That's a profound shift in how we view the profession. The structural inspection isn't about counting the bricks to make sure none are missing anymore. It's about using human intuition to make sure the builder didn't accidentally use drywall for the foundation. If you understand that distinction, you don't just understand how to pass the exam on Unit 3, you understand the future of the entire profession. Thank you for diving deep with us today. Keep studying, keep visualizing those delivery trucks. Watch out for AELD the Viking, and we will catch you in the next session.
So imagine you've just launched like a brand new small business. For the sake of having a really concrete visual for this deep dive, let's say it's a boutique artisanal coffee roastery.
Oh, I love that. Great visual.
Right. And in those first few weeks, everything is just wonderfully, beautifully simple. The scale is so small that your entire accounting system can basically live in one single notebook.
Yeah, exactly. You sell a bag of beans to a walk-in, you write it down.
You run to the store for some pens, you write it down, you pay your delivery driver in cash. It all goes into that exact same journal.
And honestly, that's completely manageable at that early stage. Like at that micro scale, a single chronological journal is actually really straightforward.
It feels good, right?
Yeah.
Like you have total control.
You do, because the volume is so low, you can literally just sit down with your morning coffee and read the entire financial history of your business. It's a totally linear narrative.
But okay, let's fast forward 2 years. Your roastery hasn't just survived, it's, exploded. The narrative is definitely not linear anymore.
No, not at all. You're not just doing single bags for walk-ins now.
Exactly. You're shipping these massive wholesale orders to 50 different cafes. You're buying raw green beans by the shipping container from like 3 different continents.
You've got payroll for a dozen employees now.
Right. Payroll, utility bills for industrial roasters, fleet maintenance, and suddenly that one central notebook is not comforting anymore. It's a chaotic, anxiety-inducing bottleneck.
It's the absolute definition of an operational nightmare. I mean, if your business is scaling and you're still forcing every single financial event through one entry point, the system is going to choke.
It has to, right?
Yeah. If you just want to know how much you owe your raw bean suppliers, you can't just flip to a page. You have to sift through thousands of unrelated transactions.
Skipping the electricity bill, ignoring the petty cash for donuts.
Exactly. Just to find that specific supplier data, it's totally unsustainable.
Which brings us perfectly to our mission for today's deep dive. We're looking at this stack of foundational accounting literature to master how businesses actually scale their record keeping.
Without collapsing into total chaos, which is the key.
Exactly. We're exploring this core concept of subsidiary books. And I want to set the tone right now. We aren't just memorizing terms today.
No, we're looking at the actual underlying logic of business operations.
Right. So whether you're an entrepreneur trying to figure out why your bookkeeping is a mess, or a student prepping for a huge exam, we're breaking down the exact mechanisms that keep commerce functioning.
The architecture we're discussing today is actually incredibly elegant. We're going to look at how businesses break their data into specialized streams.
We'll define what these books are.
All right.
And the historical problem they solve.
Yeah, we'll walk through the whole arsenal of these registers, examine the hierarchy between subsidiary and principal books, and look at the non-negotiable rules for the major ones.
Especially the purchases book
Right.
and the return systems. Because misunderstanding those rules creates massive blind spots and, like, absolute audit nightmares.
Oh, huge nightmares. So let's start at the root of the problem.
Yeah, we established the one big journal fails. But why, fundamentally, does it fail?
Hmm.
It's not just the sheer number of transactions, is it?
No, it's really about the nature of those transactions. The fatal flaw of the single journal is that it ignores the reality of commercial repetition.
Repetition. Okay, what do you mean by that?
Well, if you step back and look at a busy firm, the vast majority of their transactions aren't unique one-off events. They fall into these highly predictable categories.
Like they're just doing the same things over and over.
Exactly. A business is constantly doing three main things. They're receiving and paying cash, purchasing inventory, and selling that
Of
inventory.
course, a continuous loop. Buy the beans, pay for the beans, sell the beans, collect the cash.
Over and over. And in a traditional, centralized, double-entry journal, the classic Italian method, every single one of those actions requires a complex, multi-line entry.
Right, you have to write the date, the debit, the credit, a whole description, the amounts.
Yeah, and doing that for 100 separate sales in a single day, it creates an immense amount of redundant manual labor.
So, as businesses grew, I'm guessing especially during the Industrial Revolution, it needed a way to process data in parallel, not sequentially.
That is a perfect way to frame it. The profession developed what became known as the practical system of bookkeeping.
Also known in the sources as the English system, right?
Yes. So instead of cluttering up one massive journal with repetitive entries, they introduced the concept of the book of original entry, or the book of prime entry.
Prime entry, meaning like the absolute first place a transaction is born in the accounting ecosystem.
Exactly. In this system, when something happens, it's recorded first in a dedicated specialized register. It completely bypasses that central journal.
So a credit sale goes straight to a credit sales book. Cash goes to a cash book.
You got it.
Okay, but I can hear a fundamental objection forming for anyone studying accounting. The bedrock rule is the double entry system, right? Every debit needs a credit.
Oh, absolutely. The golden rule.
So if we're skipping the main journal and just writing a list of sales in a notebook, aren't we breaking that double entry rule?
It's a very natural concern, and it's a huge misconception we need to clear up. The double entry system is never abandoned. It is still the absolute law.
Okay, so how does that work if we're just making lists?
What the subsidiary system does is introduce a strategic delay. It's fundamentally a data batching process.
A batching process, so we accumulate the data first.
Exactly. Think about modern computers. They don't always process every packet of data the millisecond it arrives. They queue similar packets, batch them, and process them in one sweep.
Oh, I see. So subsidiary books are like 19th century data batching.
That's exactly what they are. Instead of doing the complex double entry immediately for every single coffee bean purchase, we group them all in the purchases book.
We just make a list for the whole week or month.
Right. Then at the end of that period, we take the aggregate totals and post them to the main ledger accounts.
So the double entry absolutely still happens. We just wait and do it in bulk.
It happens, but with radically increased efficiency. It takes the friction out of daily data entry.
It reminds me of like warehouse logistics. If a truck arrives with 1,000 small boxes, you don't walk each box to its final shelf one by one.
No, that would take forever.
You put them in a staging area on the loading dock, group them, and then move the whole pallet at once. So the subsidiary book is that staging area.
That is a highly accurate analogy. They are organizational staging areas that keep the main ledger from becoming totally chaotic.
Okay, so let's look at how a business designs these staging areas. According to our sources, what are the specific buckets they use?
A well-structured business typically uses an architecture of 8 specific subsidiary books.
8 books. Okay, let's walk through them.
We'll start with the lifeblood of the business.
Yeah.
Cash. Book number 1 is the cash book. This is the staging area exclusively for receipts and payments of cash.
And crucially, in modern accounting, this includes bank transactions too, right?
Yes, absolutely. Hard currency and digital bank transfers all live in the cash book.
Makes sense. It tracks all the liquidity. What's next?
Moving to operations, we have inventory. Book number 2 is the purchases book. And I want to plant a flag here because the definition is incredibly strict.
Oh, the exam traps. I know this one is full of them.
It really is. The purchases book is strictly for recording the credit purchases of goods dealt in by the business or materials used for manufacturing.
Credit purchases of goods. We are definitely going to do a deep dive into those words, credit and goods, later. So book number 3.
Book number 3 is the necessary counterpart. The purchase returns book. Supply chains aren't perfect, you know.
Yeah, stuff arrives damaged or it's the wrong spec.
Right. And you can't just cross out the original entry. You need a dedicated system to track the reversal.
Okay, which brings us to the revenue side. Book 4.
Book 4 is the sales book. It's the exact mirror image of the purchases book. It's strictly for credit sales of the goods you deal in.
So shipping a massive wholesale coffee order on a 30-day invoice, that goes here.
Exactly. And just like supplier returns, you have customer returns. So book number 5 is the sale returns book.
For customers bringing things back that they bought on credit. So that's 5 books. Cash, purchases, purchase returns, sales, sales returns.
Right, which covers like 95% of daily operations.
What are the remaining 3?
Books 6 and 7 deal with a specific type of financial instrument. Number 6 is the bills receivable book.
Because businesses don't just use open invoices, right? Sometimes they use formal credit instruments.
Yeah, promissory notes, bills of exchange, or, as the sources mention, hundies.
Oh, let's pause on hundies. That's a fascinating piece of financial history. It's essentially a traditional bill of exchange used in India, right?
Yes, it's an indigenous instrument used for centuries in the subcontinent based on high-trust merchant networks.
So if you receive one of these formal, legally binding promises to pay, it needs its own tracking system.
Because they have maturity dates and represent guaranteed future cash flows, so they go in the bills receivable book.
And the mirror image of that is book number 7, I'm guessing.
Correct, the bills payable book. If your roastery issues a formal promissory note to a shipping company, promising to pay in 60 days, it goes here.
Okay, 7 specialized buckets. But commerce is weird. What if we trade 3 tons of coffee beans for a used delivery van? It's not cash. It's not a normal credit purchase.
And that exact scenario is why we have book number 8, the journal proper, sometimes called the general journal.
The ultimate catch-all bucket.
Exactly.
Oh.
If a transaction fundamentally cannot fit into the other 7 books, it gets journalized here.
The island of misfit transactions. I love it. Before we move on, I want to clarify a small terminology quirk from the sources.
The journal versus book debate.
Yes. The texts note that journal and book are used interchangeably here.
It's a critical point. The purchases book is exactly the same thing as the purchases journal. It's just different historical dialects.
Okay, don't let the nomenclature confuse you. Got it.
Yeah.
So we have our 8 books, but to understand the architecture, we need to look at the hierarchy.
Yes, there's a very deliberate line drawn between subsidiary books and principal books.
Let's define those 2 camps.
Subsidiary books are where transactions are first recorded. They are the staging areas, designed for data capture, not final reporting.
And the principal books.
Those furnish the actual aggregated information needed for the trial balance and the financial statements. They are the final destination.
And the undisputed king of the principal books is the ledger. Right.
Correct, the master book with every formalized account. But if you look closely at the charts in our sources, there's a fascinating anomaly.
Yeah, the cash book. It listed under subsidiary books, but then it also listed under principal books.
It does.
But wait, you just said subsidiary is the temporary staging area and principal is the final destination. It can't be both, can it?
It absolutely can, and this is one of the most elegant concepts in accounting. The cash book serves a dual purpose. It collapses 2 processes into one.
Walk me through how that actually works.
Sure. A customer hands you a $100 bill. You write it down immediately in the cash book. Because it's the book of original entry, it's functioning as a subsidiary book.
Okay, I follow the data capture part.
But normally, you'd later have to take totals from a subsidiary book and transfer them to a ledger account. The cash book, however, is structurally formatted exactly like a formal ledger account.
Oh, with a strict debit side and a strict credit side.
Yes. It's so rigorously maintained that accountants just use the cash book as the actual formal cash account for the business.
So you completely skip the batching step for cash. You don't copy the totals into a separate cash account in the master ledger.
You bypass that redundancy entirely. When you prepare the trial balance, the balances come straight from the cash book, so it qualifies as a principal book too.
That is brilliant. It lives in both camps simultaneously. And the sources show businesses don't just use one generic template for this, right?
Right, the system is adaptable. There are 4 main variations of the cash book.
Let's quickly hit those. The first is the simple cash book.
Very basic. Single column format, tracking hard cash in and out, good for a tiny cash-only operation.
But the moment you do B2B, you need the second variation.
The cash book with a discount column, also called a 2-column cash book. Businesses often give cash discounts for early payment.
Pay in 10 days, get 2% off.
Exactly. Since the discount is tied to the moment the cash is received, it's way more efficient to track it right next to the cash entry.
Makes total sense. Keep related data together. What's the third?
The 3-column cash book. Cash, bank, and discount columns. This is the standard for most modern businesses.
Tracks physical cash, digital money, and discounts all in one unified register. And the fourth one, the petty cash book. Why separate that?
It's about executive focus. A massive firm might write million-dollar checks for materials, but they also buy postage stamps and breakroom tea.
You don't want the CFO cutting a check for $5 a tea.
And you don't want hundreds of $5 entries cluttering the main cash book, so they use an impress system.
I could give a junior clerk a small fixed amount, right? Like $200.
Yes. The clerk logs minor expenses in the petty cash book. At month end, the main cashier reimburses the exact amount spent.
And just records that one single reimbursement in the main cash book. That's a great delegation of burden.
It isolates the microtransactions.
Okay, let's pull back. If I'm an entrepreneur, setting up 8 books sounds daunting. It sounds like a lot of bureaucracy. Why do this?
The literature outlines 5 massive structural advantages, and these are core principles of operational management. First is the division of work.
Back to our coffee roastery. With one master journal, only one human can physically write in it at a time.
Right. You've created an artificial bottleneck. 4 clerks are standing around while one person frantically writes.
But with 8 books, you have true parallel processing.
Exactly. One person manages cash, another logs invoices, a third records shipments. You unblock the workflow.
Which leads to the second advantage, specialization and efficiency.
Yes. When a clerk exclusively handles the sales book, they develop deep expertise. They memorize addresses, product codes, credit terms.
No context switching between a utility bill and a client invoice.
Context switching destroys productivity. Specializing makes them incredibly fast, and their error rate drops.
Which creates the third advantage, saving of time.
Because you process data in parallel, the whole accounting cycle is compressed significantly.
Faster data is great, but what's the strategic value? That's the fourth advantage, right?
Availability of information. Delayed data is useless data. If management urgently needs to know total credit sales for November to hire a new salesperson.
In a single journal, that would take days to calculate manually.
But with subsidiary books, you just open the sales book, look at the final total at the bottom, and hand them the figure in 10 seconds.
Instant access to actionable data. That alone justifies it. And the final advantage.
Facility and checking and establishing internal controls. Finding an error in a single journal is a nightmare.
But with categorized records, you can verify sales against inventory, cash against bank statements. It isolates variables.
It isolates variables, and crucially, it safeguards against fraud. Segregation of duties.
If one person handles cash, another does sales, and another does the ledger, they'd have to collude to embezzle.
Exactly. It inherently builds checks and balances into the workflow.
So the 5 advantages: division, specialization, saving time, availability, facility and checking. I like to use a mnemonic for the exams. Don't stress, save all files. DSAF.
Oh, that's a clever way to remember them.
Right. Okay, let's move into the practical mechanics. We're doing an intensive deep dive into one specific staging area, the purchases book.
Okay, let's do it.
What are the absolute, non-negotiable rules for what goes in here?
The definition is incredibly strict. The purchases book is only for the credit purchases of goods dealt in by the business.
I really want to highlight 2 words, credit and goods, because this is where the exam traps are. Let's look at the first trap, the cash exception.
A classic mistake.
Say our coffee roastery runs out of custom retail bags. We run to the local supplier, grab 500 bags, and pay $300 in cash on the spot. Does that go in the purchases book?
No, it absolutely does not. The very first word of our definition is credit. Because you paid cash immediately, it completely bypasses the purchases book.
It goes directly into the cash book. But why is the system so rigid about that? They are materials for the business.
Because the purchases book isn't just tracking inventory, it's tracking liability. It's a definitive record of who you owe money to.
If you clutter it with settled cash transactions, it ruins the liability tracking.
Exactly. If money changes hands immediately, it belongs in the cash flow engine.
Rule 1. Cash bypasses the purchases book. Now the sneakier pitfall, the asset exception.
This one catches almost everyone off guard.
We need a new delivery van for the roastery. We buy it from a dealership entirely on credit. We haven't paid a dime yet. Pure credit purchases book.
Absolutely not. Look at the second keyword, goods. In accounting, goods doesn't mean just anything you buy.
Right. It strictly means the inventory you actively trade in or direct raw materials.
For your roastery, goods means coffee beans and packaging. A delivery van is not inventory.
We aren't in the business of selling vans. It's a fixed asset.
Exactly. Same goes for a new industrial roaster or office desks on credit. Capital assets cannot go in the purchases book.
What happens if a bookkeeper messes this up and logs a $50,000 van in the purchases book?
It creates a catastrophic distortion. The purchases total calculates gross profit. If you dump a $50,000 asset in there, it artificially inflates your operational expenses.
It makes it look like selling coffee is losing massive amounts of money.
It corrupts the data management uses for pricing. Assets must be separated from operational inventory.
Okay, so if we buy a van on credit, where does it go? Not cash, not goods.
It goes to our anomaly handler, the journal proper.
Fantastic summary. Cash equals cash book, asset equals journal proper. Only pure credit purchases of goods get into the purchases book.
Exactly.
So, assuming a transaction actually qualifies, let's open the book. What's the formatting?
Historically, it has specific columns: date, particulars, inward invoice number, ledger folio, details, and amount.
What goes in particulars?
The exact legal name of the supplier, because we need to know who we owe, and a narrative of the items, quantities, and base rates, like 50 bags of Colombian at $100 per bag.
Okay, then we have two financial columns, details and amount. Why two?
Because B2B pricing is complex. The details column is your internal scratch pad for the math.
Let's walk through the example from the text. We're a stationery business. February 1st, we order from Ms. Brown & Co.
We buy 5 gross of pencils at 100 rupees per gross, and 1 gross of registers at 240 rupees per dozen.
Okay, unit conversions in the details column. Pencils. 5 times 100 is 500. Registers. A gross is 12 dozen. So 12 times 240 is 2,880.
Right, so in the scratch pad we have 500 and 2,880. Subtotal is 300 and 300.
But the base price is rarely the final price.
Exactly. You add freight charges and, crucially, deduct any trade discount offered by the supplier.
Let's pause on trade discount. How is it different from a cash discount?
A trade discount is a wholesale pricing mechanism, is a percentage off the catalog price based on volume. Buy 10,000 notebooks, get 15% off.
And how is it recorded?
It's not formally recorded as a separate expense account in the ledger. The deduction happens purely in the details scratch pad.
Okay, so say Brown & Co. gave us a 10% trade discount on our 3380 subtotal,
We calculate 10% of 3380, which is 338. Subtract that.
leaving a net figure of 342.
And that 3042 is the only number that moves to the final right-hand amount column. It's the official liability.
Let's do a really quick second one to cement it. February 4th, the Paper Co.
5 reams of white paper at 100, 10 reams of ruled paper at 150, plus a 10% trade discount.
Scratch pad. 5 times 100 is 500. 10 times 150 is 1,500. Subtotal 2,000, less 10% discount of 200. Net liability is 1,800.
Perfect. That 1,800 goes in the amount column.
And at the end of the month, we just sum up that final amount column, right?
Exactly. That grand total is your aggregate credit purchases for the period.
Which brings us to the most elegant part. We have this staged data. How do we weave it into the main ledger to satisfy the double entry rule?
The batching architecture pays off in 2 steps. Step 1. Manage the individual supplier relationships.
The entities we actually owe money to. Creditors.
Yes. Our liability to them increased, so we must credit their specific accounts. We open the ledger, find Brown & Co., and credit them 342. We find the Paper Co. and credit them 1,800.
Okay, step 1 is distributing microcredits. But if I'm crediting 20 suppliers, my double entry alarm is ringing. I need an equal debit. Do I write 20 individual debits?
You absolutely do not. Step 2 happens at the very end of the month. We take that single aggregated grand total from the purchases book
and post it as one massive debit entry to the main purchases account in the general ledger.
Yes, because purchases represents an expense, tracking an inflow of goods, which is a debit balance.
The symmetry is amazing. The sum of the microcredits exactly equals the macro debit. You cut the data entry work in half.
It's flawlessly efficient.
But the real world is messy. Goods break. Which brings us to returns. Why do we need a separate track just for sending things back?
Because returns are a huge part of daily operations. Wrong specs, damaged goods. You need a rigorous system to track rejected goods and the financial compensation you're demanding.
The text calls purchase returns outward. Outward doesn't sound like a purchase to a beginner.
It is confusing. You have to shift focus from the finance to the physical logistics.
The loading dock analogy.
Yeah.
Imagine your warehouse. You reject raw materials from a supplier, you load them on a truck, and that truck drives outward away from your facility.
Yes, so purchase returns equal returns outward.
And if a customer returns a product to us, they bring it inward to our facility. So sales returns equal returns inward.
Keep the physical movement in your head, and it makes perfect sense.
Okay, so the purchase returns book format is similar, but it adds a debit note no column. What is a debit note?
Think back to the ledger. When we accepted goods, we credited the supplier's account to establish the debt.
Right, but now we're returning defective goods. We aren't going to pay for them.
So we need to reduce our liability. To reduce a credit balance, we must apply a debit to their account.
But you can't just secretly change your books. You have to notify them.
Exactly. The physical or digital document you send stating, "We are returning these goods and actively debiting your account by this exact amount," is the debit note.
It's the proof of liability reduction, and we record that serial number in the returns book for the paper trail.
It prevents disputes entirely, and the ledger posting just reverses the purchase flow. Individual suppliers are debited, and the monthly total is credited to the returns outward account.
Okay, let's stress test this with some edge cases for the text. Scenario: returned one computer, being defective, valued at $35,000 to B & Co.
Does this go in the purchase returns book?
Apply the architectural rules. What is a computer?
A fixed asset, not goods dealt in.
Exactly. If the original purchase of the asset couldn't go in the purchases book, the return cannot go in the returns book. Symmetrical rules.
So it goes to the journal proper. If you put it in returns, you distort your operational margins. Big time. Okay, try this one. Accepted the return of goods which were originally purchased for cash from us. 5 series at $400. We're returning defective inventory outward. Returns book. Read the history carefully. Originally purchased for cash. The cash flow engine is absolute. If you bought it with cash, what happens when you return it?
The supplier hands me physical cash back, a cash refund.
And what's the rule about receiving cash?
It goes in the cash book. So even though it's an outward return of inventory, the cash overrides the return system.
Perfectly stated. Cash book aggressively takes priority.
Let's do a rapid-fire exam prep to test the whole 8-book ecosystem. Scenario 1. We invest excess capital into 500 shares of a tech company, paid from our corporate bank account. Where does it go?
The outflow from the bank account dictates it. It goes directly on the payment side of the cash book, even though it's an investment asset.
Bank involvement is key. Scenario 2. We owe a supplier $10.50. We pay early. They give us a $50 allowance. We wire them $1,000. Where does the $50 allowance go? Journal proper.
No, this highlights the multi-column cash book. Since the cash discount is tied to the immediate transfer, you record the $50 allowance in the discount received column of the cash book right next to the $1,000 payment.
It keeps the settlement narrative unified. Scenario 3. The weekly total of our sales book. Where does that aggregate total go in the ledger?
Just like purchases, it's batch posted. It goes to the credit side of the main sales account.
Because sales represent revenue, and an increase in revenue is a credit.
Exactly. It perfectly balances the individual debits to the customer's accounts.
And conversely, the total of the sales return book goes to the debit side of the sales return account to reduce that revenue.
Flawless logic. Yes.
Last scenario. Irrecoverable debts. We sold $5,000 worth of coffee on credit. 3 months later, the customer goes bankrupt. Total loss. We have to wipe the receivable off the books. Where does it go?
A textbook journal, proper transaction.
Let's eliminate. Not cash, not a new purchase or sale, not a physical return of goods.
Right. It's purely an internal accounting adjustment to recognize a financial loss. It fails all 7 specific book criteria.
So the journal proper catches it. We debit bad debts expense and credit the customer's account to zero it out.
The journal proper forces the system to confront reality.
We have covered so much architectural ground. Let's synthesize a recap for our listeners. What are the core takeaways?
First, grasp prime entry. Subsidiary books are specialized batching areas, organizing chaotic transactions before the main ledger.
Second, know the arsenal. The 8 specific books with a journal proper as the safety net.
Third, respect the hierarchy. Understand the temporary waiting rooms versus the principal final destinations. And remember the cash book paradox.
Right. The cash book is both a subsidiary staging area and its own finalized principal ledger account.
Fourth, internalize the advantages. DSSA, division of work, specialization, saving time, availability of data, facility, and checking.
And finally, respect the rigid boundaries. Purchases and returns outward books are exclusively for credit transactions of goods.
Watch for the traps. If cash changes hands, use the cash book. If it's a fixed asset, use the journal proper.
And remember the loading dock visual. Sending defective stuff back to the supplier is moving it outward. Purchase returns equal returns outward.
Customers bringing stuff back is inward. Sales returns equal returns inward, anchored to the physical boxes.
To close out, I want to leave everyone with a thought connecting this to the modern world. We've talked about physical books, clerks, writing in details columns.
But if you go to a modern startup, you don't see physical books.
Yeah.
You see cloud-based ERP software like NetSuite or SAP. You just click Generate Invoice.
It feels like magic, disconnected from history.
It looks like magic. But underneath that UI, deep in the database, the software code is strictly executing this exact same English system logic.
It's quietly routing data into virtual staging areas and batch processing ledgers in the background.
The fundamental logic hasn't changed in a century, it just got digitized. So next time you authorize an online purchase, ask yourself, which invisible virtual subsidiary book did the software just route your transaction into?
Did a digital debit note just generate? The ghosts of these 8 books are still running global commerce. Thank you all for joining us on this deep dive. Keep looking for the logic behind the numbers, and we'll see you next time.
Usually when we talk about a business, there's this expectation of physical reality,
Yeah.
like a storefront. You know?
Right, something you can actually touch.
Exactly. You walk in, you see the inventory stacked neatly on the shelves, you see the employees working the registers, maybe you hear like the hum of the fluorescent lights.
Oh, yeah, the classic retail vibe.
Yeah, and you point and say, there it is. That's the business. Bricks or no bricks, it's solid. It's something you can just wrap your head around easily.
It's comforting, honestly. We naturally like things to be visible. We want them to be touchable, to be easily categorized by what our eyes can see and, what our hands can feel.
But then you step into the world of financial accounting, and you're trying to track the actual lifeblood of that business, the money.
And suddenly that physical building doesn't really tell you the whole story.
Right. You can't just look at a shelf and know if a company is profitable. You're looking at a tracking system that is essentially, well, it's like an invisible central nervous system.
It is the absolute definition of the financial pulse of an organization. I mean, it's the diagnostic tool for the muddy waters of commerce.
Muddy waters is a good way to put it.
If you don't understand how the money flows in and out, you don't really understand the business at all. No matter how nice the storefront looks or how busy the aisles seem, the truth is always in the ledger.
And that's exactly why we are here today. You, the listener, sitting right here at the table with us, and the two of us are embarking on a really highly targeted mission for this deep dive.
We are going to completely, utterly demystify the cash book.
Yes, we are. Whether you are cramming for upcoming accounting exams, or maybe trying to survive a college finance course, or even if you're an entrepreneur trying to keep your startup's books from turning into an auditor's nightmare.
We are stripping this down to the studs today.
Because it really is a foundational pillar, right? According to our source material, this is Unit 5 of the accounting process.
And it's incredibly easy to dismiss at first glance.
Yeah, I mean, it just sounds like a boring chronological list of money coming in and going out.
It does. But it is actually the central processing unit of any business's financial tracking. It is exactly where the physical reality of a transaction translates into the mathematical reality of a business.
So let's start with this bizarre conceptual paradox I noticed in the material. The cash book has this dual identity.
Oh, this is a classic trap for students.
Right, because it's categorized as both a subsidiary book and a principal book. And from what I understand about accounting theory, that completely breaks the rules.
That totally breaks the rules.
Usually a book is strictly one or the other. It's this rigid hierarchy. Like you write it in the rough draft, then you copy it to the final draft.
You're exactly right about the hierarchy. To understand why the cash book breaks the rules, we kind of have to look at the etymology and the function of those two terms.
Okay, lay it on me.
So subsidiary implies something supplementary or secondary. In accounting, a subsidiary book is a book of original entry. It's the very first place a transaction is recorded.
Like you make a sale, you immediately write it down there.
Exactly. Now, principal, on the other hand, means primary or most important. The principal book is the general ledger. That's the final, categorized, official destination for all your financial data.
Okay, so if I'm running a bakery, my subsidiary book is like my daily scribble pad by the register. Sold 3 croissants, paid the flour delivery guy. It's just chronological.
Right, just a raw list of events.
But the principal book, the ledger, is where I sort that out at the end of the month into specific folders, like a folder for total pastry sales, a folder for total flour expenses.
Precisely. And usually you have to manually transfer, or what we call post, every single line from the subsidiary journal into the principal ledger.
Which sounds incredibly tedious.
Oh, it is. But the cash book is unique. It acts as the subsidiary book because you record cash transactions there straight away, the very moment they happen.
But it's also the principal book.
Yes, because it also serves as the principal book, meaning you do not need to open a separate cash account in your general ledger.
Wait, really?
Really. The cash book is the cash account.
Okay, let me try a different analogy here, because the standard ones never quite click for me.
Go for it.
It feels like the cash book is a live security camera feed that also serves as the final, uneditable court evidence.
Oh, I like that.
Right. It captures the raw, chaotic, daily footage, the subsidiary part, but instead of someone having to transcribe that footage into a separate written report for the judge just accepts the tape itself as the official ledger record.
That is a phenomenal way to look at it. You are eliminating a massive, tedious step in the accounting cycle by letting the raw footage serve as the official record.
It's just so efficient.
It is. The balances from the bottom of the cash book go directly into the trial balance at the end of the period. Now, because this breaks the standard hierarchy, this dual nature concept is a massive trap.
I can definitely see why auditors would zero in on this, and why examiners would make it a guaranteed trick question on a test.
Oh, they love it.
If a multiple choice question asks, is the cash book a subsidiary book or a principal book?
Yeah.
It feels like they want you to pick a side.
But the answer is emphatically both.
Both. Got it.
It is literally the only book in the entire accounting system that holds that dual status.
Okay, so the theory makes sense. It's the camera feed and the court record. But if we strip this down to the absolute basics, before banks, before credit cards, we're just talking about a physical wooden drawer with coins in it.
The good old days.
Right. How did merchants centuries ago actually map that physical drawer onto a piece of paper? Like, what is the actual geometry of a simple cash book?
So a simple cash book is the most primitive foundational format. Visually, it looks exactly like an ordinary T account.
A T account.
Yeah, imagine a giant capital letter T drawn right down the middle of a page. It splits the page into a left side and a right side with one main amount column on each side.
Okay, I'm picturing it.
The left-hand side is always the debit side, and it strictly records all cash receipts.
The rule in the source text for the left side is debit what comes in. It's very physical.
It is entirely physical. If a customer walks into your shop and hands you a $20 bill for a t-shirt, you write that on the left side.
Simple enough. And the right side.
The right-hand side is the credit side. This side records all cash payments. The mirror rule applies here. Credit what goes out.
So if you take a $10 bill out of the register to pay the window cleaner, it goes on the right side.
Exactly. Left is money coming in, right is money going out.
But here's where I have to push back a little.
All right, what's the issue?
The source material emphasizes this, they call it the unbreakable golden rule of balancing the simple cash book. It states that the total of the receipts column, the left side, is always greater than or equal to the payments column on the right. Always.
That is correct.
But in the real world, businesses go into debt all the time. Companies go bankrupt specifically because they spend way more money than they make. So how can a book mathematically demand that receipts are always greater than payments?
That is the perfect question. And it highlights a really fundamental confusion between cash flow and accrual accounting. Or, wealth versus liquidity.
Okay, untangle that for me.
You have to remember the strict perimeter of the simple cash book. It only tracks hard, physical paper notes and metal coins sitting in a physical box.
Ah, it's the physics of reality.
Exactly. You literally cannot spend more physical cash than you hold in your hand.
That makes sense.
If you start the day with $1,000 in the register and you take in another $500, the absolute maximum physical cash you can hand to a supplier is $1,500.
You can't just magically invent more bills.
Right. You might owe them $2,000. Your business might be deeply in debt and fundamentally bankrupt, but you cannot hand them a $2,000 stack of cash if it doesn't exist in the drawer.
It's like a bucket analogy.
A bucket.
Yeah, you can pour out exactly what's in the bucket, or you can pour out less. But you cannot pour out more water than the bucket physically holds, no matter how thirsty the plants are.
That is exactly it. The right side of the book can empty the bucket perfectly to zero, making both sides equal, but it can never mathematically exceed the left side.
And that inescapable physical reality dictates the accounting reality. The debit total will always be equal to or heavier than the credit total in a simple cash book.
Spot on.
So how do we actually balance this at the end of the month? I want to understand the physical mechanics of it, because the terminology like carried down, brought down. It always seemed like archaic jargon to me. What are we actually doing with the pen and paper?
Let's walk through it step by step. It's the end of the month. You draw a single line under the last entry on both the left and right sides.
Okay, lines drawn.
You total up the receipts on the left. Let's say it's $1,800. You total up the payments on the right, say $1,030.
So the left is much heavier.
Yes. Now, to make the book visually balanced, to prove that your accounting is sound, you need both final total boxes at the very bottom of the page to read $1,800.
Right, but the right side is missing $770 to reach that total.
So you find that difference. You go to the right side, the credit side, which is the lighter side, and on the next available line, you write buy balance CD, which stands for carried down. And you plug in that $770.
And just by plugging that in, now both columns add up to $1,800.
Exactly. Then you draw double lines under the totals to lock the month closed.
But why carried down? Where does that phrase even come from?
Well, historically, before spreadsheets and software, you were literally carrying that number down to the next physical line on a massive sheet of parchment to start the next ledger period.
Oh, wow. Literally carrying it down the page.
Exactly. That $770 didn't just vanish. It is the physical cash still sitting in your drawer overnight.
Right, it's real money.
So immediately below the double lines, on the left side for the first day of the new month, you write to balance BD, meaning brought down.
Because you brought the actual remaining value down into the new time period.
You got it.
That makes so much more sense when you ground it in the physical act of writing on parchment. You're basically resetting the game board, but bringing your remaining chips down to the new round.
That's a great way to think of it.
Now, before we move past the physical cash, we really need to talk about the non-cash transaction trap. I know auditors look for this, and examiners absolutely love to use it to fail students.
Yes. The phantom transaction. Let's set a scenario.
Okay, let's do it.
It's January 31st. Your rent is due. It's $1,000. Cash is tight, so you call the landlord and say, hey, I'll bring you the cash next week on the 4th.
Been there.
The landlord agrees. You owe the rent for January. Do you record that $1,000 payment in the January cash book?
I'm guessing no, because the bucket hasn't been emptied yet.
Absolutely not. And this is exactly where amateur accountants completely destroy their books.
Just by writing it down too early.
Yes. The rule is right there in the title. Cash book. If physical cash did not cross your palm or leave your hand, it does not go in the cash book. Period.
Right. Rent due but not paid is an obligation. It's a liability. But it is not a cash outflow yet.
Exactly.
If you put it in the cash book, your book would say you have like $700 in the drawer. But when you actually count the physical money in the drawer, you have $1,700.
Which is a disaster.
The police would think someone reverse robbed you.
Right. It creates an irreconcilable audit failure. Non-cash transactions require a normal journal entry to record the expense and the liability.
But the cash book itself remains untouched.
Untouched until the very second the physical bills leave your hand.
Okay, so the bucket analogy works perfectly for a simple world of exact change and paying full price. But modern commerce, even hundreds of years ago, evolved past that.
It definitely did.
What happens when I want my money faster? Let's say a customer owes me $500 in 30 days, but I need liquidity right now to buy more flour for my bakery.
You need to incentivize them.
Right. I tell him, pay me today and I'll knock $10 off. If I only receive $490, my simple cash drawer can't track that missing $10 without making my original sales figures look wrong.
And that very necessity birthed the double column cash book.
Double column.
Okay. It takes the simple layout we just learned and adds one more column next to the amount column on each side. This new column is exclusively for cash discounts.
Let's break down the psychology and mechanics of these discounts because they behave very differently depending on which side of the transaction you are on.
They do. On the receipt side, the left, debit side, you have discount allowed.
Okay, discount allowed.
When you allow a customer to pay less to settle a debt quickly, that discount is a loss to your firm. It's a calculated expense. You basically sacrifice $10 of profit to gain immediate liquidity.
And on the flip side, the payment side, the right side.
That is discount received. This is when you owe a supplier money and they offer you a deal for paying early.
So you pay less cash than you originally owed.
Exactly. To your firm, this discount is a game. It's a form of indirect income.
Let's trace a specific tangible example from the source text to make this concrete for the listener.
Sure.
Say a customer named Ram owes us $500. We promise him a 2% discount if he pays today. 2% of 500 is $10. So RAM hands us $490 in physical cash. How exactly do we map this into the double columns?
On the left side, the debit side, you use your two columns.
Uh.
Under the discount allowed column, you write $10.
Okay.
And then under the cash column, right next to it on the exact same line, you write $490. In the particulars column, you just write to RAM to show whose account is settled.
So you track the cash you physically got and the cash you forgave side by side.
Side by side, perfectly clear.
Now here is where my instinct completely misguides me and where I know a lot of people mess up their books.
Oh, I know where this is going.
At the end of the month, we just spent all this time perfectly balancing the cash columns with the carried down and brought down method, right?
Right.
If I'm looking at these two discount columns, my first instinct is to balance them too. If I allowed $10 in discounts on the left and I received $6 in discounts from suppliers on the right, why wouldn't I just net them out and carry down a net discount expense of $4?
It seems mathematically logical to find the difference, I know.
It does. It feels so clean.
It might seem mathematically elegant, but in accounting theory, it is an absolute auditor's nightmare. You must never, ever balance the discount columns.
Just never.
Never. You simply total them up independently.
But why? They are sitting right across from each other in the exact same book.
Because discount allowed and discount received are two entirely different species of financial data. They are apples and oranges.
Okay, explain that.
Discount allowed is an expense account. Discount received is an income account. You do not net your expenses against your income directly inside a subsidiary journal.
Oh, I see. Netting them out would be like looking at your personal finances and mixing your grocery bill with your stock market dividends in a single column called, like, net life events.
That's a hilarious way to put it, but yes, it completely obscures what's actually happening in the business.
Right. If you net them, you have no idea if you are bleeding money by offering too many discounts to customers or if you are saving a fortune by paying your suppliers early.
Exactly. You destroy the diagnostic data. Management needs to know exactly what the early payment incentive program is costing the company and exactly what the early payment savings are yielding.
So what do you actually do at the end of the month?
You just draw a line under the debit discount column and write the total, say, $50. Then you draw a line under the credit discount column and write its total, say, $30.
And you just leave them alone.
You leave them alone. You do not cross-contaminate them. Later, those independent totals are posted to two completely separate ledger accounts.
Just total them, never balance them. Okay, I think we've mastered physical cash and the nuance of discounts.
We're making good progress.
But we are missing the biggest invention in the history of commerce. The bank.
Yes.
Because carrying around tens of thousands of dollars in a physical cash box is dangerous and, quite frankly, archaic.
It is. A modern firm, or really even a mercantile firm from the 1800s, keeps the bulk of its funds at a bank. Payments into and out of a current account are vastly more numerous than strict physical cash transactions.
And practically speaking, there's very little difference between cash in your register and money in your bank account, right?
Very little. It's all your company's highly liquid wealth, just residing in different locations.
Which means we need a bigger book.
We do.
This brings us to the heavyweight champion, the three-column cash book. We are now tracking discount, cash, and bank on the left side, and discount, cash, and bank on the right side.
It's a massive grid.
It really is. And this introduces a concept that I think is one of the most elegant mechanical solutions in all of accounting.
You're talking about the contra entry.
Yes, the contra entry.
It is a unique feature of a cash book that houses both cash and bank columns. It actually stems from the Latin root contra, meaning against or opposite.
Okay, so when does this happen in real life?
This entry is triggered when cash is withdrawn from the bank, specifically for office use like stocking the register with small bills, or when excess physical cash is taken from the store and deposited into the bank for safekeeping.
I use the pocket analogy for this to make it intuitive for myself.
The pocket analogy.
Yeah, imagine you're wearing a pair of pants with two big pockets. Your left pocket is your physical cash drawer at the store. Your right pocket is your business bank account.
Yeah, I follow.
If you pull a crisp $100 bill out of your left pocket and just shove it straight into your right pocket, has your total wealth changed?
Not by a single cent. Your net worth is identical. You didn't make a sale, you didn't incur an expense, you didn't pay a liability, you simply relocated the asset.
Right. And the contra entry is the accounting system's way of proving that the money merely changed pockets. So how do we write that down in this massive 3-column book so an auditor doesn't think we magically generated or lost $100? Let's say we take $1,000 from the store drawer and deposit it at the bank.
You have to record both opposing sides of this internal relocation simultaneously. Let's apply the fundamental double entry rule. Debit what comes in, credit what goes out.
Oh, yeah.
When you deposit cash, the bank is receiving the money and the physical cash is going out the door.
Okay, so on the left side, the receipt side, we need to show the bank bucket filling up.
Correct. On the debit side, in the particulars column, you write to cash, and you put the $1,000 specifically in the bank amount column.
Because the bank is receiving it.
Right. That shows your bank balance increasing. But you aren't finished.
Gotta do the other side.
Exactly. On the right side, the payment side, you must show the physical cash leaving the premises. In the particulars column, you write by bank, and you put the $1,000 in the cash amount column.
So the entry appears on both sides of the exact same book on the exact same day.
Yes, and here is why accountants love this. The double entry accounting requirement has been completely satisfied internally.
Inside the one book.
Right. You have a debit to bank and a credit to cash, all within the same subsidiary book. You do not need to post anything to the general ledger for this transaction. It is a closed loop.
But how does someone reading the book 3 months later know it's a closed loop? Like, how do they know not to go hunting through the general ledger for a missing entry?
You signal it. In the narrow ledger folio column on both sides of the book, you write a bold letter C.
Just a C.
Just a C. That stands for contra. It's basically a universal stop sign for auditors. It says, do not look anywhere else. The opposing entry is literally right across the binding on the other page.
It is so brilliant in its simplicity. Now, earlier, we spent a lot of time on the golden rule of the physical cash bucket, that you can never pour out more than it holds.
Right. You can't spend money you don't have physically.
Does that physical constraint apply to the bank column?
This is a really vital distinction. Unlike a physical drawer of cash, a bank column can have a credit balance.
Wait, you can have a negative bank balance in the book.
Absolutely. You can absolutely spend more money than you actually have in your bank account, provided you have a specific pre-arranged credit facility with your bank.
Ah, you mean the classic bank overdraft.
Exactly. An overdraft allows you to write checks or make digital transfers for more than your actual balance up to a strict limit.
Okay, so if you utilize this, the payments out of your bank column will mathematically exceed the deposits into your bank column.
Yes.
So when I go to do my end-of-month balancing ritual with the lines and the totals, the right side, the payment side of the bank column will actually be heavier than the left side.
Yes, it will. And following the exact same mechanics of balancing we talked about, you would find the difference. But this time you write to balance CD on the left side, the receipt side, because it is now the lighter side.
Oh, it flips.
It flips. You draw your totals. And for the first day of the next month, you bring that balance down to the right side, the credit side, as by balance BD.
So an opening balance on the left side means cash in the bank, an asset. An opening balance on the right side means you are in an overdraft, you owe the bank money, it's a liability.
Precisely. The side dictates the nature of the balance.
Okay, now the source text spends a lot of time on checks. And I get it, checks are weird.
There are very strange instruments.
They are pieces of paper that represent money, but they aren't actually money until they clear them.
Mm-hmm.
Let's look at the timing tricks here, because this is where reality gets messy.
Timing is everything with checks.
Let's say a customer hands me a check for $500 on Monday, but I'm swamped, the store is super busy, and I don't drive to the bank to deposit it until Wednesday. What happens on Monday?
On Monday, the bank knows absolutely nothing about this money. It is in limbo. Often, a firm will initially enter that received check in the physical cash column on the left side, treating it as if it were a $500 bill sitting in the safe.
Because technically they possess the value in their hands.
Right.
Okay, so it's treated as cash. But then Wednesday rolls around, and I finally take it to the teller.
On Wednesday, when you deposit it, you treat it exactly like a contra entry. You record physical cash going out, crediting the cash column, and the bank receiving money, debiting the bank column. And you mark it with a C.
Wait, depositing a check triggers a contra entry.
It does.
That feels like a glitch in the matrix. It looks on paper exactly like you took 500 physical dollars to the bank, even though it's just a piece of paper.
Functionally, to the accounting system, there is no difference. You moved liquid value from the office to the bank.
Okay, fair enough. But what happens if that check bounces?
The dishonored check.
Let's say you deposited it directly. You recorded it in the bank column on the left side, anticipating the money. But on Friday, the bank calls and says, dishonored, the customer had insufficient funds.
It happens all the time.
My instinct would be to just grab some whiteout and erase the entry from Monday, like it never happened.
Never, ever use whiteout in accounting.
Really? Why not?
It immediately implies fraud. If a check is dishonored, you must reverse the entry legally and visibly.
So how do you do that?
You go to the right side of the payment side, and you enter the exact same amount in the bank column. In the particulars, you write the name of the customer who gave you the bad check.
I see. You essentially force your own system to pay the money back out to correct the inflated balance.
Exactly.
And by writing their name, you create a clear audit trail that this specific person still owes you the $500.
Right. The debt isn't settled.
Okay, here is my favorite obscure mechanism from the text. What if I receive a check from customer A for $1,000, but I happen to owe exactly $1,000 to supplier B?
Okay, a perfect match.
Instead of going to the bank, depositing it, waiting 3 days for it to clear, and then writing a brand new check to supplier B, I just flip customer A's check over, sign the back, endorsing it, and hand it directly to supplier B that very same afternoon.
In that specific scenario, where a received check is endorsed to a third party on the exact same day, absolutely no entry is required in the cash book.
It's a ghost transaction.
Exactly. Because it never hit your physical cash drawer and it never hit your bank account. It entirely bypassed your cash tracking infrastructure.
It was just a direct transfer of a bare instrument from customer A to supplier B, with you merely acting as a temporary physical conduit.
You got it.
But the debt was settled. How is that recorded if not in the cash book?
You would record it via general journal entry. You decrease accounts receivable for customer A and decrease accounts payable for supplier B. But the cash book is completely blind to it because no liquid cash or bank funds actually moved through your controlled accounts.
That is fascinating. Okay, so we have this massive, complex, 3-column cash book perfectly tracking every physical coin, digital bank transfer, bounce check, and contra entry. It is a masterpiece.
It really is a beautiful system.
But the cash book is just one organ in the body. How does this data actually flow out to the rest of the ledger system? This brings us to the posting process.
Right. Remember the dual identity we talked about at the start?
The camera feed and the court record.
Yes. The cash book is a subsidiary book generating data that must update the individual accounts in the principal ledger, like your sales account, your rent expense account, or specific customer accounts.
And periodically, usually daily, you must post these entries so the entire system remains synchronized.
Exactly.
And there is a rule for this that requires a bit of, well, mental gymnastics. It's the reversal rule. You have to think backwards, almost like looking in a mirror.
It comes back to the core mechanics of double entry accounting. If you write an amount on the debit side of the cash book, the left, receipts side, that means you are actively debiting your cash or bank balance.
Right.
To complete the double entry for the rest of the universe, you must credit the corresponding account.
Let's trace a $200 cash sale to make sure I understand the cognitive load of this.
Let's do it.
In my cash book, on the left side, I write to sales, $200 in the cash column.
Good.
Later that afternoon, I open my massive ledger binder and flip to the page labeled Sales Account. I don't write it on the left side of the sales page. I have to physically cross over to the right side, the credit side, and write, by cash, $200.
Exactly. You debited cash in the cash book, you credited sales in the ledger. The transaction is perfectly balanced.
It's crisscross.
It is. And the reverse is true for payments. Items on the right side, the credit side of the cash book, are posted to the left side, the debit side of the corresponding ledger account.
So if I pay $500 for rent, I write it on the right side of the cash book because money went out. Then I flip to the rent ledger page, and I write it on the left side because my rent expense is increasing.
Perfect.
Left goes to right, right goes to left. It's a perfect crisscross. But wait, do the discount totals crisscross?
No, and that is an excellent catch. Because we do not balance the discount columns, we just took their independent totals.
Oh.
The total of the discount allowed column, which lives on the left, debit side of the cash book, is posted straight to the left. Debit side of the discount allowed ledger account.
It doesn't flip.
Nope. And the total of discount received on the right goes straight to the right side of the discount received ledger account.
So the cash and bank crisscross, but the discounts walk straight ahead. That is a vital mechanical distinction.
Very vital.
Now, looking at this massive system, I see a very practical, real-world logistical nightmare.
Okay, what are you seeing?
Well, I'm running a busy company. We process thousands of dollars a day, but my employee needs 50 cents for a bus fare to drop off a document, or $2 for a specialized pen, or $3 for stamps.
The micro expenses.
Yeah. If I force my main cashier to log every single 50-cent transaction into this massive, beautiful, highly audited 3-column cash book, it's going to become a chaotic, unreadable mess.
It would be absolutely disastrous. The main cash book would become bloated with pages of microscopic entries.
It would take forever to read.
And the main cashier, who should be focused on macro cash flow, payroll, and ensuring $50,000 supplier checks don't bounce, they would be driven mad trying to reconcile a missing 20 cents for a toll booth.
So how do we solve the 50-cent problem without just, leaving a bowl of untracked cash in the break room?
The solution is delegation through a system called the petty cash book.
A petty cash book, okay.
You appoint a trustworthy junior staff member to be the petty cashier. You hand them a small, separate, locked metal box and a much smaller, separate ledger.
And you just entrust them with all the tiny stuff.
Exactly. You entrust them with the specific mandate of handling all micropayments, say, anything below $50.
I love that. Here's a small box, handle the pens and the bus fares, leave the CFO alone.
It's highly efficient.
But how do you control it? If you just give an employee a box of cash, human nature dictates that money will eventually bleed out through, let's call them, accidental personal expenses.
Right, the temptation is there.
This brings us to what the source text flags as an exam goldmine, and what I personally think is a stroke of management genius. The impressed system.
The Impress system is a masterpiece of internal audit control. It allows delegation without micromanagement.
Walk us through exactly how it works.
Here is exactly how the mechanism works. The main cashier gives the petty cashier a fixed round sum of money at the beginning of a period, say, a float of $100 for the week.
Okay, the petty cashier has a crisp $100 bill in their metal box on Monday morning.
Throughout the week, they make small payments. $3 for postage, $10 for casual labor to move some boxes, $5 for a taxi.
Just everyday office stuff.
Right. They record every single payment in their petty cash book, and crucially, they must collect and keep the receipts, known as vouchers.
They need the paper trail.
Always. Let's say by Friday afternoon, they have spent exactly $67.50.
Which means they mathematically should have $32.50 remaining in the metal box.
Correct. Now, here is the absolute genius of the Impress system. To start the next week, the main cashier does not just hand them another random $100 bill.
What do?
The petty cashier must physically present the $67.50 worth of vouchers to the main cashier. The main cashier audits those receipts to ensure they are legitimate business expenses.
Checking the math.
Yes. Once approved, the main cashier reimburses the petty cashier exactly $67.50.
Oh, so they hand them the exact amount spent.
Exactly.
The petty cashier adds that 67.50 to the 32.50 they still had in the box, and boom, they are magically right back to the original starting float of exactly $100 for Monday morning.
Exactly. They begin every single period with the exact same predetermined maximum limit. The reimbursement always perfectly mirrors the proven audited expenses.
It is the exact historical predecessor to a modern corporate expense card.
It really is.
If your corporate card has a strict $500 monthly limit and you spend $300 on client lunches, the company pays off the $300. You don't get an $800 limit next month. You are just restored back to your $500 ceiling based strictly on the receipts you upload.
It creates psychological friction against theft or waste because the petty cashier knows they have a hard ceiling and that every single penny must be justified to get refilled.
It's brilliant.
And visually, the petty cash book is also quite clever. It uses an analytical format to save even more time.
How so? Isn't it just a simple list of small expenses?
It's pre-sorted. The extreme left-hand column records the receipts of cash, which is just the initial float, and the periodic impressed reimbursement.
Okay, the money coming in.
Then you have a total payment column. But
Yeah.
to the right of that, you have multiple analytical columns representing the most common categories of small expenses.
Like breaking the page down into specific buckets.
Yes. You might have a column for conveyance, which is travel fares, a column for cartage, for freight, one for postage, one for stationery, and always a sundries column for the oddball expenses.
So how does the petty cashier actually fill it out?
When the petty cashier spends $5 on stamps, they write $5 in the total payment column, and then they immediately write that same $5 again in the specific postage column.
Oh, they were doing the categorization work in real time.
Precisely. So at the end of the month, instead of the main cashier having to read through 80 individual tiny transactions and post them one by one to the general ledger, they just look at the analytical totals.
They just grab the bottom line of each bucket.
Right. They take the total of the postage column and debit the main postage account once. They take the total of the cartage column and debit the cartage account once. It compresses dozens of microtransactions into 5 or 6 clean ledger entries.
It's incredibly efficient. And what about that $32.50 left in the petty cash box at the end of the year?
It sits as a current asset on the balance sheet, right alongside the thousands of dollars in the main bank account. It is still the company's wealth, just physically located in a small box on a desk.
That is just, it's so neat.
Very elegant.
Now, we have spent a lot of time on physical coins, parchment ledgers, and metal boxes. And the rules are airtight. But let's bring this deep dive firmly into the 21st century.
Let's do it.
Because honestly, if I walk into a coffee shop today, no cash changes hands. I tap my phone or I swipe a piece of plastic.
It's all digital now.
Exactly. The fundamental rules of the cash book were designed half a millennium ago by Venetian merchants trading physical gold and silver. How does this archaic, column-based physical book handle invisible, instantaneous digital money?
It handles it beautifully, provided you understand the mechanical plumbing of modern digital settlement.
Okay, break the plumbing down for me.
When a customer buys something with a credit or debit card, Visa, MasterCard, SBI card, whatever, no actual money moves at the moment of the swipe.
Right, it's just a digital ping.
Exactly. The terminal reads the chip, pings the network, and the customer's bank authorizes the transaction, essentially saying, yes, this person is good for the money. The machine prints a receipt, but it is just data.
So the store hasn't received anything they can put in a bucket yet. They just have a digital IOU.
Correct. At the end of the business day, the merchant's terminal automatically batches all these digital authorizations and submits them to their acquiring bank for clearing and settlement. Within 24 to 48 hours, the bank actually moves the real funds into the merchant's account.
Okay, so from an accounting perspective, when the money actually hits, how do we log that?
For the seller, a credit card sale acts fundamentally like a direct bank receipt. Because the funds are guaranteed by the network and deposited directly, you record it in the cash book on the receipt side, the left side, directly into the bank column.
So it is functionally identical to the customer walking into your local bank branch and handing the teller cash to put into your account.
Functionally identical.
That makes sense. It bypasses the physical left pocket of the cash drawer and drops straight into the right pocket of the bank account.
Exactly.
But there is a massive catch here that I know ruins a lot of small business accounting.
Oh, the fees.
Yes. The banks and the card networks, Visa, MasterCard, they do not build these massive, secure, instantaneous global networks out of the goodness of their hearts. They charge a toll.
Yes, the merchant discount rate or swipe fee. The bank charges a commission on every single transaction, usually ranging from 1% to 4%, depending on the type of card and the merchant agreement.
And this is where the accounting gets really dangerous.
It does.
Let's say I sell a premium coffee machine for $100. The customer taps their card, the bank processes it, but they take a 3% fee, $3. So the next day, only $97 actually lands in my bank account.
Right.
If I am the bookkeeper, my instinct is to just look at my bank statement, see a deposit of $97 and write sale. $97 on the left side of my cash book.
Yeah.
What is wrong with doing that?
If you do that, you are actively falsifying your revenue and hiding your expenses.
Falsifying it.
Yes. If you record a $97 receipt, your ledger tells management that you sold a $100 coffee machine at a discount. It lowers your top-line revenue artificially.
Oh, I see.
Furthermore, it completely hides the $3 you paid to the bank. Management has no idea how much credit card processing is actually costing the business over the year.
It obscures the reality of the business. You sold it for $100, but you paid $3 for the privilege of using the digital network.
Exactly.
So how do we force the 500-year-old cash book to tell the truth about a millisecond digital transaction?
You have to break the transaction down into its gross flow of value, unnetting it. In reality, the bank credits your account for the full $100, but in the exact same millisecond, they debit your account for the $3 commission.
So it's a two-step dance happening behind the scenes.
Exactly.
Yeah.
And your cash book must reflect that two-step dance. On the receipt side, the left side, you record the full gross sale amount of $100 in the bank column. Your revenue is accurately captured.
Okay, so the 100 goes in.
Then immediately you cross over to the payment side, the right side. You write by commission or by bank charges, and you enter the $3 fee as a payment out of the bank column.
It's brilliant. You make it look like the bank handed you a $100 bill, and you immediately handed them back three $1 bills as a thank you tip.
That is exactly how you record it.
The net result mathematically on your bank balance is exactly $97, matching reality perfectly. But your sales account stays whole, and your bank charges expense account accurately tracks the cost of doing business.
The old rules still apply perfectly. We just have to map the digital steps to the physical columns.
The logic of double entry accounting is practically an unbreakable law of financial physics. If you trace the flow of value, what came in, what went out. The system can handle anything from a Venetian gold florin to a contactless smartphone payment.
It really is a marvel of human logic.
This has been an incredibly thorough journey. We've gone from the conceptual paradox of the dual identity down to the physical parchment logic of balancing the simple bucket, through the psychological nuance of discounts, the closed-loop brilliance of contra-entries, the psychological controls of petty cash, all the way to mapping the merchant discount rate of modern plastic.
We covered a lot of ground today.
To finish this off, let's do a quick conversational audit review.
I love a good audit.
I'm going to act as a slightly overconfident, stressed-out business owner trying to close my books, and I want to bounce my assumptions off you based on everything we've learned.
A perfect way to solidify the concepts. Let's do the audit.
Okay, I'm looking at my cash book. I need to save time, so I'm just going to treat it as a rough draft, a subsidiary book, and later I'll hire someone to copy all these thousands of entries into a proper cash account in my main general ledger. That's standard practice, right?
And right away, you are wasting money and time. Remember the dual identity. The cash book is both the subsidiary book and the principal book. The balances at the bottom of your cash book go straight to the trial balance. Do not open a redundant cash account in the ledger.
Got it. Skip the extra work. Okay, well, I sold a lot of inventory on credit this month. Customers signed contracts saying they will pay me in 60 days. I'm going to go ahead and write those massive sales numbers on the left side of my cash book so my investors see how much money we are making.
If you do that, you will fail the audit immediately. The cash book strictly ignores all credit transactions. It only tracks actual liquid value physical cash or bank transfers that has actually cleared. If you haven't received the cash, it goes in a journal, not the cash book.
Right. The bucket can't hold promises, only water. Okay, looking at my two discount columns, I offered a lot of early payment discounts to customers on the left, and I got a few discounts from my suppliers on the right. To make the book look clean, I'm just going to find the difference between the two, balance them out, and carry down the net discount to the next month.
Never balance the discount columns. Discount allowed is an expense. Discount received is an income. You total them independently and send those totals to their respective ledger accounts. Do not cross-contaminate your expenses and your income.
Never balance discounts.
Got it. Okay, I took $500 from the register and drove it to the bank. I wrote it on the left side to show the bank getting money, and I wrote it on the right side to show the register losing money. I'm done.
You forgot the signal. You must put the C for contra in the ledger folio column on both sides. Otherwise, your accountant will spend hours looking through the general ledger for the matching double entries that just don't exist.
The C closes the loop. Okay, last one. My petty cashier spent $90 out of their $100 float this week. They've been working hard, so I'm just going to hand them a fresh new $100 bill for next week so they have a bit of a buffer. You just broke the impress system. You never give a random amount. You audit their $90 of receipts and you reimburse them exactly $90. That restores their physical cash to the strict $100 ceiling, maintaining total psychological and financial control.
The ceiling is absolute. This has been a masterclass. From the physical bricks of a storefront to the invisible digital pulse of modern commerce, it all comes down to understanding the flow of value on the left side and the right side of that T account.
That's all it takes.
You are now armed with the history, the mechanics, and the underlying logic to tackle any cash book exam question or to bulletproof the finances of your own business empire. Thank you so much for joining us at the table today. Keep learning, keep questioning, and we will see you on the next deep dive. You know, if you break your arm, and an X-ray gives you this really clean, jagged white line, it is entirely binary.
Right.
It's broken or it's not broken.
Right, yeah. You look at the scan, the doctor points, and you just immediately know the reality of the situation.
Exactly. But step into the world of accounting,
Yeah.
and I feel like that diagnostic machine is just fundamentally broken. I mean, I want you to picture this scene. You're sitting at a desk, the lighting is terrible, it is like late at night, and you're staring at a trial balance.
Oh, yeah, that master list of all your debit and credit balances, the one that is supposed to prove your books are mathematically sound.
Right. And the two columns simply will not match. Or, and I think this is somehow infinitely worse, they do match perfectly, but the final profit number sitting at the bottom of your income statement is just a total lie.
It is the absolute definition of diagnostic muddy waters, because when those numbers don't add up, or when they add up but conceal this massive underlying mistake, this very specific cold panic sets in. It's a panic that every accounting student, every business owner, and every professional auditor just knows intimately. Your financial x-ray is basically lying to you.
Welcome to today's deep dive. Our mission today is really clear. We are putting on our trench coats, grabbing our magnifying glasses, and stepping into the shoes of a financial detective.
I love that.
We're going to deeply, comprehensively understand the art and science of the rectification of errors. We want to strip away the textbook jargon and just look at the real-world mechanics of how mistakes happen, how they hide, and most importantly, how we hunt them down and fix them.
And this isn't just about passing a test. I mean, if you are an exam candidate, mastering this is totally non-negotiable. But really, this is about understanding the actual language of business. If you don't know how to track down a misallocated number, you don't really know how double-entry bookkeeping works.
That is the ultimate goal for you today. Whether you're a complete beginner looking at a ledger for the very first time, maybe a college student pulling your hair out before midterms, or even an entrepreneur trying to understand why your accountant is asking you so many questions.
Yeah, we are moving completely beyond rote memorization here.
Exactly. We want you to achieve a conceptual mastery of finding, classifying, and legally fixing accounting errors. So to do that, we have to start with the foundational definition. What exactly are we hunting here?
Well, when we use the term error in an accounting context, we are drawing a very firm line in the sand. The key word here, the concept you have to just lock in your mind right out of the gate, is the word unintentional.
Unintentional. Okay, so just to be crystal clear, if I am intentionally hiding a transaction to, say, lower my tax bill, or if an employee is skimming cash from the register and doctoring the books to cover it up, that is not an error.
You hit the nail on the head. That is fraud. That is embezzlement. And that requires a forensic accountant and a lawyer, which is a completely different investigation. We are strictly talking about omissions, where a human being just flat out forgets to record something, or commissions, which are basically mechanical mistakes. Think, adding or subtracting incorrectly, misinterpreting a piece of data, or just dropping a zero because you were exhausted.
That human element,
Yeah.
just the fallibility of staring at spreadsheets for 8 hours straight.
Precisely. And to truly contextualize the problem, we really need to understand the life cycle of a transaction, because these unintentional mistakes typically inject themselves into the system at two primary stages.
Okay, so where does it start?
They either happen right at the beginning, during the collection of raw financial data, like the source documents, your invoices and receipts, or they happen during the actual recording and processing of that data into the books.
I was actually thinking about this while prepping for today, and I came up with an analogy. Think about cooking a really complex recipe.
Okay, I'm with you.
Let's say you are making a massive pot of soup, and that soup represents your final financial statements. The trial balance, the balance sheet, the profit and loss. If you accidentally add a tablespoon of salt instead of a teaspoon, you have fundamentally changed the flavor profile of the dish.
Oh, totally.
The soup is ruined, even though you technically follow the chronological steps of the recipe. Like,
Yeah.
you put the salt in at the correct phase of cooking, but the measurement was just completely wrong.
That captures the mechanics beautifully. And actually, to push that cooking analogy a step further, what if you completely forget to add the salt at all?
Right.
The soup looks perfectly fine visually. The volume of liquid in the pot is basically identical. A casual observer would say, hey, you made a great pot of soup. But when someone actually tastes it, when an auditor or a bank manager actually analyzes the financial statements, the fundamental truth of the dish is missing. It's bland. It's incorrect.
Exactly. And just like in a kitchen, before you can fix the ruined soup, before you decide if you need to, add potatoes to absorb the extra salt, or add the missing salt in late, You have to know exactly where in the cooking process the mistake occurred.
Timing is everything.
Right. The timing of the error dictates the method of rectification.
Which brings us to the first major phase of our investigation today, which is the stages of errors. We need to map out exactly where things go off the rails. Because in accounting, as we said, timing dictates the fix. The system is entirely sequential. So let's look at the very first stage, initial recording errors. This takes place in the subsidiary books and the cash book.
The subsidiary books. So for the complete beginners out there, these are often called the books of prime entry, right?
Yeah.
It's essentially the diary of the business, the very first place a transaction lands when it walks through the front door.
That's a great way to describe it, yeah. The Purchases Day book records all your credit purchases, the Sales Day book tracked all your credit sales, and the cash book logs every single penny that physically or digitally enters and leaves your bank accounts.
Okay, makes sense.
Now imagine a concrete scenario. You are running a business and you make a credit purchase from a supplier. The physical invoice sitting right there on your desk says $17,270. But the bookkeeper, whose eyes are blurring at 5 p.m. on a Friday, enters it into the Purchases Day book as $17,720.
Ouch. The classic transposition error. Swapping the 2 and the 7. So 17,270 becomes 17,720. That is a $450 mistake created in just the blink of an eye.
And it happens thousands of times a day across the globe. Now, here is a massive trap that students and business owners fall into all the time. They confuse this initial recording phase with the later post-ed phase.
Okay, let's break that down because I know those terms get thrown around interchangeably a lot. Recording versus posting. So the recording is the very first time the pen hits the paper or, the fingers hit the keyboard, entering the transaction into that daily diary, the subsidiary book.
Correct.
And then the posting is when we take that recorded number later on and we move it or categorize it into the specific individual accounts in the general ledger. And the ledger is basically like a giant filing cabinet with a folder for every single thing the business cares about, right? A folder for sales, a folder for rent, a folder for that specific supplier.
You've got it, exactly. The distinction is absolutely vital because it explains how a disease spreads through the body of your accounting system.
So if I mess up that very first diary entry, if I record the purchase as 17,720 instead of the real 17,270 in the Purchases Day book, does that single typo just poison every single step that comes after it?
Oh, it creates a catastrophic domino effect. Let's look at a cash book example to really see the dominoes fall. Suppose you write a check to pay off a supplier. The check is for $19,920.
Okay.
But you wrongly record it in the payment side of your cash book as $19,290.
Right, so I wrote a check for almost 20 grand, but I told my own books that I only spent $19,290. I've massively underreported my cash outflow.
Exactly. Now trace the flow of that bad data because your initial foundational record says $19,290. When the end of the week arrives and you have to post that payment to the supplier's individual folder in the ledger, what number are you going to transfer over?
The wrong one.
Huh?
I'm going to look at my diary, see the smaller number, and write that down in the supplier's ledger.
Right. So now your supplier ledger is wrong. It looks like you still owe them money that you actually already paid, but actually it gets worse. When you total up your cash book at the end of the month to figure out how much cash you have left in the bank, the total will be calculated using that artificially low payment figure.
Oh, wow. Because I recorded a smaller payment than I actually made, my book's going to tell me I have more cash sitting in my checking account than I actually do.
Which leads to bounced checks, failed payroll, and a totally distorted reality for the business owner. This is exactly why initial recording errors are so insidious. They infect the entire nervous system of the business because every subsequent step assumes the initial data entry was flawless. The ledger trusts the journal implicitly.
Okay, so that's the danger of the initial entry. But let's say the bookkeeper actually types the numbers in perfectly. What is the next stage where things go off the rails?
Well, we move from data entry to mathematics. The next stage involves totaling, which in traditional accounting terminology is called casting. So whenever you hear the word casting, just mentally substitute the phrase totaling up a column of numbers. Casting and balancing errors are really the bread and butter of accounting mistakes.
Casting, like a fisherman casting a wide net to catch all the numbers in a vertical column and pull them together into one big total.
Love that visual. So let's illustrate a casting error. Imagine it's the end of January. You have this long vertical list of 50 different credit sales in your sales day book. You take your 10-key calculator and you go down the column, adding them up. The actual true mathematical sum of all those individual sales is $175,700.
Okay, that's the real number.
Right. But your thumb slips on the calculator, you accidentally hit a 6 instead of a 5 at one point. You write down the grand total at the bottom of the page as $176,700.
So just to be clear, the 50 individual sales entries were perfectly correct. The customers will billed the exact right amounts. But the final sum at the bottom of the diary page is artificially inflated by $1,000.
That's the trap right there. And what happens next? Well, the accounting cycle dictates that you take that grand total from the sales day book and you post it as one big lump sum to the main sales account in your general ledger. So your sales account receives a posting of $176,700. Your official revenue for the month is now overstated by $1,000.
Just because of a thumb slip. My profit looks $1,000 better than it actually is, which means I might end up paying taxes on money I never even made.
Exactly. And casting errors don't just happen in the day books. They happen heavily when we are trying to balance individual ledger accounts.
Balancing, okay, we need to unpack this. Because balancing a T account is one of those concepts that feels like, I don't know, abstract geometry the first time you learn it.
It can definitely feel abstract, but the underlying logic is just a simple scale. Let's visualize a ledger account for a supplier. We'll call them Miss Robin Co.
Okay, I am visualizing a giant T drawn on a piece of paper. The left side is the debit side, the right side is the credit side.
Perfect. This is a supplier, they are a creditor, we owe them money. According to the rules of double entry, when our liability increases, like when we buy goods from them on credit, we record that on the credit side, the right side. So on January 1st, we purchase goods worth $99,000. On the right side of the T, we write buy purchases $99,000.
Got it. The scale is tipping to the right. We owe them almost $100,000.
Then on January 6th, business is booming, and we make another purchase from them for $59,400. Again, we record this on the right side. Buy purchases $59,400.
Okay, we have two heavyweights on the right side of the scale now. $99,000 and $59,400.
Now, the end of the month arrives. We need to balance this account so we can carry a single summarized number forward to the next month and eventually to the trial balance. To do this, we first have to cast, or total, the heavy side, in this case, the credit side. What is $99,000 plus $59,400?
Let me do the mental math. 99 plus 59 is 158. So the true mathematical total is $158,400.
The true total is $158,400. But let's say our exhausted account makes a casting error right here. While adding those two numbers, they make a mental leap and write down the total as $155,400. They just missed $3,000.
Okay, so the total at the bottom of the right column now incorrectly says $155,400.
Here is where the balancing mechanic kicks in. To balance the T account, we have to make the left side, the debit side, equal the right side. Since there are currently 0 entries on the left side, we have to insert a balancing figure. This is where that jargon term balance CD comes in.
Right. Balance carried down.
Exactly. We write to balance CD on the left side, and we use whatever total we calculated on the right side to make them match.
Oh. Because the accountant incorrectly totaled the right side as $155,400, they will write to balance CD $155,400 on the left side to basically force the scale to balance at that incorrect number.
Yes. And the next morning, on February 1st, they will take that balancing figure and drop it back over to the right side as the opening balance for the new month, writing by balance, BD balance, brought down $155,400.
Meaning, the official permanent record of the company now states that we only owe Saathaan Co. $155,400. When in harsh economic reality, we owe them $158,400. We have artificially erased $3,000 of our own debt just because we couldn't add two numbers together correctly. When Saathaan Co. sends us their statement, it's going to trigger a massive dispute between our billing departments.
That is the insidious cascading nature of casting and balancing errors.
Okay, so we firmly established where things go wrong in the timeline. Initial recording in the diaries or subsequent totaling and balancing in the ledgers. But knowing when it happened is really only half the battle. Now we need to classify what kind of error we are looking at.
This classification is absolutely paramount, not just because examiners love to test it, but because the category of the error dictates the specific surgical tool you need to use to fix it later.
While I was going through the notes preparing for this deep dive, I found this brilliant memory trick. A mnemonic device to help you lock in the 4 broad categories of accounting errors. I want everyone listening to commit the acronym POCC to memory. POCC.
POCC. Let's break down the anatomy of that acronym.
P stands for principal. O stands for omission. The first C is for commission, and the second C is for compensating. Principal, omission, commission, compensating. Let's tackle the biggest, baddest one first. The P errors of principle. I like to call these the rule breakers.
Rule breakers is highly accurate, and honestly, these are the errors that keep auditors awake at night. An error of principle happens when fundamental accounting policies are blatantly violated. This is not a math mistake. It's not a fat finger typo. It is a conceptual, philosophical failure. It happens when a transaction is recorded in a way that fundamentally misrepresents its true economic nature.
What is the classic scenario here? The one that is guaranteed to show up on a college final exam or a CPA test?
The quintessential example, without fail, is the confusion between capital expenditure and revenue expenditure.
Let's do a quick ELI 5 explain.
Yeah,
Like, I'm 5 for those terms because they sound intimidating, but the concept is actually pretty straightforward.
it is straightforward. Capital expenditure is money you spend on acquiring, building, or significantly improving a long-term asset. Something that is going to generate value for the business for years to come. Think buying a warehouse, purchasing heavy machinery, or upgrading a fleet of delivery trucks. Because these items have long-term value, they go onto the balance sheet as an asset.
Right. They are things you own.
Exactly. Revenue expenditure, on the other hand, is the money you burn through just to keep the lights on day to day. Paying the monthly rent, paying employee salaries, buying printer paper, fixing a broken window. These don't create long-term assets, they're just the cost of doing business right now. Therefore, they go on to the income statement, the profit and loss account, as expenses. And they immediately reduce your profit for the current year.
Assets go to the balance sheet. Expenses go to the income statement and eat your profit.
Got it. So how does the error of principle actually happen?
It happens when you cross the streams. Let's say your business buys a brand new piece of office furniture for $5,000. A heavy, beautiful mahogany conference table. That is a long-term asset. It should benefit the business for a decade. But the bookkeeper, maybe they don't know the rules or maybe they just get lazy, they take that $5,000 invoice and they just debit the general purchases account or office supplies expense as if they just bought $5,000 worth of toilet paper.
They treated a long-term capital expenditure, the mahogany table, as a short-term revenue expenditure. Yes, that is a pure error of principle.
Now, here is where my brain hit a wall when I first learned this. If I take a massive $5,000 debit that belongs in the furniture folder and I shove it into the completely wrong folder labeled purchases, shouldn't my trial balance catch that? I mean, the money is sitting in the wrong room.
And this is exactly why errors of principle are the most dangerous predators in the accounting jungle, because the trial balance will absolutely 100% still agree it will not flag the error.
But why? How can a master list of all accounts balance if $5,000 is in the wrong account?
Because the trial balance is mathematically blind. It is not a sentient being. It doesn't read the labels on the folders and judge whether the contents make logical, economic sense. The only thing the trial balance cares about is mathematical symmetry. It only asks one incredibly simple question. Do the total debits in the entire company equal the total credits?
Oh, I see the matrix now.
Right. When you bought that conference table for $5,000 cash, you credited the cash account for $5,000. That part was correct. To maintain the holy symmetry of double entry accounting, the system demanded a corresponding debit of $5,000. You should have debited the furniture account. Instead, you debited the purchases account.
But from the perspective of the master scale, it just sees a weight of $5,000 taken off the credit side and a weight of $5,000 added to the debit side. Symmetry is achieved. The scale balances perfectly.
Exactly. The trial balance is perfectly happy. It flashes a green light, completely oblivious to the fact that you just categorized a 10-year asset as a 1-month expense.
That is terrifying. It gives the business owner a completely false sense of security. The computer says books balance, but the actual financial reality is deeply distorted. By hiding that $5,000 asset inside an expense account, my total assets look smaller than they really are, which makes my company look weaker to a bank. And simultaneously, my expenses look artificially inflated, which just crushes my reported profit for the year.
You've grasped the exact danger. It distorts both the balance sheet and the income statement simultaneously while cloaking itself in mathematical perfection. This is why you cannot rely solely on software to do your accounting. You must deeply understand the nature of transactions.
All right, that is P in POCC, principle. Let's move to O, errors of omission. I like to call these the ghosts, because these are the transactions that simply disappear into the ether.
The ghost is a perfect moniker for it. An error of omission happens when a transaction is completely or partially left out of the books. The accountant forgets to record it, a piece of paper falls behind a desk, or an email gets deleted before it's processed.
The documentation mentions two distinct types, complete omission and partial omission. Walk us through the complete omission first.
A complete omission is total ghosting. The transaction never entered the accounting nervous system at all. It was omitted entirely from the very first diaries, the subsidiary books. For example, imagine it's December 31st, the last day of the year. A major customer, Hari Saran, returns $3,000 worth of goods because they were defective. The delivery truck backs up, the boxes are unloaded into your warehouse, and the warehouse manager signs the receiving slip. But the warehouse manager puts the slip in his pocket, goes home for New Year's Eve, and it accidentally goes through the washing machine. No entry is ever passed in the accounting books.
So no entry is made in the sales returns day book. No posting is made to Harry Saran's personal account to reduce his debt. From the accountant's perspective, this return literally never happened.
It doesn't exist. Now think about the trial balance. What does the master scale do when it encounters a complete omission?
Well, the scale only breaks if one side is heavier than the other. Because the slip was washed, we forgot to record the $3,000 debit for the return. A&D, we forgot to record the $3,000 credit to Harry Saran. We missed both weights equally. So the scale doesn't tip. The trial balance is perfectly happy. It agrees.
Exactly. Complete omissions keep the trial balance in perfect harmony. Both columns are artificially lower than they should be, but they are equal. It is incredibly hard to find a complete omission unless you are doing physical inventory counts and wondering where extra boxes came from. But now, let's contrast that with a partial omission. This is where things get messy, and examiners really love to test the difference.
Okay, take a step further. How does a partial ghost act?
A partial omission almost always occurs during the posting phase, the translation from the diary to the ledger. Let's use the Hari Saran return again. Suppose the warehouse manager does hand the slip to the accountant. The accountant correctly records the $3,000 return in the sales returns day book. The initial recording is perfect.
Okay, so far so good.
But later that week, when the accountant is transferring data from the diaries into the individual ledger folders, his phone rings. He gets distracted. He completely forgets to open Hari Saran's folder and post the $3,000 credit to reduce what Hari owes us.
Ah. So the transaction started its journey, but it never finished. Because it was in the sales returns day book, the total of that book will eventually get posted as a massive debit to the sales returns account. The left side of the scale gets its weight, but the specific corresponding credit to Hari Saran's account was totally forgotten.
You've got it. The accountant created a debit but ghosted the matching credit. What happens to the trial balance now?
The debit column is going to be $3,000 heavier than the credit column. The symmetry is shattered. The trial balance will break.
And that is the golden rule for exams. A complete omission from the subsidiary books keeps the trial balance in agreement. But omitting to post one specific side of a ledger account, a partial omission, will cause the trial balance to disagree and flash red immediately.
Okay, P for principle, O for omission. Now we arrive at the first C in POCC, errors of commission. The clerical blunders.
These are the everyday, incredibly frustrating mechanical mistakes. If you are looking at an error, and it isn't a fundamental violation of accounting philosophy, and it isn't a completely forgotten piece of paper, it is almost certainly an error of commission. This umbrella category covers all the mathematical, transposition, and posting mistakes we talked about earlier.
So entering 17,720 instead of 17,270, that's commission. Casting a column incorrectly on your calculator, that's commission.
Yes. Also, posting the wrong amount from the journal to the ledger. Or posting the correct amount but putting it on the wrong side of the T account, like putting a debit on the credit side. Or just calculating the final balance of an account wrong. It's the fat finger mistakes and the brain fog blunders.
And what is their relationship with the trial balance?
It depends on exactly where the blunder happened. If you write the wrong amount in the initial diary entry, like the 17,720 typo, both the debit and credit will eventually use that wrong number, so the trial balance will still agree. But the vast majority of commission errors, wrong side postings, wrong casting, wrong balancing, break the symmetry. They are the most common reason you are staring at a broken trial balance at midnight.
Which brings us to the final and, frankly, the most fascinating C in POCC, compensating errors. I originally tried to describe these as the lucky coincidences, but after really thinking about the mechanics, a better analogy is the suitcase analogy.
The suitcase analogy, walk me through that.
It's like you are packing a suitcase for a major international trip. The airline has a strict rule. Your bag must weigh exactly 50 pounds, no more, no less, or they won't let it on the plane. The 50-pound limit is our trial balance. It represents the required symmetry. While packing, you make a massive mistake. You completely forget to pack your heavy winter boots, which weigh 5 pounds.
So your bag is currently 5 pounds too light.
Right. But then in a separate moment of distraction, you accidentally pack 3 heavy hardcover books that you didn't mean to bring, which happened to weigh exactly 5 pounds combined. You zip the bag up, you go to the airport, and you put it on the scale.
And the scale reads exactly 50 pounds.
The scale is perfectly happy. The airline lets the bag on the plane. You feel great. But when you arrive at your destination in the freezing cold and open your suitcase, your internal contents are a complete disaster. You don't have boots, and you are lugging around books you don't even need.
That is a phenomenal analogy. A compensating error happens when the mathematical effect of one isolated mistake is exactly canceled out by the mathematical effect of a completely separate, unrelated mistake. The master scale is tricked into balancing, but the internal accounts are wrecked.
Let's trace the actual accounting mechanics of this. How does it happen in the books?
Let's look at the purchases daybook. We buy goods on credit from 2 different suppliers on the same day. First, we get a delivery from Miss Robin & Co. The actual paper invoice states $27,030, but the accountant accidentally enters it into the diary as $27,050.
Okay, error number 1. They overcharged the book by $20. The record is $20 too high.
Exactly. Then, on the very next line of the diary, they record a delivery from Miss Karnataka Suppliers. The actual invoice says $28,050. But through sheer coincidence, the accountant types it in as $28,030.
Error number 2. They undercharged the specific entry by $20.
Now, look at what happens at the end of the month when we total the purchases daybook. The bookkeeper adds up their incorrect entries. $27,050 plus $28,030.
Okay, 27 plus 28 is 55,000. 50 plus 30 is 80. So the wrong entries total up to $55,080.
And what would the total have been if they had painstakingly entered the correct original invoice amounts? The real amounts were $27,030 and $28,050.
Let's see, 27 plus 28 is 55. 30 plus 50 is 80. The total is exactly the same, 55,080. The $20 overcharge perfectly neutralized the $20 undercharge.
Yes. That total purchases figure of $55,080 gets posted as one giant debit to the trial balance. Mathematically, it is flawless, the scale is happy, but just like your suitcase, when you open up the individual supplier accounts, it's a mess.
Because when I post those individual numbers to the supplier's personal folders, I will show that I owe Saathaan & Co. $20 more than I actually do, and I owe Karnataka $20 less than I actually do. When I send out the payment checks, both suppliers are going to call me furious, demanding a reconciliation.
And the trial balance won't offer you a single clue that this disaster is brewing, because total debits still equal total credits.
Okay, so that is the POCC framework. Principal, omission, commission, compensating. Understanding these categories is the foundation. But it leads us directly into the most critical phase of our deep dive, the detective work.
Yes. Theory is great, but practical application is where accountants earn their money.
We've established that if the trial balance tallies, we still might be harboring ghosts, rule breakers, or suitcase disasters. But let's deal with the most immediate heart-pounding problem. What happens when the trial balance doesn't tally? We are staring at a spreadsheet where the debit side is $1,500,000 and the credit side is $1,498,000. There is a glaring difference of $2,000. It's 11 p.m. Where do we even begin? We can't just randomly flip through thousands of ledger pages hoping to spot a typo.
No, random searching is a recipe for madness. You must execute a systematic, step-by-step investigation procedure. This framework is essential for real-world auditing, and it is practically a cheat code for exams.
Let's walk through the protocol. Step 1 and 2 seem almost too basic, but I imagine they save a lot of time.
Step 1 is the most fundamental. Recast the trial balance itself. Take out a fresh calculator and re-add the debit and credit columns. You would be shocked by how often the accounting error is actually just a bookkeeper hitting the wrong button while summing up the final master document.
Always check if the scale itself is broken before you start weighing the items. Makes sense. What is step 2?
Step 2 is to verify that you haven't simply forgotten to carry over the most obvious balances. It is incredibly common for someone to meticulously list all the complex ledger balances, rent, accounts receivable, inventory, but completely forget to look at the cash book and write down the final cash in hand or bank balance onto the trial balance.
You forget to put the actual cash on the master list. Yeah, that would definitely throw off the totals. Okay, so assuming our math on the master list is correct and we didn't forget the cash balance, we move to step 3. And to me, this is the most brilliant part of the entire unit. It's called the golden rule, but I prefer to call it the halving trick. This is pure financial sorcery.
It feels like magic, but it is pure physics. The physics of double entry accounting. The very first thing you must do when a trial balance breaks is establish the exact mathematical difference between the two columns. Do not just say they are off. Find the exact gap. Let's stick with your example. Debit column 1,500,000. Credit column 1,498,000.
So the exact gap is a shortage of $2,000 on the credit side.
Correct. The halving trick dictates that you take that exact gap and you divide it by 2. You have it. What is half of 2,000?
$1,000.
Once you have that halved number $1,000, you systematically scan through your ledgers and your journal, looking for a specific transaction that is exactly equal to $1,000.
Okay, but why? This is what confused me at first. Why am I searching for half the difference instead of the full difference?
Because of the pendulum effect of a wrong side posting. Let's visualize the scale again. Let's say you have a transaction where you were supposed to place a $1,000 weight on the debit side, the left side. But in a moment of distraction, you grab that $1,000 weight and you mistakenly dropped it onto the credit side, the right side.
Okay, the weight is in the wrong bucket.
Think about the dual impact on the master scale. First, by failing to put the weight on the left side where it belonged, your debit column is now $1,000 too light. It's starving for that $1,000.
Right. Left side is down 1,000.
Second, by inappropriately dumping that $1,000 weight onto the right side, your credit column is now artificially $1,000 too heavy.
Oh, so left side is down 1,000 and the right side is up 1,000. They're moving in opposite directions. The total gap created between the two sides isn't $1,000. It's $2,000.
Precisely. A single wrong side posting creates a discrepancy in the trial balance that is exactly double the amount of the actual transaction. Therefore, if you are staring at a trial balance that is off by $2,000, dividing that gap by 2 gives you $1,000. Searching your books for a $1,000 entry allows you to quickly zero in on a potential wrong side posting. It cuts through the noise and gives the detective a prime suspect.
That is genuinely brilliant. It's like using a forensic algorithm. But what if the halving trick turns up empty? What if my gap is a weird specific number, like exactly $100? If I have that to 50 and search but find no $50 transactions, what do I do next?
That brings us to steps 4 and 5. If the halving trick fails, you need to look at the geometry of the gap itself. If the difference in your trial balance is a perfectly neat, round number like exactly $1 or $10, $100, or $1,000, it is a massive red flag pointing toward a casting error.
A totaling error in the diaries.
Yes. Human brains are very good at adding the big numbers, but we often sloop on the decimal places or forget to carry a 1 to the next column. If you are off by exactly $100, it is highly probable you just made a simple 10-key addition error while totaling up the purchases book or the sales book at the end of the month. You have to go back and re-add those specific columns.
Okay, look for round numbers. And if all the mechanical checks, the re-adding, the halving trick, the casting checks, if all of them fail, we have to move to step 6, the big picture test.
This is where you have to stop acting like a calculator and start acting like a business analyst. If you can't find the mechanical typo, you have to step back and look for analytical anomalies. You take the current account balances in your broken trial balance, and you lay them side by side with the audited account balances from the previous year.
You are looking for things that stick out like a sore thumb.
Exactly. Suppose you are reviewing the accounts and you see that your sales account balance for the current year shows $3,253,000. But then you look at last year's financials and the total sales were $3,645,000.
That is a massive drop, nearly a $400,000 decline in revenue.
Right. Now, as an analyst, you ask the business owner, did we lose our biggest client? Did a factory burn down? Did a global pandemic halt supply chains? If the owner says no, business was actually better this year than last year, then that massive dip is a glaring siren. It tells the detective that a massive error is hiding specifically in the sales account. Maybe an entire month of sales data was never posted, or a huge contract was wrongly credited to a different account. Comparing year-over-year figures provides the vital context that mechanical formulas can miss.
So we've set the scene. We understand the stages where errors infect the system. We know how to classify them using POCC. And we just executed our detective procedures to hunt them down. The detective work is officially done. We found the culprit. The X-ray finally shows the break. Now we enter the most critical part of this entire process, the art of rectification.
Because finding the error is only half the job. Fixing it is where the real skill comes in.
And I know for a fact that I can't just take a bottle of whiteout, erase the wrong number, and write in the new one. Or if I'm using software, I can't just hit the delete key and pretend it never happened.
Absolutely not. In the realm of accounting and auditing, there must always be an unbroken, transparent chain of custody, an audit trail. You cannot make historical data vanish. If you try, it looks exactly like fraud. You must pass formal, transparent adjustments to correct the record.
You have to leave a scar that proves the surgery took place.
Exactly. And the specific surgical method you use to fix the error depends entirely on when you manage to discover it. We categorize rectification into 3 distinct stages.
Let's start with stage 1, fixing one-sided errors before the trial balance is prepared.
This is the easiest scenario. Let's say you are a diligent bookkeeper. It's the end of the month, you've posted all the ledgers, but you haven't yet pulled all those final balances into the master list, the trial balance. During a quick review of your work, you spot a mistake.
Okay, the books are still open. They haven't been summarized yet.
Right. And you notice that the error only affects one side of one specific account. In this stage, you don't need to write a full, complex journal entry with a balancing debit and credit. You can just apply a local fix.
Let's use a concrete scenario. I'm reviewing the purchases book, and I realize it has been undercast by $100. My addition was short by $100. Consequently, when I took that wrong total and posted it to the general ledger, the purchases account received a debit that was $100 too small.
So your purchases account is starving for $100. It needs more debit weight. Because you caught this before making the trial balance, the fix is elegantly simple. You open the ledger, go to the debit side of the purchases account, and you literally just write a descriptive sentence explaining the top-up. The standard phrasing is, to undercasting of purchases book for the month, $100.
That's it. I don't need a corresponding credit somewhere else. I just write a sentence and drop the missing $100 onto the scale.
That's it. It's a one-sided adjustment. Let's do another one to reinforce it. Suppose you realize the returns inward book, which is just another name for sales returns, has been undercast by $50.
Okay, sales returns carry a debit balance because they reduce our credit sales. If the book was undercast, my total debit is $50 too small. The account is starving, so I just need to add $50 to the debit side of the returns inward account.
Exactly. You open the account, go to the debit side, and write. To undercasting of returns inward book, $50. You are simply topping up the account that was shortchanged by the math error.
Okay, stage 1 makes sense. If the concrete hasn't dried yet, you can just smooth it over. But what if we are too late? What if the concrete is dry? This brings us to stage 2. We've extracted all the balances, we've built the trial balance, and it flat out does not agree. The left side does not equal the right side. And let's raise the stakes. The CEO needs the financial statements finalized by 8 a.m. tomorrow morning for a massive bank loan application. I do not have time to go through all 6 detective steps today. What on earth do I do?
This scenario is why the accounting gods invented a very famous, or perhaps infamous, tool, the suspense account. It is a temporary holding pen. It acts as a mechanical shock absorber for your entire accounting system.
The shock absorber. I like that. How does it actually work to force the broken scale to balance?
Let's say you total your trial balance at midnight. The debit column totals $10,000. The credit column totals $9,900. You are short $100 on the credit side. The statements must be prepared immediately. You cannot submit an unbalanced trial balance to a bank. They will laugh you out of the room. So you have to artificially inject a credit of $100 to make the math work.
But I can't just invent a phantom $100 credit and hide it inside the sales account. That would be falsifying revenue.
Exactly. You cannot hide it in a real operational account. Instead, you create a brand new, highly visible folder called the suspense account. You put that artificial $100 credit into the suspense account. Now look at your trial balance. Debits $10,000, credits $9,900 plus suspense account $100. Total credits $10,000. The master scale balances.
Okay, so the math works, but where does that suspense account go when we print the actual balance sheet for the bank?
It hangs out right on the balance sheet. If it has a debit balance, it sits on the asset side. If it has a credit balance, like our example, it sits on the liability side. And let me be clear. It acts as a massive, glaring red flag to anyone who reads the statements. It screams, hey, we have unresolved errors in our books that we haven't found yet.
It's a temporary Band-Aid, but a very transparent one. So the bank meeting goes well, the weekend arrives, and the panic is over. Now I have time to do my detective work. I dig to the files, and I finally find the culprit. I realize that a month ago, a specific page in the sales book was undercast by $100.
Okay, let's trace the logic. The sales book was undercast. Sales are a revenue. They carry a credit balance. Because the total was too small, your sales account is starving for $100 of credit. How do you fix that?
I need to increase sales by 100, which means I need to credit the sales account by $100.
Correct. But here is the crucial difference from stage one. Because the trial balance has already been prepared and the suspense account has been opened, the concrete is dry. You can't just write a one-sided descriptive sentence anymore. You must write a complete double-entry journal containing both a debit and a credit. You know your credit is going to sales. What do you use for the debit?
This is where the shock absorber comes in. I use the suspense account for the debit.
Exactly. Think about the physical mechanics. The suspense account was sitting on the books with a temporary artificial credit balance of $100. By passing a journal entry to debit the suspense account for $100, you effectively neutralize it. You zero it out. You close the folder.
So the final formal journal entry to rectify the error found after the trial balance is debit suspense account 100, credit sales account 100.
Yes. The suspense account absorbed the imbalance when you were in a crisis, and then when you finally unearthed the truth, you use the suspense account to complete the double entry circuit and wipe the slate clean. It is a highly elegant system.
That is incredibly satisfying. It's like finding the missing puzzle piece that locks the whole picture together.
It really is. Now let's move to stage 3. This is the big leagues. Fixing two-sided errors using complete journal entries. These are complex errors that affect multiple accounts simultaneously. And this applies regardless of whether a suspense account was opened or not, because the error itself already possesses both a debit and a credit component.
And this is where the source material introduces a very specific methodology. I call it the three-step method.
The three-step method is the absolute most critical procedure for anyone taking an accounting exam, and it is the safest way for professionals to untangle complex messes. Human brains are not designed to hold all these moving debits and credits in our short-term memory simultaneously. If you try to jump straight to the answer in your head, you will fail. You must write it down in 3 distinct steps: the wrong entry, the correct entry, and the rectifying entry.
Wrong, correct, rectify. Let's do a deep dive walkthrough of this. Walkthrough number 1. Let's look at a classic error of principle. Scenario: $5,000 of office furniture was purchased by the company, but the exhausted bookkeeper wrongly debited it to the general purchases account.
Okay, apply the protocol. Step 1. What was the wrong entry? What did the confused accountant actually type into the system?
Well, they debited the wrong folder. They debited purchases for $5,000. And let's assume they paid via a bank transfer, so they credited the bank account for $5,000. So written down, the wrong entry is purchases account Dr. 5,000 to bank account 5,000.
Perfect. That is the flawed reality currently sitting in the books. Now, step 2. What should have been the correct entry? What is the actual economic truth of what happened that day?
The economic truth is we acquired a long-term asset. We bought furniture, so we should have debited the furniture account. The payment method was fine. Correct. Entry: furniture account Dr. 5,000 to bank account 5,000.
Excellent. Now we arrive at step 3, the rectifying entry. This is where we play matchmaker. We compare the wrong entry with the correct entry to figure out how to build a bridge between them. Let's look at the bank account first. In the wrong entry, bank was credited $5,000. In the correct entry, bank should be credited $5,000. What does that tell us?
It tells us the bank account is perfectly safe. The credit landed exactly where it was supposed to. We don't need to touch the bank account at all.
Precisely. We isolate the variables. Now look at the debits. We have a massive $5,000 debit sitting in the purchases folder that absolutely should not be there. And conversely, we are missing a $5,000 debit in the furniture folder that desperately needs to be there.
Okay, so we have to move the weight. How do we put the required debit weight into the furniture folder?
It's a simple addition. We debit the furniture account for $5,000.
Okay, furniture gets the debit. But how do we remove the wrong toxic debit from the purchases account? You can't just delete it. How do you kill a debit in accounting?
You neutralize it by applying an equal and opposite force. You kill a debit with a credit. So we credit the purchases account for $5,000.
Bring it all together.
Yeah.
The final, formal rectifying journal entry is debit furniture account, $5,000. Credit purchases account, $5,000.
Spot on. Furniture doctor $5,000 to put the asset where it economically belongs. To purchases $5,000 to reverse the erroneous expense entry. That is the three-step method in action. It provides a logical scaffolding that prevents panic.
Let's escalate the difficulty. Walk through number 2. This is a complex error of commission. And when I first read this scenario, my brain almost broke.
Lay it on me.
Here's the exact scenario. Purchases of $1,500 were entered in the sales book as a credit sale to a customer named Ram for $3,000.
That is a spectacular mess.
I really need to act out the economic reality of this confusion. We bought something. We purchased inventory worth $1,500. Money should be leaving our company. But somehow, some way, we recorded it in the system as if we were selling goods to a guy named Ram. And not only that, we recorded this entirely fake sale for double the actual price, $3,000. How on earth does a business function like this?
It happens when processes break down. Someone grabs an invoice from a messy pile on a desk. The invoice gets flipped upside down. The bookkeeper misreads the vendor name as a customer name. They have a typo on the keyboard, and they enter it into the totally wrong software module. It is a compound disaster. But this is exactly why the three-step method exists. Do not panic. Just follow the steps. Step 1, the wrong entry. What did the hallucinating accountant actually record in the books?
They truly believed it was a massive credit sale to Ram for $3,000. The standard entry for credit sale is to debit the customer because they owe us money and credit revenue. So they recorded Ram account Dr. $3,000 to sales account $3,000.
Correct. That is the fiction currently polluting the ledger. Now, step 2, the correct entry. Wipe away the fiction and look at the actual piece of paper. What was the reality?
The reality was a credit purchase for $1,500. Since Ram's name is the only one involved, we have to assume we bought the goods from Ram, acting as a supplier. The standard entry for a credit purchase is to debit the expense and credit the supplier. So it should have been. Purchases account, Dr. $1,500, to Ram account, $1,500.
A very sound assumption. Now we face the crucible. Step 3, the rectification. We have to dismantle the wrong entry and construct the correct entry simultaneously. Let's take it piece by piece. First, we have an entirely fabricated sale sitting on the books. We have a credit balance in the sales account for $3,000 that never happened. How do we erase a fake credit?
We use the opposite force. We have to debit it. So our first rectifying move is to debit the sales account for $3,000.
Exactly. Sales account Dr. $3,000. The fake revenue is dead. Next piece. We have a real legitimate purchase of $1,500 that was completely ignored by the system. How do we bring a purchase to life?
We record it normally. We debit the purchases account.
Yeah.
So our second move is purchases account Dr. $1,500.
Right. Let's pause and look at our progress. We currently have 2 debits in our rectifying journal. Sales Dr. $3,000 and purchases Dr. $1,500. That gives us a total debit weight of $4,500. Now, to make this a valid journal entry, we desperately need a corresponding credit of $4,500 to balance it. Let's look at the remaining variable, Ram's personal account. This is the trickiest part.
Okay, let's look at Ram. In the wrong entry, the bookkeeper debited Ram for $3,000. They officially declare that Ram owes us $3,000.
Yes.
But in the correct entry, we see the truth. We actually bought goods from him. We should have credited Ram for $1,500 because we owe him money. Oh man, Ram must be absolutely serious. We literally sent him a demand bill for $3,000 when in reality we owe him $1,500.
He is likely calling his lawyers right now. We have to fix his account immediately. Think of his account like a thermometer. The temperature is currently reading a positive 3,000 degrees. We need the temperature to drop all the way past zero, down to a negative 1,500 degrees. What is the total distance of that temperature swing?
To get from positive 3,000 down to zero, we drop 3,000. Then we have to drop another 1,500 to hit the target. The total swing is a massive 4,500.
Exactly. And because we need to pull his account balance down into creditor territory, we must apply a credit. We need to credit Ram's account for the entire total swing.
So the final piece of the puzzle is to RAM account 4,500.
Put the whole Frankenstein entry together and read it out.
The master rectifying journal entry is sales account, Dr. 3,000, which completely reverses and kills the fake sale. Purchases account, Dr. 1,500, which finally records the real, actual purchase. To RAM account 4,500, which swings his personal balance from owing us 3K to us owing him 1.5K. And let's check the math. Total debits are 3,000 plus 1,500, which equals 4,500. The total credit is 4,500. The journal balances perfectly.
That is masterful rectification work. Do you see how trying to calculate that $4,500 credit in your head without writing down the steps would be nearly impossible?
Impossible. My brain would have melted trying to figure out why a $1,500 mistake required a $4,500 adjustment. But mapping out the wrong versus correct makes the logic undeniable.
That is the power of the framework. Let's do two more, focusing deeply on the economic reality of the mistakes. Walkthrough number 3. This one tests your understanding of the business entity concept. Scenario. The proprietor of the business withdrew $1,000 in cash to pay for his family's personal groceries. However, the bookkeeper wrongly debited this $1,000 to the trade expenses account.
Okay, let's unpack the philosophy here before we do the entry. The business entity concept dictates that the business and the owner are two completely separate people in the eyes of accounting. The business's money is not the owner's personal piggy bank.
Exactly. When the owner extracts cash for personal use, it is not an operational expense of running the company. It does not reduce the company's taxable profit. It is a withdrawal of equity. We call this drawings.
So by putting the grocery money into the trade expenses folder, the bookkeeper essentially told the government, hey, we spent $1,000 running the business, please lower our taxes, which is tax evasion if not caught.
It is a massive compliance issue, so let's fix it using the 3 steps. Step 1, wrong entry. What do?
They debited an expense. Wrong entry. Trade expenses, Dr. 1,000 to cash 1,000.
Step 2, correct entry. What was the truth?
The owner took equity out. Correct entry. Drawings account, Dr. 1,000 to cash 1,000.
Step 3, rectify. The cash account is fine. Money did leave the building. We just have to fix the debits. We have a toxic debit in trade expenses. We are missing a crucial debit in drawings.
We put the debit where it belongs. Drawings account, Dr. 1,000. And we neutralize the toxic expense by crediting it to trade expenses 1,000. The fix is clean and restores our tax compliance.
Beautifully reasoned. Now for one final, highly conceptual challenge. Walkthrough number 4, scenario. Last year, a customer named Mahesh Chan went bankrupt. He owed us $2,000, but we gave up hope and formally wrote it off as a bad debt. Fast forward to today. Mahesh's conscience gets to him, and he unexpectedly sends us a check for the $2,000. We recover the bad debt. However, the bookkeeper excitedly takes the check and wrongly posts it to the credit of Mahesh Chan's personal ledger account.
Okay, my instincts are flashing red, but I have to think through why this is wrong. When someone pays you money they owe you, you normally do credit their personal account to reduce their debt. Why is it wrong here?
This is a conceptual trap that catches almost everyone. You have to remember the history of the account. Last year, when Mahesh went bankrupt, what did we do? We didn't just leave his debt hanging there forever. We passed an entry. Bad debt expense, Dr. 2,000 to Mahesh Chan 2,000.
We already credited him. We closed his folder out to zero. From the perspective of our ledger, Mahesh Chan doesn't exist anymore. He doesn't owe us a dime.
Precisely. His account was dead. So today, when he unexpectedly pays us back, it is considered a sudden, joyful gain for the business. It is free money. It should be credited to a special nominal gain account called Bad Debts Recovered.
So what did the bookkeeper actually do? By crediting Mahesh's debt account today, what did they create?
Think about the scale. His balance was zero. The bookkeeper dropped a $2,000 credit weight onto his side of the scale.
Oh my God. They essentially created a liability. By crediting his account, they made our books declare that we suddenly owe Mahesh $2,000. He gives us a check, and we record it as if we took a loan from him.
It is entirely backward. We must rectify this immediately. Step 1, wrong entry. Bank Doctor 2000 to Mahesh Chand 2000.
Step 2.
Yep.
Correct entry. Bank Doctor 2000 to Bad Debts Recovered Account 2000.
Step 3. Rectify. The bank received the money, so the debit to bank is safe. We just need to fix the credits. We have a toxic credit sitting in Mahesh's account, making it look like we owe him money. We are missing the credit in the gain account.
To kill a credit, we debit. So we debit Mahesh Chan for $2,000 to bring his balance back to zero where it belongs, and we credit the gain account to recognize the profit. To Bad Debts Recovered Account, $2,000.
That is the highest level of accounting logic. It really is like untangling a knotted fishing line. You can't just pull as hard as you can. You have to follow the specific thread of logic back to the source.
It is incredibly satisfying when the knot finally comes loose. And that logical, methodical procedure is really what separates a data entry clerk from a true accountant.
I couldn't agree more.
Okay, we have covered a monumental amount of ground today. We've walked through the entire life cycle of an error. Let's bring it all together for a final, comprehensive recap so our listeners can lock this in for their exams and their careers.
Let's summarize the core takeaways. First and foremost, remember the fundamental definition. Errors are unintentional mistakes. They are the result of human fallibility, tired eyes, slipping fingers, or conceptual misunderstandings. They are not intentional fraud.
Secondly, we explored the timeline. These mistakes generally inject themselves either during the initial recording phase in the diaries, the subsidiary books, or during the subsequent posting and casting phases when we transfer data into the ledger folders. And as we saw, a mistake early on creates a devastating domino effect.
Third, we introduced the ultimate classification framework, the POCC mnemonic.
P for principle, the rule breakers. Treating a long-term asset like a mahogany table is a short-term expense. These are the most dangerous, because the trial balance scale remains perfectly balanced, hiding the distortion from business owners and banks. O for omission, the ghosts. Completely forgetting an invoice keeps the scale balanced, but partially forgetting one half of an entry shatters the symmetry. C for commission, the clerical blunders. The fat fingers, the wrong side postings, the math errors, the primary culprits behind a broken trial balance. And finally, C for compensating the suitcase analogy. Two completely separate mistakes that miraculously cancel each other out mathematically, keeping the master scale happy while wrecking the internal folders.
An excellent synthesis. And for the practitioners and exam candidates, remember your diagnostic toolkit. If the trial balance breaks, use the having the difference trick to hunt for wrong side postings. If you are off by $2,000, search the ledgers for a $1,000 transaction.
If you are out of time and the bank needs the reports, deploy the suspense account as your mechanical shock absorber to force the scale to balance. But remember, you must hunt down the error and close that account later.
And finally, when you are untangling complex, two-sided errors, absolutely rely on the three-step method. Write down the wrong entry, write down the correct entry, and use deductive logic to build the rectifying entry that bridges the gap. Do not try to be a hero and do it in your head.
Now, before we sign off, I want to ask you a broader philosophical question. We have spent an hour talking about calculators, manual casting, and ledgers. But we live in the 21st century. In the real world, almost every business, from mom-and-pop shops to global conglomerates, uses advanced accounting software like QuickBooks, Xero, or massive SAP systems. Does this technology make everything we just talked about entirely obsolete?
That is the most important question we could end on. And the answer is a resounding, definitive no, it does not make it obsolete. Here is the final thought I want every listener to deeply internalize. It is absolutely true that modern accounting software completely eradicates simple errors of commission. A computer processor will never, ever cast a column incorrectly. It will never make an addition mistake. Furthermore, the software physically prevents the trial balance from disagreeing because it literally will not allow a user to save a one-sided journal entry. The save button is grayed out until debits equal credits.
So the software acts as an impenetrable shield against math errors and partial omissions.
Yes, it enforces mathematical perfection. But here is the fatal flaw. Technology cannot prevent errors of principle. Software is, fundamentally, a very fast, very obedient, completely blind idiot. It only knows what the human user tells it.
Oh, I see where this is going.
Think about it. If an untrained employee receives an invoice for a brand new $50,000 company delivery van, and they open the software, select new bill, and casually code it from a drop-down menu as a regular office supply expense, the computer does not argue. The computer happily records it. The computer ensures the debits equal the credits perfectly. The software will generate beautifully formatted, mathematically flawless financial statements. But the underlying economic reality is a complete disaster. The company's assets will be understated by 50,000, and their reported profit will be crushed by 50,000.
The software executes the human's conceptual failure flawlessly.
Exactly. Technology does not replace the need to deeply understand the economic nature of transactions. In fact, I'd argue it makes understanding principles more critical than ever before. Because the software generates reports that look so professional and so perfectly balanced, it lulls business owners into a false sense of absolute security. The machine says it's perfect, so they believe it's perfect. It still requires an educated human brain to look at the ledger and ask, wait, why did we spend $50,000 on office supplies this month?
That's a brilliant perspective. The tools have evolved, but the underlying philosophy of what makes a business tick remains exactly the same.
A human judgment is irreplaceable.
What an incredible place to end our investigation. To our listeners, we heavily encourage you to apply these detective skills to your own studies or your own businesses. When you look at an error in a textbook or in your software, don't just try to memorize the mechanical fix. Step back and ask yourself, what story is this error telling me? How did this business transaction jump off the rails?
Practice the 3-step rectifying journal entries on scratch paper until they become second nature. Because every accounting error is just a puzzle waiting to be solved. And now you have the master key to solve them all.
Until next time, keep your debits firmly on the left, keep your credits on the right, and may your trial balances always agree, naturally without the need for a shock absorber. We will see you on the next deep dive.
Yeah.
So imagine you are an accountant,
Right.
and you are sitting in this dimly lit office.
Oh, I know this scenario.
Yeah, it's like 11:30 at night on the very last day of the financial year.
The absolute worst time.
Literally the worst. You've spent weeks, maybe even months, meticulously recording thousands of transactions.
Right.
You've tracked every single invoice, every petty cash receipt, every massive equipment purchase.
Just drowning in paperwork.
Exactly. So you take a deep breath, you hit a button to run your trial balance, and the screen loads. The total debits sit there in black and white,
Okay.
and the total credits sit right next to them, and they do not match.
Oh, man, your stomach just dropped.
It drops completely. Panic sets in. You are staring at this, multi-million-dollar discrepancy.
Yeah, somewhere in that labyrinth of ledgers, a mistake has been made.
Right. And what do you even do? Do you start from page 1 and manually check tens of thousands of lines?
Nobody wants to do that.
Nobody. Or, do you fudge the numbers to make it balance and just pray the auditors don't notice?
Which is illegal, obviously.
Honestly, yeah. But the reality is, the very fabric of our global economy relies on the absolute precision of these ledgers.
It really does. When they break down, businesses collapse.
So welcome to today's deep dive into the accounting process. Specifically, we are looking at the detection and rectification of accounting errors.
It is the ultimate nightmare scenario for anyone in finance, honestly.
It really is.
It feels like hunting for a needle in a haystack, except, the haystack is made of millions of numbers.
And the needle is just one misplaced decimal point.
Exactly. Just one little dot. And the stakes couldn't be higher. We often think of accounting as just dry math. But it's the language of business truth.
The language of truth. I like that.
Yeah, because when the math is wrong, the truth is obscured. It's how minor clerical errors bankrupt small businesses.
Right.
And it's how massive intentional misclassifications bring down global titans, like Enron or WorldCom.
Which is exactly what we are dissecting today. We are breaking down the anatomy of accounting errors, how they are born, how they hide in plain sight.
And most importantly, how to hunt them down.
Yes, how we hunt them down and neutralize them. Because whether you are a student preparing for a brutal finance exam or, an auditor walking into a chaotic corporate environment.
Or just someone trying to understand the news.
Right, like trying to figure out how a billion-dollar company can suddenly report a massive loss due to an accounting irregularity. You really need to understand the mechanics of the mistake.
Absolutely. And the foundational concept we have to grasp before we can fix an error is understanding what the system is designed to do in the first place.
Right, the basics.
Yeah. Modern business relies on double-entry bookkeeping. It's a system popularized back in the 15th century by a Venetian mathematician named Luca Pacioli.
Good old Luca.
Good old Luca. And the golden rule is elegantly simple, right? For every action, there is an equal and opposite reaction.
Newton's third law, but for money.
Exactly. Every time value moves, it must be recorded twice. Once where it came from and once where it went.
Right.
So a debit must always have a corresponding credit.
So if I buy a laptop for the business, my equipment asset goes up, that's a debit.
Correct.
But my cash goes down, so that's a credit. The universe remains perfectly balanced.
Precisely. And the trial balance is simply the ultimate test of that equilibrium.
Right.
At the end of the year, you take the final balances of every single account, your cash, your debts, your sales, your rent expense, and you line them up.
Left and right columns.
Yeah, all the accounts with the debit balance go in the left column. Accounts with the credit balance go in the right column. You add them both up.
And if the universe is in harmony, those two final numbers will be identical to the penny.
Right. But our panicked accountant from your intro is staring at a screen where they aren't identical.
Which means the golden rule was broken somewhere.
It was broken.
Let's unpack how that actually happens. I want to look at the taxonomy of these errors. There is a remarkably helpful memory trick in our source material for categorizing these mistakes.
Ah, yes. The POCC framework.
Right, POCC, that's POCC.
Identifying the category is really half the battle. POCC stands for the 4 foundational types of accounting errors: principal, omission, commission, and compensating.
Principal, omission, commission, compensating. Got it.
When you find a discrepancy, your very first analytical step is sorting it into one of these 4 buckets.
Let's start with the O errors of omission. Conceptually, this feels like the most straightforward one.
It is. The transaction just simply evaporated.
Like you bought goods from a supplier, the goods arrived, but the invoice just slipped behind a filing cabinet and never entered the accounting system at all.
A complete omission. And here's the terrifying part about a complete omission. It's a silent killer.
A silent killer. Why?
Because the transaction never entered the system, neither the debit nor the credit was recorded.
Oh, I see.
So therefore, the mathematical equilibrium of your ledgers remains perfectly intact.
Wow. Okay.
Your trial balance will still tally perfectly at the end of the year, completely masking the fact that your liabilities are actually higher than reported because you still owe that supplier money.
It is the illusion of accuracy. The math checks out, but the reality is fundamentally wrong.
Exactly.
But omission isn't always complete, is it? What if the invoice didn't fall behind the cabinet, but the accountant just got distracted halfway through recording it?
That brings us to a partial omission. So let's say you properly recorded the purchase in your subsidiary purchase book. That's your initial entry.
Right.
But later, when it was time to transfer that information, to post it into the individual ledger account of the supplier, you skipped it.
Oh, you just forgot that specific step.
Right. Now, you have a problem. Your total purchases will eventually be debited, but the specific supplier was never credited.
The universe is out of balance.
Exactly. This kind of error absolutely will trigger a discrepancy on your trial balance.
So complete omissions hide in the shadows, but partial omissions trip the alarm system.
That's a great way to put it.
That leads us to the first C in the framework, errors of commission. I tend to think of these as the clumsy errors.
Clumsy is the perfect descriptor.
Like the human element just failing under the pressure of repetition.
Yeah, these are mechanical, clerical slip-ups. The transaction was entered, but the hands on the keyboard fumbled.
Like a typo.
Exactly. You might write 5,000 instead of 500. You might post a transaction to the correct account, but place it on the debit side instead of the credit side.
Ouch.
Or you might simply mess up the arithmetic when adding up a long column of numbers in a sales book.
I can easily see how this happens. You know, you are processing 500 invoices a day.
Your brain just turns to mush.
Right. You have an invoice for a sale to a customer named Mr. Gansham. You enter the amount perfectly. You record it as a sale perfectly.
What?
But when you type in the customer name, you accidentally click on Mr. Radhasham from the dropdown. A completely different customer.
The infamous wrong account posting. This is a classic error of commission. Now think about the physical movement of that value.
Okay.
You have successfully recorded that the business earned revenue. You successfully recorded that someone owes you money.
Right. The system just thinks Radhasham owes us now.
Exactly. The total debits and credits in the company's ledger are perfectly equal. The trial balance will tally and tell you everything is fine.
Even though it's totally wrong.
Yeah. But when you send Mr. Radhasham a bill for goods he never bought, while Mr. Gansham gets off scot-free, your customer relations department is going to have a very bad day.
Oh yeah, they're going to be furious. Which proves again that a tallied trial balance is a test of arithmetical accuracy, not a guarantee of absolute truth.
Exactly. Math doesn't equal truth automatically.
Okay, so clumsy typing is one thing. But the P in POCC, errors of principle, that seems entirely different. This isn't a slip of the pen, right?
Oh, not at all.
This is a fundamental misunderstanding of the rules of the game.
Errors of principle are the most dangerous mistakes in accounting, and they are frequently the mechanism behind massive corporate fraud.
Really? Corporate fraud.
Oh, absolutely. An error of principle occurs when you violate the core doctrines of accounting, most commonly failing to distinguish between capital expenditure and revenue expenditure.
Okay, let me try an analogy here to see if I am grasping the gravity of this.
Go for it.
If an error of commission is like accidentally painting your living room the wrong shade of blue, an error of principle is like pouring diesel fuel into a gasoline engine.
Oh, I like that.
Because the liquid is in the tank. The fuel gauge reads completely full, so on the surface, looking at the dashboard, everything appears normal.
The trial balance tallies.
Right, the trial balance tallies. But the internal chemistry is fundamentally incompatible. And the moment you try to run the engine, the entire vehicle destroys itself.
That analogy is spot on. The numbers are in the system, but the structural integrity is compromised.
Give me a real-world example of that.
Let's look at a very common, seemingly innocent example from our source material. A business, let's call them Jane Brothers, decides to sell off some old office furniture.
Okay, furniture is an asset.
Right. When they sell it, they receive cash. They correctly debit their cash account. But instead of crediting their furniture account to show that the asset is gone, they credit their sales account.
Wait, they treated selling their own desks the same way they treat selling their actual retail products.
Yes. Now, trace the impact of that mistake. Because they credited sales, which is a revenue account, their income for the year is artificially inflated.
Wow, okay.
When they generate their profit and loss statement, it will look like they had an incredibly successful year of trading.
Even though they just sold a desk.
Exactly. And they will likely end up paying higher taxes on a profit they didn't actually earn from their core business.
And it gets worse. Right. Because they never credited the furniture account, their balance sheet still lists those old desks as valuable assets owned by the company, even though they are literally sitting in someone else's office.
Precisely. Their assets are overstated, their revenue is overstated, and their profit is an illusion.
That's wild.
But the math worked perfectly. One debit, one credit. So the trial balance smiled and waved it through.
This is exactly what happened with the WorldCom scandal in the early 2000s, wasn't it?
Yeah.
But like in reverse.
Yes, exactly in reverse.
They took billions of dollars of regular day-to-day operating expenses, things like paying for access to telecom networks, and they capitalized them.
Right.
They recorded those expenses as if they were buying long-term assets.
It is the ultimate real-world manifestation of an error of principle. By hiding their massive daily expenses on the balance sheet as assets, their expenses looked incredibly low.
And their profits looked artificially massive.
Exactly. Wall Street kept throwing money at them because the profit and loss statement looked stellar.
But the foundation was entirely rotten.
Completely rotten. When the auditors finally realized those assets were just thin air and regular expenses, the company collapsed into bankruptcy. It destroyed billions in shareholder value.
All because of a fundamental violation of capital versus revenue classification.
Yes.
That is terrifying. It really elevates this beyond just, passing a finance exam. This is about the survival of an enterprise.
It absolutely is.
Now, what about the final C? Compensating errors?
Compensating errors are a statistical nightmare. This happens when the effect of one error is perfectly neutralized by the effect of a completely unrelated error.
Like a coincidence of mistakes.
It's a very dark coincidence. Imagine you're recording a purchase and you accidentally over-debit the purchase's account by $5,000.
Okay, so your ledger is now heavily unbalanced on the debit side.
Right. Your trial balance will definitely fail at this point.
Good.
But 3 weeks later, a different clerk is recording a massive sale, and they accidentally overcredit the sales account by exactly $5,000.
Oh, you have got to be kidding me. Two wrongs mathematically making it right.
Yes. The debit column is artificially heavy by $5,000. The credit column is artificially heavy by $5,000. They match.
And because they match, the trial balance gives you the green light.
Compensating errors are incredibly difficult to detect because the system's primary defense mechanism, the imbalance, has been deactivated by pure chance.
Okay, so we have the POCC framework. Principal, omission, commission, compensating. We know the enemy.
We do.
But knowing the type of error doesn't tell us how to fix it. If I am the accountant and I spot one of these mistakes, what is my very first physical move?
Your first move is to look at the calendar.
The calendar. Why?
Because the method of rectification does not depend entirely on what the error is. It depends heavily on when you discover it in the accounting cycle.
Wait.
The timeline dictates the treatment. We divide this timeline into 3 distinct stages.
Right, what are they?
Stage 1 is catching the error before the trial balance is prepared. Stage 2 is catching it after the trial balance is prepared, but before the final financial statements are locked in.
And stage 3?
Stage 3 is the nightmare scenario, finding the error in the next accounting year.
Okay, let's start with the best case scenario then. Stage 1, it's August. The financial year doesn't end until December.
Plenty of time.
Right. I am reviewing the purchase ledgers, and I realize a junior clerk undercast the purchase book by $1,000.
Undercast meaning they just added the column of numbers wrong.
Exactly. So the total posted to the purchases account is $1,000 too low. The trial balance hasn't been drafted yet. How do I fix it?
Well, because you are in stage 1 and you have found a one-sided error, the fix is elegantly simple.
Okay.
You do not need a complex double-entry journal correction. You simply open the purchases ledger account, go to the debit side, because purchases have a debit balance and we need to increase it.
Right.
And you just write an explanatory statement, something like, to undercasting of purchase book, 1,000. You draw a line, add it to the total, and you are done. Localized surgery.
Wait. I have to pause you right there.
Yeah.
Because my foundational understanding of accounting is screaming that this is heresy. We just spent the first 20 minutes establishing that Luca Pacioli's double entry system is sacred. Every debit must have a credit.
Yes, that is the rule.
And you are telling me I can just open a ledger and scribble a one-sided debit entry into the margin. Isn't that intentionally breaking the universe?
It feels like breaking the rules, I know, but we have to look at the mechanics of the error itself.
Okay, break it down for me.
The error was an undercasting of a subsidiary book total. The individual transactions inside that book, the credits to all the individual suppliers who sold you those goods, those were already posted correctly one by one throughout the month.
Oh, I see.
The suppliers' accounts are perfect. The only account in the entire company that is sick is the general purchases account.
So only one side of the scale is actually broken.
Exactly. If you tried to force a formal double entry journal entry right now, you would debit purchases for 1,000 to fix the shortage. But what would you credit?
I couldn't credit the suppliers. They're already fine.
Right. And if you credit cash, you are lying because no cash moved today. If you try to invent a double entry for a one-sided error, you are forced to sabotage a perfectly healthy account just to satisfy the format of a journal entry.
That makes total logical sense. You don't perform surgery on a healthy organ just because the other one needs a stent.
Perfect analogy. So in stage 1, before the trial balance locks everything into place, we are allowed to perform that localized surgery. We heal the sick account with a one-sided statement and leave the healthy accounts alone.
Okay, I get it now. But the window for that localized surgery closes eventually.
It absolutely does.
The clock strikes midnight on the financial year. We arrive at stage 2. We run the trial balance. And as we established at the beginning of our deep dive, it does not tally.
The worst case scenario.
We have a discrepancy. The books must be closed. The tax authorities are waiting for our profit numbers, and we cannot find the error. What happens now?
Now, you are forced to manipulate the system to buy yourself time.
Manipulate the system.
Yes. You cannot finalize financial statements if the foundational math doesn't balance. So accountants created a magical, temporary holding pen.
A holding pen.
We forced the trial balance to agree by dipping the mathematical difference into a newly created ledger called the suspense account.
The suspense account. I love this concept. I've always visualized this as the financial equivalent of a junk drawer in your kitchen.
A junk drawer. I like where this is going.
You know the scenario. Guests are arriving in 5 minutes. The kitchen counter is covered in unread mail, loose batteries, rubber bands, and receipts.
Absolute chaos.
Right. You don't have time to sort it, so you sweep it all into the junk drawer and slam it shut.
Out of sight, out of mind.
Exactly. The kitchen looks immaculate, the house is presentable, but deep down, that drawer is a chaotic mess. And eventually, you will have to open it, pull out every single item, and figure out where it actually belongs.
The junk drawer is the perfect analogy. The suspense account is an artificial plug. It has no underlying economic reality. It exists purely to satisfy the mathematical requirement of the trial balance.
So how does it actually work mathematically?
Here is the mechanical rule. You look at your broken trial balance. If the total credits exceed the total debits, your ledger is too light on the debit side.
Okay.
So you open the suspense account with a debit balance for the exact amount of the difference. The scale is now balanced.
And if the debits are heavier than the credits, the suspense account takes a credit balance to prop up the right side.
Correct. The house looks clean, the financial statements can be drafted, but the moment that suspense account exists, the rules of rectification fundamentally transform.
Right, because now the trial balance is artificially in perfect harmony.
Yes. You can no longer perform localized, one-sided surgery.
Because if I just scribble a one-sided adjustment into a ledger now, I will break the artificial harmony I just created.
Precisely. In stage 2, every single error you uncover, even if it is a one-sided error, must be fixed using a complete double-entry journal entry.
But how do I write a double entry for an error that only affects one account? What is the other half of the transaction?
The junk drawer. The suspense account becomes the counterweight for all your corrections.
Oh, I see.
You fix the actual broken ledger account with a debit or credit, and you park the opposite entry in the suspense account. As you find more and more errors, you are constantly debiting and crediting the suspense account, slowly emptying the junk drawer piece by piece.
Okay, let's put this theory into practice. Let's walk through a masterclass in stage 2 rectification.
Sounds good. Let's do it.
Imagine a local manufacturer brings us his ledgers. Let's call him Mr. Dutt. His trial balance failed. It showed an excess credit of $493.
Okay, step 1 is setting the board. The trial balance has an excess credit of $493. That means the debit side is suffering a shortage. So we open our suspense account, our junk drawer, with a starting debit balance of $493. That is the target we have to eliminate.
All right, the drawer is open. Mr. Dutt hands us his notes, and we start digging through the chaos.
Yeah.
Here's the first mistake we find.
What is it?
An amount of $100 received from a client, Dito Das, on the last day of the year was entirely omitted from the cash book.
Okay, we immediately apply our POCC framework. This is an error of omission, specifically a complete omission. Because it never entered the primary cash book, it never flowed into the ledgers at all.
So it's the silent killer. It didn't actually cause our $493 imbalance.
Exactly. And because both sides of the transaction are missing, the fix is straightforward. We just record the reality of what happened.
Okay, so what did the business receive? Cash. Cash is a real account. It increases with a debit.
Yes.
So we debit cash account for 100.
Yeah.
And who provided the benefit? The client, DDAS. So we credit DDAS for 100.
Spot on. And notice we didn't touch the suspense account at all for that one, even though we are in stage 2.
I was going to ask about that. Why didn't we?
We didn't touch it because a complete omission never affected the trial balance in the first place. You only use the suspense account as a plug for errors that actually threw the math out of alignment.
That makes perfect sense. Since this error was completely missing, the double entry fix creates its own perfect balance.
Exactly. Next error.
Okay, digging back into the notes, here's the next error. The total of the returns inward book for December was cast short by $100. Someone messed up the arithmetic.
An error of commission, a casting error. Let's trace the logic. Returns inward means our customers are returning goods to us. It is the opposite of a sale.
Right.
Since sales generate a credit balance, returns inward must logically carry a debit balance. The book was cashed short, meaning the total transferred to the ledger was too low. The returns inward account is starving for more debits.
So the fix begins by feeding it what it needs. We debit the returns inward account for $100.
Correct, but now we have a problem. The individual customers who returned the goods were already credited correctly throughout the month when the individual lines were recorded.
Right, their personal accounts are fine.
Yes. We only have a one-sided error in the aggregate total. We cannot credit the customers again.
Ah, this is where we reach into the junk drawer.
Yes, it is.
We need a credit to balance our $100 debit, so we credit the suspense account for $100.
You've got it! We fix the real account, and we use the suspense account to absorb the shockwave of the double entry.
I love that.
Yeah.
Okay, let's tackle a thornier one. An error of principle. Mr. Dutt paid $375 in wages to workmen specifically for building new permanent display showcases for the factory floor.
Okay.
But the bookkeeper just charged that $375 to the regular wages account.
Oh, boy. This is a classic violation of capital versus revenue classification.
Just like the diesel and the petrol car.
Exactly. The workmen were not performing daily operational labor. They were constructing a long-term asset. The rules of accounting dictate that any cost incurred to bring an asset into existence or into its working condition must be capitalized.
It has to be added to the value of the asset itself.
Yes.
So treating it as a regular wage expense falsely lowered the company's profit for the year and hid a valuable asset from the balance sheet.
Exactly. Let's fix it. The cash went out the door correctly, so the cash account is fine. The problem is entirely between the wages account and the asset account.
Okay.
We have an incorrect debit sitting in the wages account. How do we kill a debit?
We hit it with a credit. We credit the wages account for $375 to zero out that specific mistake.
And where does that value belong? It belongs in the structural value of the business. So we debit the furniture account or showcases account for $375.
We have successfully moved the value from a temporary expense into a permanent asset.
Yes. We capitalized it.
And again, no suspense account needed because we are fixing a two-sided misclassification. The error was perfectly symmetrical, so the fix is perfectly symmetrical.
You are getting the hang of this.
Let's do one more principal error because this one is deeply psychological.
Oh, I love the psychological one.
Mr. Dutt took $1,000 out of the company bank account to buy a personal motorcycle for his weekend trips.
Of course he did.
But the bookkeeper charged it to miscellaneous expenses account.
The psychology of the small business owner. There is always a temptation to run personal lifestyle costs through the business to reduce the taxable profit.
It's so common.
But the business entity concept is a foundational rule. The business and the owner are completely separate entities. If the owner takes cash for personal use, it is not a business expense. It is a withdrawal of their own capital. We call this drawings.
By hiding the motorcycle in miscellaneous expenses, they're basically lying to the tax authorities about their operating costs.
We have to reverse the lie. We have a false debit of $1,000 sitting in expenses. We neutralize it by crediting the miscellaneous expenses account for $1,000. That restores the profit.
And then we must record the reality of the withdrawal.
Right.
So we debit the drawings account for $1,000, which will eventually reduce the owner's total equity in the business.
Exactly.
Okay, one final error from Mr. Dutt. A check for $200 received from a client, PC Joshi, was dishonored by the bank. It bounced,
Okay.
but the bookkeeper mistakenly passed the debit to the allowances account.
This requires us to visualize the timeline of a check. When PC Joshi originally handed us the check, we assumed it was good.
We banked on it, literally.
Right. We debited our bank account because we thought we had more money, and we credited PC Joshi's personal account, effectively wiping out his debt to us. He was cleared.
But 3 days later, the bank calls. The check bounced. The money isn't there.
The reality has reverted. We have to reverse our original entry. We have to credit the bank because we don't actually have the funds. And critically, we have to reinstate PC Joshi as a debtor.
We have to debit his account to show he still owes us $200.
Yes. But the clumsy bookkeeper didn't debit Joshi, they debited allowances.
They essentially treated the bounced check as if we generously gave Joshi a $200 discount.
An incredibly generous and entirely fraudulent mistake. We have to fix it. We have a false $200 debit in allowances, artificially increasing our expenses. We credit the allowances account for $200 to erase it.
And we finally reinstate the debtor. We debit PT Joshi's account for $200. He is back on the hook for the money.
Perfect.
Okay, we have hunted down every error on Mr. Dutt's list. We've been making all these entries, some touching the suspense account, some not. This leads to the most satisfying moment in all of accounting.
It really is.
If we were to take out a fresh sheet of paper right now, draw a giant T account for the suspense account, start with our opening debit balance of $493, and post every single correction we just made.
The balance will be exactly zero. The debits will perfectly match the credits. The junk drawer is completely empty.
Wow.
And that mathematical zero is profound. It isn't just a number, it is absolute proof that you have found and rectified every single one-sided error that was causing the fundamental imbalance. The crisis is over, the books are clean.
It is a phenomenal feeling of order being restored to chaos. But, the journey of hunting these errors is filled with psychological traps.
Oh, absolutely.
Our brains naturally want to solve problems in the most direct way possible, which, in accounting, is often mathematically disastrous. Let's explore the deadliest trap of them all. Let's call it the double amount trap.
This trap catches seasoned professionals and exam students alike because it preys on our intuitive sense of fairness. It happens specifically when a transaction is posted to the wrong side of an account.
Okay, let's set up a scenario for you listening. We owe a supplier, Trivedi & Co., some money. We make a payment, which means we should debit their account to reduce our liability by $800.
That's what should happen.
But in a moment of sheer clumsiness, the bookkeeper credits Trivedi's account for $800 instead.
So instead of showing that our debt went down, the ledger now incorrectly shows that our debt to them increased by $800. It's a massive swing in the wrong direction.
Now, here is where human intuition fails. I am reviewing the books. I see an $800 mistake sitting on the credit side. My brain says, well, the problem is $800. I need to put an $800 debit in there to fix it.
Right. That's what everyone thinks.
So my instinct is to write a journal entry. Debit Trivedi & Co. for $800. Mistake was $800. The fix is $800. Problem solved, right?
And that instinct is entirely mathematically wrong.
Break it down for me. What?
Let's visualize the ledger. Right now, there is a heavy $800 weight sitting on the credit side of the scale. If you pass a rectification entry that debits Trivedi for exactly $800, what physically happens to the scale?
The $800 debit exactly cancels out the $800 credit. The scale balances. The account is at zero.
Exactly. The balance is zero. But is the reality of the business zero?
No.
No. The reality is that you made a payment and you were supposed to have an $800 debit balance reflecting that reduction. By only posting $800, you have only completed half the job. You successfully erased the mistake, but you failed to record the truth.
Oh, I see the trap. Erasing a mistake doesn't automatically write the correct history. I need the account to actually show a debit of $800, which means I have to double the amount.
Precisely. To fix a wrong side posting, the rectification amount must always be double the original error. You must pass a journal entry to debit Trivedi & Co. for $1,600.
Wow, $1,600.
Right. Let's break down the journey of that $1,600. The first $800 of that entry acts as a missile, right? It flies over to the credit side, neutralizes the wrong entry, and brings the account balance to zero.
Okay.
The second $800 then settles into the debit side, establishing the correct factual reality that should have been there all along.
So a mistake of $800 requires a fix of $1,600. It feels so counterintuitive until you visualize the movement of the value. If you are ever fixing a wrong side error, double the number.
Double the number, always.
This brings us to another massive conceptual hurdle. When we are making these fixes in stage 2, the end of the year is looming. The most important number to any business owner, investor, or tax authority is the net profit.
The bottom line.
Right. Every time we tweak a ledger, we risk changing the bottom line. How do we quickly analyze the impact of our corrections on the company's profit without having to draft an entirely new profit and loss statement from scratch?
You need a reliable mental framework based on the fundamental nature of the accounts you're touching. It all boils down to distinguishing between nominal accounts and everything else.
Remind us what nominal accounts are.
Nominal accounts are your temporary accounts, your incomes, your revenues, your expenses, your losses.
Okay, and the others.
Real and personal accounts are your permanent assets, liabilities, and equity. The golden rule for profit impact is this: only adjustments to nominal accounts change your profit.
Because profit is literally just income minus expenses. If I touch a debtor's account or fix the value of a machine, it doesn't change how much money the business actually earned through operations.
Exactly. So when you are looking at your rectification journal entry, you ask yourself a sequence of questions. First, does this entry involve a nominal account? If the answer is no, like if you are just debiting a debtor and crediting suspense, your profit is unaffected.
Right.
But if the answer is yes, you move to the second question. Does this entry increase my income or decrease my expense? If it does either of those things, your net profit will rise.
Because reducing an expense acts mathematically like a gain.
Yes. And conversely, if your rectification entry decreases in income or increases in expense, your net profit will fall.
Let's stress test this framework with some rapid-fire scenarios. Let's say I am auditing a company, and I find out their bookkeeper casted the miscellaneous expenses account in excess by $5,000. They added the column wrong, and the expenses are recorded too high. What is the impact on profit when I fix this?
Okay, follow the framework. The error is in a nominal account, expenses. To fix an expense that is too high, we must credit the expense account to reduce it. We are decreasing an expense. Decreasing an expense is a mathematical game for the business. Therefore, rectifying this error will actively increase the reported profit by $5,000.
The owner will be thrilled.
Very thrilled.
Next scenario. The sales account was undercast by $10,000. They forgot to carry a page total forward.
Sales is a nominal account representing income. It is currently sitting $10,000 too low. To rectify this, we must credit the sales account to bring it up to its true value. We are increasing an income. Increasing income directly increases profit. The fix boosts profit by $10,000.
What about this one? It's a bit of a hybrid. A check for $5,000 issued to a supplier was wrongly debited to the purchases account instead of the supplier's personal account.
This is an error of principle crossing the boundaries. Purchases is a nominal expense account. The supplier's account is a personal liability account. By mistakenly debiting purchases, the company accidentally created a $5,000 expense out of thin air.
They made their business look less profitable than it actually was.
Exactly. To fix it, our journal entry must remove that false expense. We will credit the purchases account for $5,000 and debit the supplier.
Okay, looking at the nominal side of that fix, we are crediting, which means reducing an expense.
And reducing an expense increases profit. This fix boosts the bottom line by $5,000.
Let's look at one that hurts the owner. What if a sales return of $2,000 was completely omitted from the books? A customer gave the goods back, but we never recorded it.
Sales returns are a contra-revenue account. They act as a direct reduction to your gross income. If you completely omitted a return, your current income is artificially bloated. It looks like you sold goods that are actually sitting back in your warehouse.
Right.
To rectify the omission, you must record the return. You will debit sales returns. You are actively introducing a reduction to income. Therefore, this rectification will decrease the net profit by $2,000.
It is a beautifully logical flowchart. Does the fix touch an expense or an income? Does it make the company wealthier or poorer? That determines the profit impact.
It takes the guesswork completely out of it.
So we have successfully navigated stage 1 and stage 2. We have learned how to perform localized surgery and how to use the suspense account as a junk drawer to force a balance while we hunt down errors.
But now
we must face the abyss. Section 5 of our journey. Stage 3. The nightmare scenario.
Stage 3 is where the purely mathematical mechanics of accounting collide with the deep structural philosophy of financial reporting. This is the realm of the matching principle and the sanctity of the financial year.
Let's paint the picture for our listeners. It is 2022. Our accountant was tired. The trial balance didn't tally. They opened a suspense account, dumped a $15,000 discrepancy into it, and finalized the financial statements anyway.
It happens more often than you'd think.
The books were closed. Taxes were paid. The New Year's Eve ball dropped. It is now May 2023. The accountant is reviewing old files, and suddenly they find it, the missing invoice. They forgot to record a $15,000 purchase of raw materials back in November of 22.
Oh, no.
As a layman, my instinct is to just shrug and say, well, better late than never. I'll just open the accounting software right now in May 23 and debit the purchases account for $15,000. The expense gets recorded. The money is accounted for. What is the big deal?
The big deal is that you are actively destroying the integrity of the financial markets.
Destroying the markets. That sounds dramatic.
It's true. Accounting is not a continuous, endless river of numbers. It is strictly compartmentalized by time. The entire foundation of modern finance rests on the accrual concept and the matching principle.
Explain the philosophy behind that. Why does the calendar matter so much?
The matching principle dictates that the expenses incurred to generate a specific set of revenues must be reported in the exact same time period as those revenues.
Yep.
If you buy raw materials in 22 and you sell the finished goods in 22, the cost and the income must face off against each other in the 22 profit and loss statement. That is the only way an investor or a bank can accurately judge the true operational efficiency of the business for that year.
So if I take a $15,000 expense that belonged to 22 and I lazily dump it into the purchases account in May of 23, I am contaminating the new year.
You are poisoning the well. By debiting purchases in 23 for a 22 event, you are artificially inflating 23's operating expenses. You are going to make the 23 profit and loss statement look significantly worse than it actually is.
The management team might look at the numbers and think the business is failing, when in reality, they're just paying for last year's ghost.
Exactly. And at the same time, because you didn't record it in 22, last year's profits were artificially inflated. You made the company look incredibly successful, perhaps paid out massive executive bonuses based on an illusion. The professional term for this is falsifying the current year's profit and loss statement.
Falsifying. That is a word that lands you in front of a regulatory commission.
It absolutely does.
So we are trapped. We have to record the $15,000 expense because it's a real economic event that happened. But we absolutely cannot touch the 23 purchases account because that ruins the current year's integrity. How do we resolve the paradox?
We resolve it by introducing a quarantine zone.
A quarantine zone.
We create a specialized, temporary account designed specifically to absorb the ghosts of the past without letting them touch the operations of the present. This is known as the profit and loss adjustment account. Or in modern corporate reporting, it is often categorized under prior period items.
A quarantine zone. I love that imagery. So how does it work mechanically?
The rule is absolute. When you are in stage 3, the next accounting period, any correction that requires adjusting a nominal account, an income or an expense from the previous year, must be routed through the profit and loss adjustment account instead of the actual nominal account.
Okay.
You cross out the word purchases or sales or wages in your rectification journal entry, and you write P&L adjustment in its place.
Let me make sure I have the boundaries of this quarantine zone perfectly defined. Does this rule apply to every single error we find from last year? Like, if I find a mistake in a debtor's account, do I use the adjustment account?
Excellent question, and this is the most critical distinction to master. The quarantine rule only applies to nominal accounts.
Only not.
Yes, because nominal accounts are the ones that calculate profit, and profit is tied to a specific year. Nominal accounts essentially die at midnight on December 31st. They are closed out to zero.
Right.
But real and personal accounts, your assets, your liabilities, your cash, your debtors, these are permanent. They are continuous. A warehouse you owned in 22 is still a warehouse in 23. A customer who owed you $500 on New Year's Eve still owes you $500 on New Year's Day.
The reality of an asset or a debt crosses the barrier of time.
Exactly. Because real and personal accounts roll forward continuously, if you find an error involving one of them, you just use the normal account name. You do not quarantine them in the P&L adjustment account. You only quarantine the ghosts of dead incomes and expenses.
This is heavy conceptual lifting. We need to ground this with a complex scenario. Let's look at the books of a businessman, Mr. Roy. It's the new year, and he is trying to clean up last year's mess.
Let's see what Mr. Roy did.
Here is his first discovered error. Last year, he purchased a motor scooter for the business for $3,000. However, the bookkeeper wrongly debited the entire $3,000 to the conveyance account, which is a travel expense account. Mr. Roy's business policy is to charge 10% depreciation annually on all motor vehicles.
This is a beautiful, multi-layered stage 3 problem. Let's dissect the damage first. By treating an asset, the scooter, as an expense, conveyance, Mr. Roy committed an error of principle last year.
Yeah.
His profits last year were artificially crushed by a massive $3,000 fake expense. We have to fix that reality today in the new year.
Okay.
Step 1, we need to bring the asset onto the balance sheet. But we can't just debit motor vehicles for $3,000. Why?
Because time has passed. The scooter is a year older now. It has lost value.
Exactly. We have to account for reality. The scooter was worth $3,000. It should have depreciated by 10%, which is $300.
So it's true, current value right now is $2,700.
Yes, motor vehicles is a real account, so we use its actual name. We debit the motor vehicles account for $2,700.
We have established the physical reality of the asset. Now we have to deal with the ghost of the expense.
Right. We need to reverse that false $3,000 conveyance debit from last year. Normally, we'd credit the conveyance account. But conveyance is a nominal account. It's a new year. If we credit conveyance now, we will artificially lower this year's travel budget, making this year look wildly profitable. We can't do that.
Enter the quarantine zone.
Enter the quarantine zone.
Instead of crediting conveyance, we credit the profit and loss adjustment account for $2,700.
You've got it. That single entry achieves two things simultaneously. It puts the properly valued asset onto today's balance sheet, and it parks the retroactive profit correction safely in the quarantine zone where it won't contaminate today's operational data.
That is incredibly elegant. Let's try another one from Mr. Roy's nightmare ledger. Last year, he received $500 in cash from a client, Mr. C. The cash was recorded correctly, but when it was time to post it to Mr. C's personal ledger account, the bookkeeper accidentally debited Mr. C for $500 instead of crediting him.
The classic wrong side posting returns. But now we are in stage 3. Let's apply our rules. We have a false debit of $500 sitting in Mr. C's account. We know from our earlier discussion about the double amount trap that to fix a wrong side posting, we must double the figure.
So we need to credit Mr. C for $1,000. 500 to erase the mistake, 500 to record the truth.
Exactly. Now ask the crucial question. What type of account is Mr. C?
He is a human being. He is a debtor. That makes it a personal account.
Does a personal account enter the quarantine zone?
No. Personal accounts survive the New Year barrier. A debt is a debt regardless of what year it is. So we do not use the P&L adjustment account. We just use his name. We credit Mr. C's account for $1,000.
Perfect. But we need a double entry. Where does the debit go? Remember, a wrong side posting in a ledger would have caused the trial balance to fail last year. That $1,000 mathematical shockwave was absorbed by the suspense account last year, and that suspense balance rolled forward into this year.
So the junk drawer survived the New Year too.
Yes, the suspense account is carried forward on the balance sheet until it is cleared. So to complete our double entry and empty the drawer, we debit the suspense account for $1,000.
That is a vital realization. Even in stage 3, fixing prior year errors, we still rely heavily on the suspense account if the error originally caused mathematical imbalance. The only thing that changes in stage 3 is how we handle the nominal accounts.
Precisely. You are manipulating two different holding pens at once. The suspense account holds the mathematical discrepancies. The P&L adjustment account holds the chronological profit discrepancies.
Which leads to the ultimate question. We reach the end of this grueling cleanup process. Mr. Roy has found all his errors. What is the final fate of these two temporary accounts? The P&L adjustment account has collected a net balance of all these prior year profit corrections. Can't just sit there on the books forever, right?
No, it has served its purpose as a quarantine zone, and now the quarantine must be lifted. The final net balance of the profit and loss adjustment account represents the true, corrected profit or loss from the previous years. Who does that profit belong to?
It belongs to the owner.
Exactly. So you calculate the final balance of the adjustment account, and you transfer it directly into the proprietor's capital account.
If the adjustment account has a net credit balance, it means last year's profits were artificially understated. We suddenly discovered new wealth, so we add it to the owner's capital.
Correct. And if it has a debit balance, it means last year's profits were a mirage, and the owner is actually poorer than they thought. We deduct it from their capital. It bypasses the current year's income statement entirely and goes straight to the foundation of the owner's equity.
Wow.
And similarly, if there is any stubborn, unexplainable balance left in the suspense account after all investigations are exhausted, which sometimes happens in messy corporate environments, that remaining balance is also typically transferred to the capital account to wipe the slate clean, though doing so is essentially an admission of defeat by the auditor.
It's basically saying, well, we can't find the missing $50, so we are just taking it out of your paycheck to make the math work.
That's exactly what it is.
We have covered immense ground today. We have traversed the history of double entry, the taxonomy of errors, and the rigid timeline of rectifications. Before we summarize the journey, I want to engage in a bit of a philosophical sparring match.
Well, bring it on.
I am going to throw some common scenarios at you. The kind of traps that auditors look for or that examiners use to torment students. You tell me if the premise is true or false, and more importantly, defend the logic. Are you ready?
I am ready. Let's do it.
Scenario 1. A manufacturing company buys a massive, state-of-the-art robotic assembly arm. The bookkeeper, seeing a huge outflow of cash, assumes it is an operational cost and treats the purchase as a daily expense. This is classified as an error of principle. True or false?
True, unequivocally. This is the textbook definition of an error of principle. And it is the exact mechanism of the WorldCom fraud we discussed earlier, just in the opposite direction.
Right.
They are mixing up a capital expenditure, which buys assets that provide economic benefit over multiple years, with revenue expenditure, which is consumed entirely within the current year. By expensing a robotic arm, they are committing a massive violation of accounting doctrine that will violently distort their current year profit downwards.
Excellent. Scenario 2. If an accountant commits a series of compensating errors, the trial balance will still agree, meaning the financial statements generated from it are completely reliable. True or false?
The first half of the statement is true. The trial balance will agree. The second half is dangerously false. The financial statements are absolutely not reliable. Compensating errors are the terrifying coincidence where A mistake on the debit side is perfectly matched by an unrelated mistake on the credit side.
The dark coincidence.
Yes, the math works, the scale is balanced, but the underlying reality is a fiction. It is the ultimate proof that a tallied trial balance is a prerequisite for accuracy, but never a guarantee of it.
Scenario 3. The owner of a bakery writes a check from the business account to pay the monthly rent for his personal apartment where his family lives. The bookkeeper debits this payment to the business's rent account. True or false?
False. And this is a trap that ensnares thousands of small business owners every year. It violates the business entity concept.
Separate the owner from the business.
Exactly. The bakery is a separate legal and financial entity from the baker. If the business pays for the owner's personal shelter, it is not a business operating expense. It provides no economic benefit to the bakery. It is a withdrawal of equity. It must be debited to the drawings account. If it sits in the rent account, it is an error of principle, and the owner is illegally reducing their taxable business income.
Final scenario. This one requires careful thought. A logistics company buys a fleet of second-hand beat-up delivery trucks. Before they can use them, they have to spend $10,000 on massive engine repairs and new paint jobs to make them roadworthy. The bookkeeper debits this $10,000 to the standard repairs and maintenance expense account. True or false?
False. And this is a brilliant nuance in the rules of capitalization. The word repairs usually triggers our brain to think expense.
Of course.
But the foundational rule is that any expenditure incurred to bring an asset into its initial working condition for its intended use by the company must be capitalized.
Oh, because it's required just to get it started.
Exactly. It does not matter that the trucks are secondhand and old to the world. They are brand new to this company. The company cannot generate revenue with them until those specific initial repairs are done. Therefore, that $10,000 is part of the acquisition cost of the fleet. It must be debited to the motor vehicle's asset account, not the day-to-day repairs expense account.
That is a phenomenal distinction. The context of the repair dictates its classification.
It's all about context.
Well, we have dissected the anatomy of the mistake from every conceivable angle. Let's do a comprehensive chapter recap for you listening to really cement this immense framework into your long-term memory. How should you approach any discrepancy you encounter?
It is a logical, sequential flowchart. Step 1, do not panic. You detect an error. Step 2, you must immediately establish when you are in the timeline. Are you in stage 1 before the trial balance? Are you in stage 2 after the trial balance but before the books are closed? Or are you in the nightmare of stage 3, the next accounting year?
Right, the timeline is key.
Step 3, you diagnose the error using the POCC framework. Is it an error of principle, breaking the rules? Omission, forgetting the transaction? Commission, clumsy clerical math? Or compensating the dark coincidence?
POCC, got it.
Step 4, you apply the timeline-appropriate fix. If it is stage 1 and a one-sided error, you use localized surgery, a simple explanatory statement in the ledger. If it is stage 2, the trial balance is artificially locked, so you must use a complete double-entry journal correction, utilizing the suspense account, the junk drawer, to absorb any imbalances.
And if it's stage 3?
If it is stage 3, you apply the quarantine rules. You fix real and personal accounts normally, but any corrections to nominal incomes or expenses must be routed through the profit and loss adjustment account to protect the integrity of the current year's timeline.
And we have our critical survival rules. The double amount rule. If you clumsily post a number to the wrong side of a ledger, you must double the amount in your rectification entry to neutralize the mistake and establish the truth.
Always double it.
And the profit impact rule. When analyzing a correction, ask yourself if the fix increases in income or decreases in expense. If it does, your profit goes up. If it decreases income or increases in expense, your profit goes down.
If you can internalize that sequential logic, there is no accounting disaster, whether on a university final exam or in the chaotic aftermath of a corporate acquisition, that you cannot methodically untangle and resolve.
Which brings us to our final overarching thought for this deep dive. Something for you, the listener, to genuinely ponder the next time you look at the financial health of a company. Whether you are investing your life savings, auditing their books, or even just accepting a job offer from them.
It's an important perspective.
We have spent this entire session exploring the mechanics of the suspense account. It is an incredibly powerful tool. It is the life raft that allows a company to finalize its trial balance, close its books on time, and systematically hunt down its errors without grinding operations to a halt. But I want you to view it through the lens of a detective. Imagine you are looking at a company's internal ledgers over a 5-year period. And every single year, right at the deadline, a massive, bloated suspense account appears. Millions of dollars are dumped into this junk drawer just to force the math to work.
That's a scary thought.
Now, let's assume that 6 months later, the accounting team eventually finds all the errors, posts the double entries, and clears the suspense account perfectly to zero. The math is eventually clean, the crisis is always resolved. But what does the constant, desperate reliance on that junk drawer tell you about the structural integrity of the company?
It is the ultimate red flag. A cleared suspense account proves that the final arithmetic worked out. But a constantly utilized suspense account proves that the internal controls of the business are fundamentally broken.
Broken how?
It means their daily processes are chaotic, their data entry is sloppy, and they are constantly relying on emergency post-mortem surgery because they do not know how to record the economic reality correctly the first time.
The math might eventually be sanitized, but the operational foundation is crumbling. It is a culture of chaos, masked by a final, desperate balancing act. It is something to look out for. A perfectly balanced set of books at the end of the year doesn't necessarily mean the journey to get there was honest or stable.
Very well said.
Thank you for joining us on this exploration of financial truth and error. Keep questioning the numbers, keep investigating the discrepancies, and keep balancing those books.